big orders.
No.
And China
Well, what's
is not
wrong with
using
that?
this
That's
stuff.
most people look at that and go, great.
Well, Powell's not looking at it. He's the only guy
my-
that matters. Nestor thinks it's an inverse. It's inverse. Right? It's inverse, not gas.
Why would that lead to be saying, okay, yeah, that's,
Because, David, that's not the way it works.
Ah, got it. That's
Okay.
not the way it works.
Well, sort of one thread from that is travel names, Jim. TSA screened how many passengers over the weekend? Well, 300,000 more than we did.
Right, and then you still
Over a
have we're
four-day Memorial Day
running out of plays on that, and people still want to go back to they want to go to the cruise in Royal Caribbean.
Yeah,
He's
CCL, one of the leaders this morning.
I don't trust the airlines.
3-month high on that.
Chief Fun Officer of Carnival. Shut.
And the Nasdaq's up over 1%, in part driven by Nvidia, but also you got Apple.
But look at Alphabet. Look at
I
Alphabet.
know
Google's down.
You got Google down. But
Because
you got
people
Tesla up
understand the
sharply,
A100 is not as
Netflix up
good.
Sharply.
Well, I just find that everything else is just you try to get into something, and you think you have a thesis, but it's not tech, and it just goes down. Like there was a recommendation of one of my worst picks, which is J&J, because the talc lawsuit, it was a recommendation to buy, and I figured, okay, we're gonna get some little relief. It's going to be up $1. No, it's down.
Well, I know you noticed the Constellation upgrade over at MKM.
Well, they actually have Nielsen data, which shows that Corona lights come back to life.
That's
and that's been very good.
That's
Modelo
highs for the year.
Yeah, but that's a lot because of the problems of Bud Light.
There was some insider selling
Bud Light.
recently, right?
Well, the
Constellation.
Sands family continues
Yeah,
to sell,
they
but then
keep selling.
once they finish, they have to sell in tranches. They're not in the market now.
Right.
But I mean, this is a Bud Light share
play
take.
on the other side of it,
Share
right?
take.
That they
That's what
take
it
a
is.
share from
I mean, I'm not going to say that suddenly everyone,
the Bud Light fiasco.
but also the summer months it tends to do well, and Bill Newland's doing a good job. And the Nielsen, like I said, the Nielsen data came out 2 weeks ago and was really pro Constellation.
So classic action here with the Nasdaq up 1%, but the Dow negative. S&P highs for the year, going back to August or so. As we go to break, check bonds as well. We did get some relief in some of those T-bill yields this morning. June 1 now yielding about 5.1 as this debt ceiling proposal starts to work its way into the whips. We'll watch for a vote sometime this week. Be right back. Been a while since we've talked about regional bank lending stress. Piece in the FT this morning that the KRE has had 2 consecutive weeks of gains. First time since February. They argue, Jim, that it's a relative bargain for some.
Yeah, I still think that you're going to see, they have to pay more for FDIC coverage, and I think that not necessarily losses have gone up, but the lending is going down. David would like that normally.
Yeah, although others argue that was already in place.
Yeah.
We'll see. It's something to watch. There's the KRE this morning with the Dow down 65 and S&P 4220. Don't go away.
$85.55.
It's time for Jim and Stop Trading.
Well, lost in all of the market is that crypto's been going up. And there's a great piece today by Atlantic Equities saying that Coinbase is the best way to play it, upgrade to overweight, and it's saying it's trying to regain custody assets. I mean, I've been very skeptical, but this is a very positive piece about Coinbase, and I have to admit that they were supposed to be challenged by the SEC, and it looks like they are okay. Really amazing.
Yeah, $70 target.
Yes.
Interesting. What are you going to tackle tonight?
Okay, I've got 2 AI plays. I've got Marvell, which had an incredibly bullish AI conference call last week, up 40%, David. And then Enrique Lores, who I think is going to want to talk AI and the evolution of the PC. And what can I say? I mean, this is what works. It's what works. And I think we all feel challenged in our business to say, is this going to be a SPAC thing? And I meet a lot of people over the last week who say, you know, please don't be a part of this. And then I get the Jensen stuff. Jensen Huang.
It's completely
Please
different.
don't be a part of the AI
Yeah,
revolution.
it's completely different.
I agree.
It's a seminal
agree.
change.
It has real
It has
orders.
nothing to do with a
No,
financial
it has to-
creation of Wall Street that enriched a handful of people.
No, it's a new way to compute. And it's working for even companies that we thought were going to be wiped out, like advertisers.
This is a sea change.
I'd like to be more skeptical. You know, his like we're all going to die thing, like Billy and Predator.
That's
it's
a
like,
longer-term story.
Longer term.
Yeah.
It's longer term. I mean, we are all going to die, by the way. That is still the news.
But our
flash.
great-great-grandkids, are they?
Maybe even our kids won't. I don't know.
No.
Singularity going to be.
No, our kids are still going to be helped by it. It's not done luring us.
You'll
away.
live on in the cloud no matter what. You'll just be there.
We have to go.
I'll see you tonight. Mad Money, 6 p.m. Eastern Time. We covered a lot just now. When we come back, more on NVIDIA's valuation surpassing $1 trillion for the first time. Back in a moment.
Good Tuesday morning and welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber, live as always for you from Post 9 of the New York Stock Exchange. Take a look at stocks. S&P 500, highs of the year here, up about 1/3 continues to push higher after the rally we got on Friday. The NASDAQ again leads the charge. Those tech-specific AI stocks doing a lot of the market's work here, up 0.6%. And you can see the weakness in broader stocks with the Dow down again, although kind of flattish, 9 points or so. 30 minutes here into the trading session. Here are three big movers we're watching right now. Shares of NVIDIA hitting new all-time highs and its market cap topping $1 trillion for the first time ever. It's also the first time a U.S. chip maker has joined that exclusive $1 trillion club. More on this in the AI arms race straight ahead. Tesla, one of the top gainers in the S&P right now, as well as CEO Elon Musk, heads to China for the first time in 3 years. We've got the latest from Beijing this hour. And Netflix shares are also pushing higher. The stock's now up 17% this month, and its market cap, once again, topping Disney.
Getting some data this morning out of Conference Board. Let's get to Rick Santelli. Hey, Rick.
Yes, good morning, Carl. Conference Board consumer confidence for the month of May. Headline number expected to be up at 99.0. Comes in much better. 102.3, 102.3, and that jumps over what now is a revised, big revision from 101.3 up to 103.7. And what's notable about that is with that revision, it now makes the current better than expected read at 102.3, less than the rear view mirror, and the smallest month-over-month confidence number since November of last year. And if we look at the present situation, not a good number, 148.6. That's the lowest number of the year. You have to go back to December of last year to find a lower number. And finally, on the expectations, what may lie ahead, 71.5. That follows a revised 68.1 that moves up to 71.7, which makes 71.5 the lightest read since February, as, of course, expectations have been a bit on the depressed side. Interest rates have been pretty much across the curve lower. Debt deal hasn't been passed, but there is a deal. We're about in the middle of the range on a 10-year. We've been as high as 377, as low as 370. We hover right about in the middle at 373.5. Sarah, back to you.
All right, Rick, thank you. Rick Santelli with the consumer confidence data. Better on the headline, worse on present situations. Guys, today's all about digesting the deal that we got from Speaker McCarthy and President Biden as we await what will happen in Congress, basically. It's a tight margin for error, a tight window here until the June 5th now ex-date that the Treasury has set. That's next Monday. But all the research and all the commentary has to do with how this is going to affect the economy, right? This new deal. So there's been some preliminary looks at it. And the good news, at least for markets, is it appears market friendly from that perspective of it could hurt the economy a lot worse. 2011 saw a little bit more austerity, for instance. I'm looking at the Goldman note, for instance. Jan Hatzius writing, the spending deal looks likely to reduce spending by 0.1 to 0.2% of GDP year over year in 2024 and 2025, compared with the baseline in which funding grows with inflation. JP Morgan also says that despite the fact that we've got a lot of legislative hurdles and not a lot of time, if it does get signed into law, the implied spending reduction does not look like a game changer for the macro outlook. So that should be good news for the market that could have been worse in terms of cutting spending and weighing on the economy.
Yeah, for example, Jan is looking at a 0.4 GDP shave just from the credit crunch and regional bank stress. So this would be not very much of a shift in the macro forecast because of the debt ceiling itself.
Because it's a flatline spending, basically, from 23 to 24, and then a 1% increase to 25. The bigger issue, and I think, we've been covering the market reaction, is sure, maybe a little bit of a relief rally, but the equity market didn't really price in any kind of disaster happening. It didn't get so worried about it. So it's hard to price in relief now. I think the next steps that the market are looking at is, and we've talked about this before, the massive issuance of Treasury bills now needed for the Treasury to refill. Its cash balance is like 39 billion. It's the lowest it's been in a while.
You've made this point. You did last week. You asked a couple of questions about it. I was starting to hear about it in the marketplace as well, that it may push out other liquidity. Is it a real concern, though, or is it just something we're going to talk about and then we're going to be, oh, that really actually happened?
I think it depends if it sucks out reserves from the banking system, right? Because then you've really got a liquidity suck. And Bank of America says it could be equivalent to a 25 basis point increase in the Fed funds rate. Remember, you always have to think in terms of how much it tightens the economy and the markets. And this is a market that's fed off liquidity. So it could be a real thing. We kind of just don't know. It depends on what kind of buyers step in for all this debt that the Treasury is going to issue, right? But that is a real thing. And it's happening, I think, at a time where liquidity is already being sucked out because they're shrinking the balance sheet.
Right.
And now we're expecting another rate hike in June. The market has moved into more than 60% odds that we get a rate hike because the data and the Fed speak just don't sound like they're justifying a pause necessarily.
So the sucking out of liquidity as a result of massive issuance could be worth 25 basis points. We're still dealing with the question mark of lending from many of the regional banks and whether that is going to be curtailed in part because of their own balance sheet issues. And you're still telling me we're going to actually get another 25 basis points?
Well, the argument is that the data's run warm. The stress that we're getting from the banks arguably was already happening anyway. It has been for a while. You got this package. If it passes, why wouldn't they hike in June?
Well, and we got some good news on Friday from the Fed data. It looks like loans rose again. Commercial bank lending rose 10.4 billion in the week. That was a 3-week high. Deposits also rose across the banking system, 30 billion during that same period. So yes, we're still expecting some sort of squeeze, but it's not the credit crunch that, worst case scenario, at least Not yet.
The numbers are not bearing that concern out, at least.
They're not. And so that's going in one direction. And the data's moved in the other direction. It's come in strong. And the inflation, the PCE numbers on Friday went in not the way the Fed wanted it to go. We still got an inflation report. We've still got a jobs report. But, David, it's also the Fed speak. We had Waller on the tape, the Fed governor, who's been pretty out front on this hiking cycle, I would say, coming out and saying he doesn't expect the new data coming in to tell us that we're necessarily at a restrictive enough point.
I know. Although, look at energy. Look at WTI. Look at natural gas. They don't care about that, I guess.
Because it's come down.
Yeah, a lot.
It's come down a lot.
Trying to hold 70 this morning. First things first, though, we got to get this package past the Hill. And for that, we'll turn to an expert whip. That is Kayla Tausche. Hey, Kayla.
Hey, Carl, good morning. President Biden and Speaker McCarthy now fully in sell mode. They're trying to shore up the 218 votes needed to pass the Fiscal Responsibility Act, as it's being called. And first, it will be taken up in the House. Each party was briefed over the weekend. The House Rules Committee is set to advance the bill today, though 2 Republicans have said definitively that they would vote no, leading to questions about how McCarthy would respond and whether he would still move it forward. If he would, the House would then vote after that, and the Senate would begin its proceedings after that. But some members in the Senate have been vowing to slow walk it, and that could delay passage to over the weekend right before that Monday deadline. Asked about the chorus of criticism, the president said any skeptics should talk to him directly, and he said he's optimistic about the deal's prospects.
I feel very good about it. I've spoken to a number of the members. I spoke to McConnell. I spoke to a whole bunch of people, and it feels good.
Mitch McConnell, the top Senate Republican, has vowed to get his colleagues to support anything that can pass the House. House Republican leadership has pledged 150 votes, with Democrats expected to provide around 70 votes. But members today, as they study the bill, could shift their views. We've already seen some moderates coming out on Twitter, guys, who have said, you know what, I'm not going to be able to support this. But we know the White House and several cabinet members are working the phones behind the scenes, dozens of calls being made every single day. So we will see whether that campaign can move any hearts and minds, and we'll find out a little bit more later on this week.
I know they're both spinning it as a win, but the White House and the Republicans, who got more of what they wanted?
Well, I think you just have to look at the vote counts that are pledged there. House Republicans believe that they can put up 150 votes. That would mean that Democrats would only have to put up 70. And I think that it's fair to say that the deal that was reached was based off of the original Republican agenda. Yes, Democrats in negotiations were able to shave some of those numbers down pretty substantially. And certainly White House officials have put out some memos and talking points suggesting that they did get some wins, that there were some parts of the SNAP program that were protected. There is some slight change to permitting reform that will benefit more green energy policies, although the big kahuna for permitting reform did not end up being part of the bill. So certainly there are some small wins that Democrats are trying to tout here, but by and large, the package resembles a lot of what the Republicans brought forward, and that's why the president's having a really hard time with his caucus specifically.
All right, Kayla, thank you. Kayla Tausche. The S&P and NASDAQ coming off their best day since early May, and the tech rally marches on. NVIDIA hitting $1 trillion in market cap for the first time ever. Senior markets commentator Mike Santoli now joins us at Post 9 to break it all down. So beyond NVIDIA, what is the rest of the market telling you?
Well, NVIDIA and then this very narrow channel of other stocks that are able to feed off of the AI enthusiasm have been doing a lot of the work. The NASDAQ 100 came into the week up 30% year to date. The equal-weighted S&P flat year to date. It shows you that's where the upside impetus has come, especially since March. And because of that, the NASDAQ 100 is, by almost any measure, getting bit stretched. It's overbought, just in a routine way, kind of the way it was November 2021, but also last August as well. So it's probably should cool off. And that would mean perhaps that the S&P would have some either kind of absorb it through the other stocks that haven't participated or pull back at the top end of its range itself. But what I find interesting is a lot of this tech outperformance has been a massive catch-up move. On a 3-year basis, take a look at mega cap growth stocks, the mega cap growth ETF, relative to the equal-weighted S&P. They're basically neck and neck right now, but it's been a huge comeback by those tech stocks in the last few months. So I feel like it's a less stable way for the market to rally. So the criticism of the narrowness of this rally has been somehow that it's sort of not the way you want to see bull markets act. And I grant that. You would prefer to see a broader market. But to me, the equal-weighted S&P has been registering what we're dealing with. It's been dealing with all these little scares, the regional bank scare, what the Fed's going to have to do, and the fact that the economy is at least considered to be supposed to slow down at this point. And it hasn't quite taken hold just yet. I would also point out what you were talking about before in terms of the Treasury issuance. We could be double counting here a little bit. What I mean by that is the anticipation of the issuance has distorted, has had the bond market front run that a little bit with the yields going up a lot. And it might be goosing the implied Fed funds expectations still about June. So there's no way of knowing exactly how much of it is that, how much Fed speak in the next week until the blackout window might go against that. And even, by the way, I'm seeing some commentary about the consumer confidence report just now that the employment read was soft. And so that might change the calculus for all of it. So it leaves us at the top end of the range for the S&P 500, reliant on a relatively narrow group of stocks that are really partying and feeding off of this excitement that doesn't have enough places to go.
The AI excitement, you mean?
Outside of NVIDIA, yeah.
What about, I mean, it does bring you back to some extent 25 years ago to the internet craze, or even more than that at this point.
Exactly.
And people, obviously, for proper reasons, being excited about what that would bring. But that spread wide and far. You don't see that happen.
That's the thing. So if it's a real bubble, it's not there yet. If it's just kind of this eruption of temporary enthusiasm, we're repricing NVIDIA for this massive, buying panic by their customers, which is really what it seems to be, then it's different. If you're not seeing IPOs, if you're not seeing basically everybody hit the market's willingness to buy this stuff, it sort of feels like, it might have gone too far in the short term, but it doesn't yet merit the comparison to what we had. By the way, Intel hit a $500 billion market cap in the year 2000. 23 years ago in a much, much smaller market.
Cisco also was over
way less than half as big as
Cisco was
one.
also over half a trillion at one point.
That's right.
And has never seen anything close to that.
My point is $1 trillion today is less than $500 billion was that.
Got it.
Yeah.
Always good for the historic perspective, Mike. Thank you. As we had to break, our roadmap for you for the rest of the hour. Exactly 2 weeks until the next Fed meeting on rates. Why a pause, as we've been discussing, may be in peril.
Plus, don't know if you heard, but NVIDIA's topped $1 trillion on market cap. That would be the first time ever for that company. We got a lot of commentary out, of course, on AI overall. And what we just discussed with Mike, are we in bubble territory of any kind? We'll question that.
Also, the health of housing, home prices rising, and so are mortgage rates. Redfin CEO will join us with his pulse on the market as we did hit highs for the year, settling back just a touch, still 42.15.
for you.
Welcome back to Squawk on the Street. We're exactly 2 weeks away from the next Fed meeting. Of course, we've been talking about whether or not the Fed will raise rates by as much as 25 basis points. The stakes have been raised as a result of the conversation recently. Maybe not a pause. Steve Leisman's got more for us. Those percentages keep going up, Steve.
Yeah, and they're staying there for a couple reasons, David. I'll go through those. The hope for a pause, though, looks to be in peril. We have several economic risks that they could have stayed the Fed hands from hiking rates. They now look to be less likely. Tuck one, the debt default would have stayed the Fed's hands, but an agreement appears to be more likely. And the deal, importantly, perhaps less negative for the economy. J.P. Morgan estimating that the debt ceiling deal would shave about 0.2 percentage points off of GDP next year, less than they had estimated, and much less than you can see there, the 0.7% subtraction from the 2011 debt deal. For another reason, the banking turmoil might have stayed the Fed's twitchy rate hike in hand, but the latest Fed data shows domestic bank loans and deposits, they're actually up a bit in the past week. Deposits still down from before Silicon Valley Bank failed, but loans are higher, and there doesn't look to be a massive credit pullback that's going to hobble the economy, at least not yet. And it doesn't look anything like the 08-09 chart. That combines with Friday's still high inflation data, plenty of hawkish Fed rhetoric, putting the rate hike back on the table in those percentages David was talking about. Futures trading with a 60% probability of a rate hike in June, and it's mostly priced in through July. You can see now the big deal here. The year-end rate now just estimated by the market, just 14 basis points below the Fed officials' own median forecast. It had been as much as 100 basis points shy. Okay, got the jobs number coming up this Friday. It's going to play a role in shaping expectations. Wall Street forecasting a slower but still strong 188,000 jobs. So that leaves only one inflation report, guys, standing in the way of the Fed and another rate hike. Sarah?
Yes. And here we go again, waiting on the big inflation report. Steve, thank you. Steve Leisman, our next guest, laying out what he calls shock absorbers that are keeping the economy from sliding into recession year. Joining us is Yardeni Research President Ed Yardeni. So, Ed, the market is actually not doing terribly with the fact that we've had a rapid shift in Fed expectations in the last few weeks, now thinking about a June hike, maybe even a July hike. What do you make of that?
Well, I think the market has been remarkably resilient, mostly because the economy has been remarkably resilient. My thesis here is that the pandemic was a big shock to all of us. It was different. None of us experienced anything like it. The last time in history we had something like it was the Spanish flu in 1918. So it was a big shock. And now that the pandemic is basically over, there's still shockwaves from it. And yet there's some very substantial shock absorbers that have cushioned the economy from falling into recession.
Hey, Ed, it was fun to read some of your stuff over the weekend in which you said that parts of your roaring 20s thesis remain intact. Although I remember a few weeks ago where you did say another hike would make you pretty nervous. Has that gone away?
Yeah. No, it hasn't gone away. You know, I have to be realistic about the opportunities and the risks in this market. So I'm not going to kind of take one position here and tell you that nothing can go wrong. I mean, I have to, since I am an optimist and a bull in this environment, I have to be very well aware of what could go wrong. I think the Fed has got to be pretty close to done. I think that the banking crisis demonstrates that we are in restrictive territory. Jerome Powell basically acknowledged that a few days ago, that we are in restrictive territory. And what they really wanted to do is get it up to restrictive and keep it there. They didn't want to keep raising interest rates until something really seriously breaks and then be forced to lower interest rates. So I think they're where they want to be, and I think they're going to keep it here.
When you talk about shock absorbers, are you talking about fiscal policy? Just the enormous stimulus we've had, the legislation around infrastructure and that sort of thing? Because what I hear is that definitely works against the recession idea, but the excess savings do wear out by the end of the year.
Well, there's still a tremendous amount of liquidity in the system. Some of it is very visible in M2, which is still about $500 billion above its pre-pandemic trend line. We know that there's excess saving, and it's very likely that excess will end by the end of the year, as you point out. But meanwhile, the labor market continues to generate jobs. Meanwhile, we're seeing that wages are actually starting to increase faster than prices. And then another important shock absorber is the baby boomers. I'm one of that group, so I know what we're doing. And I'm still working for a living, but a lot of my friends are retiring, and they're getting pension benefits. They're getting 401k payouts. They're getting Social Security, and they got a lot of time to spend the money on early bird specials at the diner. And they're traveling a lot. I know that from what friends are doing.
Not to mention a lot of home equity. One thing that you did mention was that rent inflation is moderating pretty fast, and you think that's going to continue through the course of the year, right?
Absolutely. We have, as you know, we've got these monthly coincident indicators of rent that are showing what current leases are doing, and that inflation rate's coming down substantially. And that really is a good leading indicator for the rent measures in the CPI and in the PCED. So I think that's coming down. I think durable goods inflation is going to be zero for the foreseeable future. So I think we need to see some moderation in other services, and I think we will.
So are you a buyer of cyclical stocks? They haven't acted well, Ed, even though we haven't had the recession yet.
Well, you know, my roaring 2020s thesis certainly has come back strongly with this AI development. And I think we're just in the early phases of really integrating artificial intelligence with robotics, with automation. This really all adds up to increasing the productivity of the brain. Previously, in previous productivity booms, we increased the productivity of brawn, horsepower. And so I think this is a radically different productivity boom that suggests to me that all companies are technology companies. If you're not using technology to increase your productivity, you're going to be left behind.
Ed Yardeni, thank you. It's good to get your updated views. Appreciate it.
Thank you.
Still ahead this morning, Tesla's headed higher as Elon Musk returns to China for the first time in 3 years. We'll get the latest from the ground over there as the stock above the 200-day for the first time since September. Don't go away.
Elon Musk arriving in China this morning. It's his first trip to that country in 3 years. Let's go over to Eunice Yoon and get more on this trip. She joins us from Beijing. Eunice.
Thanks so much, David. Well, Elon Musk's private plane was spotted here in Beijing today. He met with the foreign minister, and the expectation is that he's going to meet with the Chinese premier and then head to Shanghai, where he would oversee the factory there for the company. Now, upon his arrival, Musk had very positive things about China and Tesla's relationship. According to the foreign ministry, which published his comments, he said that China's development achievements were natural, that he, like Beijing, opposes decoupling and breaking chains, and that he's willing to expand in China and share China's opportunities. Now, his remarks were met with equal enthusiasm from China's government about Tesla. They said Tesla shows that China's commitment to international business climate is very strong. And then the minister used Tesla as an analogy on U.S.-China relations, saying that Tesla is needed to avoid dangerous driving, and also that they should step on the gas, the U.S. and China, to promote mutually beneficial cooperation. Now, Musk isn't the only American CEO who happens to be in China this week. JP Morgan's Jamie Dimon is also in Shanghai already for an event there that's going to gather about 2,600 bankers as well as clients over the next 2 days. In fact, just moments ago, Shanghai's government posted on WeChat that JP Morgan's Dimon met with the Shanghai Communist Party chief there and also discussed JP Morgan's great progress in the city, and also would increase its investment there in the development of Shanghai as a financial center. Guys?
Yeah, Eunice, is David. And Tim Cook was there not that long ago as well. Specific to Musk, it's not just the Shanghai factory, right? He's got a battery factory they're building as well, I believe. And there are some who say he's made certain commitments to the Chinese government in terms of investing over time. Do we know anything about that?
Nothing very specific. Like you, I've heard a lot of different rumors or reports about what he might be doing, that there's a possibility that he would be overseeing and checking a refreshed Model 3 for this market. As you know, the market has Tesla as a leader, but there's a huge price war going on, and Tesla doesn't have a new product. So that's one thing that a lot of people have been talking about. You mentioned Tim Cook. I think what's interesting is that when Tim Cook came and when a lot of other American CEOs came here, they were very much under the radar, or when they did speak publicly, they tried to not really take any sides or sound overtly pro-Beijing. Elon Musk taking a bit of a different task, obviously much more pro-Beijing than a lot of the others. And one would wonder then what that could potentially mean for him back in D.C., since from the conversations I've been having here with a lot of executives, especially American ones, they're very worried about the impression they could leave back home by being so openly committed to Beijing in this market.
Yeah, I mean, how about Jamie Dimon hosting a banking conference there? It's not something we hear about that often. It's such a tricky dance. So is it Eunice, that the attitude of the Chinese government, are they welcoming of these American CEOs? Is the feeling that as long as you're not in a strategic industry like semiconductors, you're good?
Well, I think they say that they are open and that they are committed to a very welcoming environment for international companies. I think you hit the nail on the head when you said that if it's an industry that China wants to promote, and they think that foreign help is going to get China there to where they want to go, then you're very, very welcome. But of course, the backdrop of all of this is that there's been a lot of uncertainty here within the international business community because of crackdowns on various sectors, most particularly in the consulting sector. And there's a big question mark because there's an anti-espionage regulation that's going to be coming into place in July, and a lot of questions about the kind of vague wording about what is considered a spy, because it looks like right now that really any type of information gathering is being scrutinized.
Eunice, thank you. Eunice Yoon in Beijing tonight. Speaking of AI, the AI arms race pushing shares of NVIDIA to all-time highs yet again as the chipmaker hits $1 trillion in market cap for the first time ever. Our next guest says AI is in a bubble. Tech investor Roger McNamee joins us to explain why. Dow's down 65 points. S&P and NASDAQ remain positive. We're back in 2 minutes.
Welcome back to Squawk on the Street. I'm Bertha Coombs with your CNBC News update at this hour. Moscow was hit by drones this morning in what appeared to be the first attack on residential areas of the Russian capital since the invasion of Ukraine. The Russian Defense Ministry blamed Ukraine for what it called a terrorist attack, but Ukrainian officials said the country had nothing directly to do with the drone strikes. China declined a request from the United States for a meeting between the country's defense chiefs. The Pentagon suggested the meeting take place during a security forum in Singapore in June. Washington has been trying to restore high-level communications with Beijing as both sides show a willingness to ease tensions stoked by clashes over Taiwan, a Chinese spy balloon, and Russia's war with Ukraine. Meantime, China launched a new crew into space today with its first ever civilian astronaut on board. The spacecraft is headed to China's space station to relieve a crew which has been living there since November. China has been ramping up efforts in space exploration lately and aims to send a crewed mission to the moon by 2030. Gives a whole different meaning to the moon, Carl.
Everybody wants to do it.
Right? Literal.
Thanks, Bertha. Bertha Coombs. As you know, NVIDIA hit that $1 trillion market cap mark this morning for the first time ever. The AI boom fueling more than $4 trillion in gains for tech stocks this year. That's according to Refinitiv data. Our next guest compares it to crypto and the metaverse, saying companies are more concerned about building market value before they actually build the business for AI. Joining us this morning, early Facebook and Google Investor Elevation Partners co-founder Roger McNamee. Roger, great to have you back. I don't think you're, correct me if I'm wrong, I don't think you're comparing this AI structural change to crypto or the metaverse, or are you?
No, Carl, the big thing that's comparable is that the incentives of the system are not aligned with the incentives of society. So if you wanted to do AI properly, you would do it the way the people are doing in drug discovery, which is you have a highly curated training set and you put a great deal of effort into making sure that whatever outputs come out are always going to be accurate. Today's things that they're calling AI, particularly the generative AIs like what OpenAI makes with GPT-4 and ChatGPT. These are literally just BS generators. They have no verified content in them, and the results are incredibly unreliable. And the notion that we're going to apply this to things like search, it's going to result in just one bad outcome after another.
What you're saying reminds me of what the B of A desk said last week, and that is that the NVIDIA quarter and the guidance and the actual dollars being marked as a result of all of this made them believe that the market's going to sniff out any kind of phony association with AI, that you can put it next to your name, but it's not going to, the market's not going to reward you necessarily the way it has NVIDIA. You disagree?
Well, the key thing with NVIDIA is every time you make a large language model, you spend something like $500 million on NVIDIA chips. That's real money. And the trick here is that the guys at OpenAI are trying to create the illusion that what they're doing is inevitable. And yet there is no obvious business model. There's no way to monetize this other than with surveillance capitalism. And we know from social media how much harm that causes. And so what you're looking at here is a battle between the OpenAI guys trying to create this sense of inevitability and the reality of the marketplace saying, wait a minute, guys, interest rates are now 5%. $500 million in parts just to do each training set that you do, plus the labor, plus if you do this properly, whatever the costs are of curating the data, that's too high in a 5% interest rate environment when you have businesses with no obvious business model.
But isn't the business model, isn't it going to change everything? And I know there's a lot of dangers and a lot of worries about AI, but that it's going to make everything more productive and more efficient and lead to all this technological innovation and the way that the internet did, ultimately improving the way we do everything.
Well, that's what they want you to believe, but there's literally no evidence that today's technology can do that. I mean, the search engine results, you need to do fact checking on a search engine. That literally defeats the purpose of a search engine. And, you know, you see these stories. I mean, there was the story last week about the lawyer.
You have to do that with Google, too.
I'm not disputing that, but I'm not saying that isn't progress, right? When you have a thing with Google, Google gives you a long list of potential sources. This is going to give you one answer that sounds tremendously authoritative. And yet it has what they like to call hallucinations, which are basically just nonsense, made up things. And the point here is they could do really great work. AI has enormous potential. The trick here is you need to change the incentives. You need everything to operate where the executives who are leading these projects have an incentive to protect the people who use it, to ensure that the content produces accurate results. And neither of those things exist today. And until it does, until you see those things driving the industry, the products that they make are going to suck.
You keep talking about use cases, and you come back to search and inaccuracy, Roger. But I mean, you know, Meta, here's another name that I know you love, but they're using it all the time. I mean, the thing is writing code. They're replacing jobs left and right with AI. I'm having a hard time following you on this argument about search, and yet, from what I hear from so many different enterprises right now, they are incorporating generative AI into their daily tasks and slowly but surely perhaps replacing jobs with it.
So if you think about this for just a moment, so relative to programming, I think the argument that you can enhance the work of programmers with AI, that is indisputably true. That is one of the places where this thing still really does work. To me, the core question that we have to ask as a society of all technology businesses is, in a world where you have real problems like climate change, like healthcare, like education, is the best stuff that you can do with a product like AI the kind of stuff that OpenAI is demonstrating? You know, I agree with you. There are corporations out there that have absolutely bought into this. Journalists have completely bought into this. And my only point to you here is, before investors completely buy into it, we should just ask the question of, how are they going to get paid? How are you going to get a return on what is effectively $500 million each time you do a training set in
Understood.
a 5% interest rate environment?
Yeah, the costs are enormous to have the large language models, which is why it may only end up being a handful of players who are able to do it, given they have the resources to do it. But well, I guess the final question is, you come back to responsibility. Are you one of those who are concerned overall, though, that the growth of AI will exceed our ability to control it?
Well, David, I'm worried about what AI does today. If you look at the things that preceded large language models, so think about predictive policing and the use of AIs for resume review and mortgage review. In those cases, the lack of care, the lack of incentive alignment resulted in things that were filled with bias that did real world harm. And until we change the incentives of this industry, real world harm is the most likely outcome that we're going to get. And I look at it and just go, it just doesn't have to be that way. It wouldn't slow it down that much. It wouldn't reduce the opportunity that much to actually require that people exercise due care in the creation of large language models so that you limit harm. And that's all I'm suggesting. And in my mind, that is the most important thing to do now. But right now, if you will, the mania that's going on here, and I think it really is a mania because journalism, politicians, and corporations have all embraced this stuff without thinking through the lessons we've already learned from recent technologies that basically have the same roots.
Yeah, we thought we had our hands full with moderating online content, Roger. This is a much bigger bowl of issues to deal with. We'll talk more about it, of course, in the days and weeks to come. Roger McNamee, thanks.
My pleasure.
Meantime, mortgage rates coming off their biggest weekly gain since February. More on what investors need to know with the CEO of Redfin after the break.
This is not an inflation story. It's not something to be afraid of when I think the Fed is figuring out what to do. This is a story about 15 years of underbuilding in this country. There's a huge supply-demand imbalance.
That was Toll Brothers CEO Doug Yearley, underscoring how that 15 years of underbuilding in the U.S. has created a massive supply and demand problem. And new Case-Shiller data out today showing home prices were up in March, driven by tight supply. This, of course, comes as mortgage rates continue to push higher. The average rate on the 30-year fixed, it jumped to 7.14%. That was as of Friday. Let's get more on the health of the housing market. We turn to Redfin CEO Glenn Kelman for that. Glenn, always good to have you. Inventory problems, sort of number one, is that, or inventory, lack of inventory, the number one issue right now in housing?
It's number one, number two, and number three. So not only do we not have enough new construction because of political gridlock and financing challenges, but we also don't have anyone putting their home on the market just because they have a 30-year fixed rate below 3%. So nobody wants to sell a home right now, and there are still plenty of people who want to move.
So what changes that? What will be the change agent here, so to speak?
Well, I think we're going to be on hold until rates come down. 7% rates aren't that bad historically, but it's been such a steep rate increase that many people have very low mortgage rates and very long to go on those mortgages. So they're going to hold out until rates come down a little bit. Most people couldn't buy the house that they bought 2 or 3 years ago. So it's unthinkable for them to move up. We've seen a slight uptick over the weekend in listing demand. Some people are coming out for the summer, but it's well below where we would expect to see at this point in the season.
So with all these forces, Glenn, what's happening with prices? They're clearly not coming down as fast as the Fed wanted them to.
Yes, we've been pretty pessimistic about sales volume. We think it'll be around 4.2 million units when normally you see around 5 million, but we're pretty sticky on price. Prices are going to stay fairly high. It's going to be a real affordability crisis for the millennial generation. Many people want to move, and they just can't do it because prices aren't going to come down in this housing market correction. It's the weirdest housing market correction I've ever seen.
Are they coming down faster than rent prices? Which is more affordable now, buy or rent?
Neither one is really coming down, but rents are coming down faster than home prices.
Across the country?
Mostly, yes.
What about the migration, Glenn? Has that gone the other way after we saw just such big changes in where people located during COVID?
Not really. If anything, the affordability pressure is still driving people into the center of the country, into the Sun Belt, into the American South. And so that's where we see the strongest demand. And that's where we're still seeing bidding wars. It's so crazy. People are talking on the news about a housing market crisis, but at the same time, a buyer is facing 5 or 6 bids, especially in places like Texas and Florida. So I don't think that's going to stop anytime soon. The one exception in Texas is that Austin is pretty flat.
Yeah, well, also Boise. I mean, a couple of those places that were particularly they benefited from that move do seem to be coming down year over year, right?
Right. Well, these little boom towns that suddenly had 1 million Californians trying to come in and buy up the whole city, those are the ones that have gone up and down like crazy. But even then, I think people have been really rate sensitive in Boise. So if rates come down just a tick, all of a sudden we've got a bunch of buyers in Boise out of the woodwork, and then they'll go back up a tick, and it'll be a very quiet weekend. So even those markets are really rate sensitive right now. Buyers are looking to get in, but they just need a break on rate, and maybe the debt ceiling deal will do it.
This is the least happy I've heard you in a while, Glenn. So how do you?
Oh no, you know what? I just have bronchitis.
Oh, okay.
Okay,
that explains it. Okay, I thought maybe it was the market getting you down. How do you grow your business in this kind of environment? We've all seen the stock collapse from the 2021 levels. Yeah. How are you pivoting?
Well, we're pretty proud of the fact that we've come back from about $3 a share up to 9 or 10. I haven't checked this morning. Oh, you've got it on the chart. Thank you.
Yeah, $9.
We paid down our debts.
It was
our website is
100
taking
in 21.
visitors from its major rivals. We've got a higher share of demand than ever before. We just have to execute against it. So I'm actually pretty bullish right now on Redfin in the second half. We've promised investors that we're going to break even this year. And if we can do that in a down market, we're going to make so much money. in a good market.
There you go. There's the enthusiasm we've come to
Oh,
expect.
sorry. Yeah.
No, that's okay. I'm sorry that
Feel
you're not
better,
feeling
Glenn.
well, Glenn, but appreciate you taking time. Get better soon. Thank you.
Great to see you guys. Bye.
Thanks, Ben. Coming up at the top of the hour, we'll speak with the National Economic Council Deputy Director Bharat Ramamurthy about the debt deal. Find out what the White House thinks it's going to do for this economy. Should we see that both sides have the votes? We also need to find that out to finalize this agreement before June 5th. That's the new Treasury X date. Don't go anywhere. We're back in just a moment. Dow's down 100 points. S&P still positive.
Voter control.
Theranos founder Elizabeth Holmes is due to report to prison today to begin her 11-year sentence for defrauding investors. She was convicted of wire fraud and conspiracy. She's appealed that conviction, but a judge ruled her appeal is unlikely to succeed and ordered her to report to prison by 2 p.m. today. The Bureau of Prisons hasn't said which facility she will be assigned to, although she's expected to surrender to a minimum security prison in Bryan, Texas, where we have live cameras. Don't be looking for something maybe this afternoon, David.
Carl, real quick, wanted to get to something we've been following closely for quite some time. That's Microsoft's attempts to continue to buy Activision. There's a hearing going on in the UK. Remember, Microsoft is appealing that ruling from the CMA that said, nope, no go. We think you're going to have too much dominance in the cloud market. And apparently the hearing is going fairly well for Microsoft in terms of at least the judge kind of moving things along to trial quicker than had been anticipated and saying certain things in terms of the CMA and his expectations there. So you can see Activision is responding positively to that. Remember, we've termed it mostly dead, but you never know. Kind of like the Princess Bride. All right, that's it for this part of Squawk on the Street. We've got another hour coming your way right after this.
Good Tuesday morning. I'm Carl Quintanilla with Sarah Eisen live on the floor of the New York Stock Exchange. Setting the agenda today, NEC Deputy Director Bharat Ramamurthy with a debt limit deal reached in agreement. Will it pass the House and the Senate?
The former chairman of S&P's sovereign ratings group, John Chambers, is with us. He led the downgrade of U.S. debt back in 2011. Could we see another downgrade ahead?
Later on, Citi's chief economist in the U.S., Andrew Hollenhorst, on a Fed pause in peril and at least maybe one more rate hike this year.
Taking a look at stocks, the tech rally continues to power this market. You see that in the strength of the Nasdaq, up 0.6%. Nvidia at the $1 trillion market cap mark, up again sharply this morning. S&P 500, it's up a little more than 0.1%. We're seeing some strength in other groups like financials ticking into the green, but overall, Dow down 120. Carl, somewhat of a relief, I guess, at least a relief rally in the bond market for the Treasury deal, although in the equity market, it wasn't really scared of the deal not happening. Everyone always just said it's going to be an 11th hour deal. Question now is, does it hurt the economy? And most of the economists out, JP Morgan, Goldman Sachs, say not so much, at least when it comes to the impact of spending, because we're going to pretty much keep the spending flat over the little 2023 levels.
Your point in the last hour was hard to get a relief rally when there was really no discomfort
exactly.
Going into the situation over the weekend. That said, oil below 70, and it has not been able to hold above that. The VIX closer to 17 than 18. That consumer confidence number didn't really instill any notion that the consumer is just raring to go here.
No, and we've gotten that from the retail earnings as well, coming off of a week where it was kind of mixed signals on the consumer. A lot's riding on the next two reports. We've got jobs on Friday, and there's another almost 200,000 jobs expected. That wage number is going to be key for a Fed that's fighting inflation. And then an inflation number as well, all before the June meeting, where there's increasing expectation that the Fed is going to go in June, is going to raise
And if not in
rates.
June, then July is definitely in play, they say.
That's the skip, not the pause scenario.
Right.
But all of that, the market taking it well. If you look at least, and Mike Santoli would say this, at the major averages, which are largely driven by tech right now.
Let's get to the debt ceiling first, though. The president and the speaker, as you know, with that tentative deal over the weekend. But the drama far from over. Kayla Tausche has the latest. Morning again, Kayla.
Good morning, Carl. President Biden and Speaker McCarthy now in full-on sell mode to try to shore up the 218 votes needed to pass what's being called the Fiscal Responsibility Act in the House. They each briefed their party over the weekend. The House Rules Committee is set to meet later today around 3 p.m. to advance the bill, though two Republicans have said they're against it and they can afford to lose no more than two, leading to questions about how McCarthy would respond if that did happen. The House would then be expected to vote after that. The Senate would begin its proceedings after it passes the House. But some members in the Senate have vowed to slow walk the deal. We will see if that drags out into the weekend. Asked about the chorus of criticism, President Biden said any skeptics should talk to him directly, and he said he's optimistic about the deal's prospects.
I feel very good about it. I've spoken to a number of the members. I spoke to McConnell. I spoke to a whole bunch of people, and it feels good.
Mitch McConnell, of course, the top Senate Republican, has vowed to get his colleagues to support anything that can pass the House. House Republican leadership has pledged around 150 votes, with Democrats expected to provide around 70 votes. But members today, as they study the bill, could begin shifting their views. We've already seen some out on Twitter weighing in against the deal. We'll see if more come and whether that tips the scales. Carl and Sarah.
I know, I've been watching the Twitter nose, especially on some of the lawmakers. Kayla, anyone surprising? Anyone significant from a leadership perspective against it?
Well, I think that one of the most surprising no's that I've seen this morning is Nancy Mace, a moderate from South Carolina. She said that the bill essentially sells out the U.S. economy and future generations by keeping spending levels high, and that she's a no. She is someone who, would have expected to be a quiet yes. Many of the yeses are not parading out and proud of their votes because it is a compromise, because it is something that, was designed to make both parties happy and perhaps make the more extreme wings of each party angry. But certainly there have been some that have been surprising. And I think as we see Congress back in session today and reporters on the Hill with microphones in their faces, we could see more of that. Although, there is still a very, very active campaign to get those yes votes and get them in line and get enough of them to cross the finish line.
Kayla, going to be a busy week, even though it's a shortened one. Kayla Tauscher this morning in Washington. Of course, even if a bill is signed by the 11th hour, that doesn't take a credit downgrade off the table necessarily. In 2011, as you may know by now, S&P issued theirs after a deal had already been reached. Joining us this morning, one of the key figures behind that downgrade, former Sovereign Rating Committee Chair for S&P, John Chambers, is here with us at Post 9. John, it's great to have you. Thank you,
Carl.
That's been said a lot lately. But I think your take is if this does get passed, maybe we can not talk about downgrades?
Well, first of all, I would say that the fact that we had this debate and we're still 1 week out and we haven't passed a bill yet, and if we don't pass a bill, we might default, validates Standard & Poor's decision in 2011 to lower the rating. It's simply not consistent to have a AAA rating and a prospect in a week that it's going to run out of cash and not pay its debt. So on that front, I think Standard & Poor's having a AA+ rating on the U.S. is entirely warranted.
You feel vindicated by that call back then?
Yeah, I agree. Now, it's very welcome that we have a bill, and but of course, if we don't pass this bill, you're going to have a default. You're going to have mass turmoil in the markets. You're going to have even if you have sequestration of ordinary payments, it's going to lead to a recession, and that's a very bad outcome. In terms of downgrades, you've got Standard & Poor's at AA+, Moody's at AAA with a stable outlook. So they're indicating that the rating is not likely to go down. Fitch last week put the AAA rating on their scale on CreditWatch negative. And there you have a possibility that they might cut the rating like we did in 2011.
Even with a deal signed?
Even with a deal signed.
And that would ostensibly be because of the structure that we currently have regarding budget and debt ceilings?
I think that their analysis was similar to ours back then. You have two major problems. One is the fractiousness of the political environment. The fact that we had a coup d'etat, a failed coup d'etat 2 years ago certainly would be an indication of that. And the second is the debt trajectory. Even with this deal, if it gets passed, the debt burden, the amount of government debt as a share of economic output is going to continue to rise. And although that in itself is not a problem now, you need a medium-term fiscal correction, because otherwise you're going to use up your ammunition when you do enter into a recession or you have some sort of major problem to face, like a war or something like that. You want to have some dry powder ready for eventualities.
I'll just play the other side, John, as I've done over the years with you on this, and that is, both the politics, which agree, it's not ideal, but ultimately we end up reaching an 11th hour deal and we avert default. And then the long-term debt trajectory, neither of that changes the creditworthiness of U.S. government debt right now, does it?
Well, debt, your capacity to pay debt is in part in function of how much debt you have outstanding. The more debt you have outstanding, the more difficulty you might have rolling it over, the more difficulty you might have in servicing it. That's what the rating speaks to, and it's not the only factor that goes into a rating, but it's an important factor.
But the market hasn't shown evidence of any trouble servicing the debt.
Well, it does, and if you look at the credit default swaps, if you look at where the June bill is trading versus the July bill, there's a fair amount of dislocation in the market. Credit default swaps for the U.S. trade worse than a dozen other nations.
But that should come down. That should narrow now, right, after the deal, and if it gets passed?
It'll narrow, but it won't be eliminated. I think that the United States will permanently face a few basis points higher interest costs on its debt for a risk premium. And when you have a stock of debt of $31 trillion, a few basis points is a lot of money.
Where do you think the debt needs to go on a dollar basis to start talking about more stabilization in ratings over the long term?
Well, ratings or no ratings, what you want to have is a stable debt to GDP. And to get that, generally, depending on other factors, but generally you need to have your budget in balance before interest payments. So you're looking at a deficit of 2 or 3% of GDP as opposed to the 6 or 7% of GDP that we have now.
And in your view, would that require us to address spending outside of non-defense discretionary?
It's going to require not only addressing spending, but you're going to have to raise taxes. As far as I can see, the only way you're going to get there is taxes that would at least cover half of the difference.
And that is tax rates, not necessarily addressing the tax gap through additional IRS agents or something else?
It's in my experience, enforcing greater tax compliance can get you a few basis points of GDP of extra revenue, but it's not going to be able to get you all the way there.
John, what's it been like being the guy that downgraded the U.S. AAA rated debt? I read an article that you had to hire security because you had death threats.
Number one, it was a committee decision, but after the decision, I got death threats and I had a bodyguard, and it wasn't very pleasant. But that was then, and now I'm retired, and so I live in serenity.
Good for you.
John, your institutional knowledge really helps us out at this particular moment, so thank you for sharing it.
Well, thank you for having me on the show.
Good to have you.
Thanks,
John Chambers.
Still to come, the White House's response to a possible debt ceiling deal, what it means for the economy. The Deputy Director of National Economic Council is with us live from Washington.
Plus, forget about a pause. SETI says the Fed is hiking 2 more times before the end of the year. Their chief U.S. economist will join us when we're back in a couple of moments with the Dow down 130.
Free consultation.
Welcome back. Wall Street continues to get more bullish on the market and on earnings. Last week, we heard from Citigroup and Bank of America, Citi lifting U.S. equities to neutral, B of A hiking its earnings target. Today, it's RBC raising its year-end S&P target to 4,250 from 4,100. Let's bring in CNBC senior markets commentator Mike Santoli. A little chasing going on, Mike.
Yeah, so there's no doubt that there's chasing going on in the parts of the market that have been performing best. So that's actual money chasing. And here I think it's an adjustment of sell-side predictions that are really just allowing the first quarter earnings beats to run through their models. And then the economy really not softening up as much as most had anticipated. Even with this target raise at RBC, more or less getting it to where the market is trading right now. The median sell side target for the S&P 500, I believe, is still below 4,200, which is where the market is hovering at the moment. So it shows you that we've had this reservoir of skepticism that the market has been able to feed off of. There's a case being made, and I know Citi is making this case, that corporate earnings could be a bit more resilient even to an economic slowdown than they had been in times past, whether it's because of inflation is still in the system and they're able to keep pricing, or simply because of the mix of companies that are contributing the most to the earnings of the overall index.
Yeah, Mike, I'm thinking back to the B of A note. Savita's report title was "Don't Be So Negative on Corporate America."
Yeah.
And I assume that points to the adjustments they've made in the way of expenses in the past, say, 6 to 8 months. But it makes me wonder where we'd be if, in fact, the China recovery had been more robust, or at least as robust as some thought it would be at the beginning of the year.
Yeah, it's definitely a good question, and there's even some downscaling of how excited people are about other parts of the world, like Europe. You might actually be looking at kind of a break-even year in terms of overall earnings. Now, there's a lot of year left. It's a little while before we're going to start trading on what still seem to be potentially enthusiastic 2024 earnings. But it does show you that this has been an unusual cycle just because of the level of nominal economic activity in the system. The credit markets have remained relatively accommodating. There's been some anxiety running through there a bit, but big companies are not really at the whims of the parts of the financing markets that have been under stress right now. So far, it's kind of a muddle through type scenario. And I think the market in a way reflects that. It's certainly not cheap, but it's way less overvalued if earnings are just flattening out rather than set to fall off a cliff, as many thought coming into the year.
We'll see what the 198 school says later on. Mike, see you soon. Mike Santoli. So with strong sentiment on the street, strong data on jobs and inflation, a debt ceiling deal, regional bank stress that seems to be abating, is the market wrong in thinking that the Fed is set to pause in June? Our next guest says maybe, predicting a pair of 25 basis point hikes on the horizon, one in June and perhaps another in July. Joining us here at Post 9 is Citi's chief U.S. economist, Andrew Hollenhorst. It's great to have you. Welcome. Thanks.
Yeah, thanks very much.
Have we checked all the boxes, do you think?
I think that's pretty much the full list of what's led markets to start to price this in. Actually, if you look at that pricing for June, we have about 14, 15 basis points priced in of a 25 basis point hike. So I think markets are coming around to this view, too.
What happens to those who were counting on M2 collapsing and lots of disinflation traction? Are those not factors anymore?
Yeah, so you're seeing some of this liquidity drain, and that's actually going to be kind of amped up by what's going on with the debt ceiling being resolved. You're actually going to get a lot of issuance from the Treasury, a lot of liquidity drained out of the system. So that's another thing that's happening. But in terms of the inflation numbers themselves, if you look at core PCE last week, on the year-on-year basis, we actually moved up to 4.7. So there's a real sense that this inflation is proving sticky.
Is that why you always were at 2 rate hikes? Because you were like way out of consensus when the market was expecting a pause in cuts.
Yeah, what we do is really try to forecast out the data, just like you're saying, look at where inflation is going to come in, and then try to understand what can the Fed do in that situation. And this is a Fed, I think is very important. This is a Fed that is regaining credibility after inflation overshot. So they're really trying to show that they're responding to higher inflation, and that's probably part of what's going to push them to hike in June.
But do you not sympathize with the view that they could pause now and just continue to see what the impact is going to be of 500 basis points of tightening, which is a lot in a very short time period, as we're getting toward the end of the fiscal stimulus, as we're getting toward this massive issuance of Treasury, a lot of still questions. Regional banks, yes, it's abated, but we don't really know what's happening there.
Yeah, a lot of moving parts like you're going through. And
I can make an argument on both sides.
Yeah,
really.
and that is a reason that, as you get to this kind of final stage of the rate hike cycle, you might want to be more careful and kind of think about this as fine-tuning where you are. The issue, I think, really comes back to communication. If the Fed doesn't hike in June, even if they say that's a skip, we're not hiking in June, but we may hike again in July, we may hike again down the road, does the market interpret that as a skip? Or does the market just say, that's a pause, that's the end of the rate hike cycle, and now we're looking for you to cut rates, bringing interest rates lower, and actually re-stimulating the economy? If you looked at house prices this morning, house prices were up. That's an issue for the Fed.
It makes me wonder whether or not the chair, when he said that tweak to guidance was, quote, meaningful, if he wishes he could maybe have that back. Or maybe not. What do you think?
Yeah, I think what the Fed has been trying to do in all their communications over the last month or so is just keep all options open. They really want maximal optionality here. Like Sarah was talking about, you don't know how much the economy is going to slow by, so you want to respond. But then when you look at the data keeps exceeding expectations on both growth and inflation.
As for the notion that excess savings are getting whittled down, right, and that there's this, eventually the consumer will end up having to face reality, some argue that that might also get pushed back because the job market is so rewarding. Does that make sense?
Yeah, it does make sense. And I think we've all been surprised at how powerful that force from excess savings has been. You see consumers that continue to spend out of those excess savings. But now you layer on top of that we've had a very strong jobs market month after month. If you're adding 200,000 jobs a month, that's a slower number than where we were a few months ago. But that's still putting a lot of income into the economy, and that's still driving that consumer spending.
Andrew, we'll see what happens later in the month. Good to have you. Thanks.
Thanks very much.
As we've been talking about all morning, debt ceiling bill set to work its way through Congress now. Joining us live from the White House to break it down is National Economic Council Deputy Director Bharat Ramamurthy. It's good to have you back on. So does anyone like this deal? The Republicans are complaining it doesn't go far enough with spending cuts. Democrats are complaining that they caved on work requirements and to other Republican demands. What's your take?
Well, I think it's usually a sign of a good compromise if there are some folks who are a little bit unhappy on each side. But I think ultimately what we have here is a good, fair deal that reflects the realities of the divided government situation that we have. A deal that, number one, takes the possibility of default off the table through 2025 and protects our economy from the possible recession that could have occurred if there was a default. A deal that protects Social Security, protects Medicare, protects Medicaid, important priorities for the president. And number three, all of those signature pieces of legislation that the president passed in his first 2 years in office, the Inflation Reduction Act, the CHIPS bill, the infrastructure package, all of that is protected as well. All those important investments will continue to flow into the economy. So overall, we think that this is a very good deal and something that we would like Congress to pass well in advance of the June 5th deadline.
Does it impact the economy at all?
Well, look, I think overall what you have is a roughly maintaining the level of spending that we had in the last fiscal year. I think the macroeconomic impact of this deal is likely to be fairly minimal. As your last guest was highlighting, really what's driving the economy right now is an incredibly strong job market, 3.4% unemployment, wages going up across the spectrum, especially for those at the lower end of the income spectrum. And when the American consumer is strong, the American economy tends to be strong too.
Bharat, we just had John Chambers, who back in the day was part of that S&P downgrade in 2011, who argued that in order to get escape velocity from this constant rotating series of crises regarding the debt ceiling, you have to address taxes, and taxes have to go up. Who's going to let that happen on their watch?
Well, look, Democrats successfully imposed some new taxes on very large corporations just in the last 2 years. A 15% minimum tax so that no company that's making billions of dollars in profits can get away with paying $0 in federal corporate income tax. That just went into place last year. So I'm not that negative on the possibility of getting these taxes into place. The president's budget calls for the very wealthy and big corporations to pay their fair share. Historically, when Democrats are in office, they're able to get those targeted taxes into place, and I remain optimistic that we can do it going forward as well.
Do you think the compromises being made regarding the funding of IRS agents is going to significantly impact compliance for the worse?
Well, what the IRS and the Treasury Department are saying is that the nature of how this funding was shifted, because it was shifted towards the back end of the budget window, means that in the short term, the IRS can continue full speed ahead on all of the improvements it was making thanks to that funding infusion it got last year. Remember, part of that is enforcing our existing tax laws, making sure that people can't get away with evading their tax obligations. Another big part of it is just improving the quality of service at the IRS, and we've already seen some of the benefits of that in the short term. Some of the data the IRS has put out has shown that refunds are getting out the door quicker. People who are calling the IRS with questions are getting their calls answered much faster than before. It's important of just making government work well for the people who are funding it.
You know, one of the other risks to think about here, Bharat, is, and it's one that you raised yourself in previous interviews with us, is the precedent that this sets now. Every time you have, let's say, a Democratic president, Republican House, or vice versa, the negotiation, the fact that, you know, you're holding a gun to the economy's head trying to prevent default. What other demands can be exacted the next time around? Is it going to go into abortion? Is it going to go into immigration? Is it going to go into other pretty contentious issues?
Well, look, I think that, as you noted, this only happens with one particular alignment, which is when you have a Republican House and a Democratic president. For whatever reason, House Republicans feel like it's a reasonable thing to do to take the global economy hostage in order to secure whatever partisan aims that they have. But I think what's important to realize in this situation is that nobody thought that default was an acceptable outcome. And once everyone made that agreement, once Speaker McCarthy acknowledged that fact, along with the other congressional leaders, what you really had here was a standard budget negotiation, the kind of thing that happens annually, the kind of thing that happened last year when the president sat down with Democrats and Republicans and got a bipartisan spending bill through Congress at the end of the year. I think if you look at the terms of this agreement, it's really pretty similar to what you would have gotten under any circumstance with a divided government situation. So I think that while that hostage taking was unnecessary, it was irresponsible, it caused some economic harm, at the end of the day, I'm not sure it exacted any additional concessions from our side.
Well, I mean, they did get the work requirements for welfare programs. That was something that you guys were very much against, and they can claim as a victory, for one.
Well, I think it's important to note on that front, yes, they pushed for a slight expansion of work requirements for older workers, those between the ages of 50 and 54. What we did was push for and got in the deal changes so that it's easier for the homeless and for veterans to access those food benefits. So I think some analysis has already found that the net effect of those two changes might actually be a slight expansion of the benefits that are available to people on that program. So I don't view that as a large shift in favor of the conservative viewpoint.
Does the White House have an expectation as to the timing of these votes, and do we think the Senate may bleed into the weekend?
Well, that's going to be up to Speaker McCarthy and Majority Leader Schumer. We defer to them on the timing of all of that. What is clear, based on Secretary Yellen's most recent information, is that we can't go past June 5th. So whatever the exact schedule is, our hope and expectation is that this will be on the president's desk and signed into law in advance of that June 5th deadline.
Finally, you mentioned Treasury, and I wonder when this is all done, hopefully, and taken care of, if we'll go back and revisit, I guess, what some were calling a threat to Treasury's credibility on the timing of these X dates. Is there any reason to think that they were trying to build urgency to help these talks along?
No, absolutely not. I think that is, there's no basis for that claim whatsoever. I know Secretary Yellen diligently was looking at tax receipts and other information, and as soon as she had the information, was updating the Hill on a regular basis from the beginning. She provided a range of possible dates and tried to indicate what the earliest possible date of a default would be, and then as she got more information, provided more specificity. I know that both Democrats and Republicans have acknowledged that she did that in a fair way, and I don't think anybody would question the Secretary's credibility on that front.
And finally, are you confident that you have the support of the House Democrats on this deal?
Just over the weekend, we saw a very large group of House Democrats, the New Dems, I think it's about 90 members or so, come out and say that they were supportive of this agreement. I think at the end of the day, there's going to be support from both the Democratic and Republican side, and I think we're optimistic that this will get through the House, it will get through the Senate, and it will get to the president's desk in advance of June 5th.
Bharat, thank you very much for taking the time today to talk us through it. Appreciate it. Bharat Brahmamurthy from the White House, Deputy NEC Director.
Later on this hour, international opportunities. It's not just Buffett looking at Japan to drive some returns. Nikkei's at a more than 3-decade high. Can that rally last, and how do you buy in?
And we're watching Ford upgraded at Jefferies. Positive on margin expansion there and more efficient execution. Price target goes to $16 a share. Stay with us.
S&P back in the green after briefly going red. Let's get a news update with Bertha Coombs. Hey, Bertha.
Hey, Carl. Here's what's happening at this hour. 9 people were hurt on Monday evening when shots were fired near a crowded beach in Hollywood, Florida. Police say someone pulled out a gun during a fight just before 7 last night and opened fire. The 9 injuries include 6 adults and 3 children. All are in stable condition. One person is in custody, but police are looking for more suspects today. NATO says it will send additional forces to Kosovo following clashes with Serb protesters in the region. At least 300 NATO peacekeepers and 52 protesters were hurt in the violence Monday. Tensions are hitting a boiling point as Albanian mayors take office in the Serbian-majority northern Kosovo after the Serbs boycotted elections in April. And the TSA says its traveler totals over the long holiday weekend surpassed pre-pandemic numbers. Agents screened 9.8 million people at airports across the U.S., which is about 300,000 higher than the same holiday weekend in 2019. Friday was especially busy with 2.74 million travelers, a new post-pandemic single-day record. It was crowded on the roads as well, Sarah. Everybody was getting out.
Yeah, well, Memorial Day weekend. I get that. That's a good sign for the economy. Bertha, thank you. Bertha Coombs. Coming up, Elon Musk and Jamie Dimon are both in Shanghai. What that means for U.S.-China relations next. Stay with us.
At the end of the day.
A mixed session in Europe coming to a close with investors in a bit of a holding pattern, perhaps waiting to see if the debt deal in the U.S. passes. Tech leading today's gains with food and beverage stocks lagging behind. But the story abroad today is China, with both Jamie Dimon and Elon Musk in Shanghai separately at a JP Morgan summit and Tesla production plant, respectively. It's the first trip for Musk to China in over 3 years. Investors weighing whether China is, in fact, open for business. A lot of talk being made, a lot here being made about what it means for China relations, which are the worst in decades, and the fact that business is caught in between with leaders like this making their visits. It's not just the two of them. We've seen leaders of Starbucks and Nike and others. Ralph Lauren, they're investing in China right now at an especially tense time. It does make you wonder, if things do get worse geopolitically, what happens to these businesses?
Or if, in turn, those executives try to replace any kind of diplomatic channel, right, and at least keep tensions from getting worse. We do know that Hang Seng shares were flirting with bear market territory, and China's worried about some of these restrictions, not just from the U.S., but from Japan as well. I mean, they're not the growth story of Asia.
No, and the sentiment has really soured on China and Chinese stocks, not just in Hong Kong. The Chinese yuan, the currency, has weakened, and the Chinese have led it. They set the reference point for where they wanted to trade in a weaker position. Part of that could be the fact that there's an expectation that stimulus is coming in China, but there's a good piece in the Journal this weekend about China, sort of peak China, and we've seen this out of The Economist as well, some structural growth problems coming into play, that it's not the economic miracle that it was in the last few years. They point to youth unemployment. They point to underlying structural issues like the property market and the fact that there is rising debt and the demographics as well.
There's also some weird asymmetry. I mean, you don't see high-profile Chinese executives coming to the United States and meeting with government leaders. And yet here we have Diamond and Musk in Shanghai and Beijing. It's going to get interesting.
Yeah, and you talk to some of these corporate leaders about it, American leaders. They say it's impossible to decouple. We've been investing. Nike's been in there for 40 years. You know, it's clearly a really promising consumer market, and so yeah, we'll see if they can kind of walk the fine line of diplomacy behind closed doors. They certainly lobby the U.S. government on these issues.
Yep. Coming up next, speaking of Japan, the stock market there, as Sarah mentioned, hitting some 3-decade high, with a strategist across the street making the case that that bull market may just be getting started. We'll talk about what's driving the gains and how to play it when you stay with us.
We have more money in terms of equity securities in Japan than in any other country in the world.
That was, of course, Warren Buffett back on Squawk Box in Japan when he was in Japan last month, and he's not the only one who's been bullish lately on Japanese stocks. The Topix and the Nikkei, the major averages there, surging to 30-year highs. Japan is certainly catching Wall Street's attention, too. Bank of America seeing the Topix rising to 2,300 points with a bull case of 2,400. Goldman Sachs expects it to hit 2,200 points by the end of the year, saying they expect the market to benefit from structural changes in that economy. So where might investors look for opportunity? Joining us now is Neuberger Berman Portfolio Manager of Japanese Equities, Kei Okamura. Thank you for joining us, Kei. So despite the already tremendous run-up in Japanese stocks outperforming the world, do you think there's still a good opportunity here?
Hi, Sarah. Thanks for having me. Yes, I do think so. Because if you take a look at where Japan's fundamentals are in terms of the economy, it's in a pretty solid position. Personal consumption's healthy. Inflation is moderate. We've got an accommodative central bank, and then a weak currency. And then, of course, the structural reforms that you just mentioned about earlier. This is something that the Tokyo Stock Exchange launched at the end of March. They basically announced that to over 3,000 companies that they have to get their act together in terms of capital efficiency and trying to improve ROE and ROIC above cost of capital. And this has launched a flurry of share buybacks. And we've just started here. Going into next year, we're going to see some more reforms come through. Next year, we're going to see tax exemptions for Japanese investors investing in this market to be expanded. So I think there's quite a bit more upside to be had in this market.
It's so funny, some of the reasons you listed for why you're bullish are reasons that investors hated Japan forever. Low inflation, they were in this deflationary spiral they could not get out of easing. And a lot of people were worried that the U.S. was following in the same direction. It's interesting how the world has changed, and therefore it's made Japan more appealing. But aren't these long-term problems ultimately for Japan?
Yes, no, I mean, I'm definitely not going to sugarcoat that. These are definitely structural issues that have been very deeply rooted in this market. If you take a look at the most recent, inflation readings, they're up, but, compared to, say, where you are in the U.S. and in Europe, still very moderate. A lot of people have been focusing on rising wages, which has been good. I think it's a positive. And if we want that sort of sustainable growth in inflation, you need that uptick in wages. On the other hand, if you take a look at the Bank of Japan's most recent forecast for 2025 CPI ex fresh food, I think they're reading somewhere around like 1.5, 1.6%. So it still hasn't reached the trend growth line that they see key to sort of move the next step in terms of monetary policy. So I think we still do have ways to go, but in the meantime, it does mean that the Bank of Japan will remain accommodative.
I do wonder, we talked for so long about what that deflationary spiral did to the Japanese consumer mindset. And I wonder if you can talk to how that shifted and whether or not the opportunities there are consumer-centric or not.
Yes, so that is a very important point, and that's something that we look at very closely in our portfolio. And this is something that, Mr. Warren Buffett obviously takes a look at as well. Pricing power, I think, is absolutely crucial in a market like this. If you have, deflationary mindsets that's been well ingrained, how do you continue to raise prices without losing market share? I mean, all of these factors are very important. That's why, going forward, I think it's going to become increasingly important to pick your stocks, make sure that you're invested in companies that have good pricing power and good growth potential as well, and not just in this market but in overseas as well.
So what do U.S. investors do to take advantage? Do you buy multinational American companies that have good sales exposure to Japan? Do you buy the ETFs? What do you recommend?
Oh, no, you should buy Japanese equities for sure. No, I think the best way, as I mentioned earlier, the GDP story in Japan is actually quite solid, I think. Personal spending has been up. But, in the earlier segment, you mentioned about the slowdown in China. I think one of the things that we've noticed is that the growth in other parts of Asia has been relatively strong. So we've seen a good influx of inbound tourists coming back in Japan, and that has been a strong support for spending in this market. So to get exposure to those types of plays, I think it is good to have in your portfolio, companies that have a good exposure to the domestic economy. And then I think, you'd also want to take into consideration the weakness of the currency as well.
All right, Kay, well, appreciate the coming on, pounding the table here for the Japan story. Thank you very much.
You bet. Thank you.
Meantime, NVIDIA topping that $1 trillion market cap this morning. What other AI exposed names may be headed for a breakout? We're going to talk about that when Squawk on the Street returns in a moment. Also, a quick check on Tesla. First peak above the 200-day since September as it's revisited 200, up 21% this month.
Free consultation.
NVIDIA's new entry into the $1 trillion valuation club, just the latest milestone in the AI boom we've seen this year, and that is the focus of today's Tech Check with Deirdre Bosa. Morning, Dee.
So, Carl, we may need a new name or a new moniker for the big tech basket powering broader market gains this year. Fang, it just no longer captures what has been happening in big tech as newcomers to the $1 trillion club like NVIDIA, as you mentioned. They power that new AI revolution. Bernstein suggests this morning the Magnificent Seven. Also notes that if there was ever a year to consider the sell in May maxim, it may be this one. The names in that group, the Magnificent Seven, they are all up between 35 and 180% this year. And in May alone, Alphabet and Amazon, they're up 15% each. NVIDIA nearly 50. So sure, good time to take some money off of the table, but also nobody wants to look like Cathie Wood here, who bailed out of NVIDIA too early. Now, another name getting attention already is Broadcom, which reports earnings this week. It has been called by BofA the most underappreciated AI beneficiary, which I guess in this market, you can call a stock that is up 55% year to date, 27% since that call. Investors, though, they may be expecting another NVIDIA here, like a blowout, and that is a very high bar to achieve. The point, though, guys, is that the first stage of this tech cycle is taking shape with the semis. Everyone is looking for the next names here. NVIDIA, undoubtedly one of them. Could Broadcom be another? Markets are understanding how generative AI gets monetized through those chip innovation and contracts. So the beneficiaries in the next stage, they're not as clear yet. That may happen faster and develop differently than here, which is the mobile internet cycle. The one thing that seems clear now, though, is that data remains king, and the so-called secret sauce that feeds these new models and the companies that have it, they may be considered the next stage winners. And yeah, guys, that is big tech, but there could be some other ones too that are good at really collecting all of that, like the UiPaths, the Databricks, the Snowflakes, which we've talked about.
Yeah, I think C3AI reports earnings this week. So, Deirdre, the buyers of all of the AI chips from NVIDIA, do we know who they are? Because wouldn't they be considered sort of the next wave of beneficiaries here who were early on in the cycle and spending money on it?
That's a good point. And they were the beneficiaries in the mobile cycle as well, right? It's the infrastructure plays, the hyperscalers, the Microsoft, Amazon, AWS. They also have a lot of data, and the Google. So those are considered the next ones. But are they good at crunching that data? Undoubtedly so. But there could be other players. Remember, too, like a Salesforce, they acquired Tableau, which is in data analytics a few years ago. So they're well positioned. But this takes longer, as we showed you in that chart, for the market to recognize. You can make the case that not so, because you've seen a Google, Microsoft, Amazon run up this year. But there could be other players, other finds here, and especially the software side of it, which is the last stage where ChatGPT and Bard sits. There's going to be many, many more of those, a lot of them probably companies that we don't even know of yet.
You know, Dee, good note out of Morgan Stanley this morning, basically saying, look, we know the AI market is doubling quarter on quarter, so everybody's going to be able to say they're a part of that, but they may also, meanwhile, be exposed to traditional refresh, which is going to get crowded out because overall budgets aren't changing all that much.
Yeah, I think it's a good point, because there was a note last week as well that said you can't just slap an AI chatbot onto everything and say that you're part of this revolution. I think what you're getting at, Carl, is maybe the spend to get there as well. We talked a little bit about this too. You need to upgrade your systems, and that's what sort of the cloud companies are having to do. They have to buy more of those NVIDIA chips. So NVIDIA is going to benefit, yes, but costs are going to go up for the players that serve the large language model. So costs increasing on one side also.
Amazing to see NVIDIA surge another 6% on top of the week last week. Thank you, Deirdre. Deirdre Bosa. Wall Street buzzing about a new deal for NBA TV rights. That's ahead. And a quick look at Apple. Shares hitting new 52-week highs moments ago, now up 36% this year. Not in NVIDIA, but outperforming the market for sure. We're back in 2 minutes.
CNBC app.
Wall Street's buzzing about the NBA this morning as some new bidders enter the arena for future media rights. Julia Boorstin joins us, and she has more. So who's in the mix here, Julia?
Well, Sarah, of course, we've all been glued to the playoffs. And as the NBA finals start this week, negotiations for NBA rights over the next decade are heating up. And the stakes here are really high, as pretty much all the other major sports rights are tied up for years. Now, ESPN parent Disney and TNT owner Warner Brothers Discovery are current rights holders, and they are still in a window of exclusive negotiations to renew their contracts that expire in 2025. They're now paying about $2.7 billion a year. Both Disney's Bob Iger and Warner Discovery's David Zaslav have talked about the value they see in the NBA. Meanwhile, streamers Amazon and Apple are both increasingly showing their interest in sports rights and likely to make a move here if they're not tied up already. Amazon has already partnered with the NBA, streaming some of its games in Brazil, while Apple recently brought up the streaming rights to not just baseball, but also soccer. Now, with growing concern about cord cutting, there is increasing attention to the value of live sports to drive viewers. And while the NBA's regular season ratings were flat with last year, ratings for the playoffs are the highest that they've been in years. Now, sources tell me that the league would like to split its rights between at least two companies. And while streaming is expected to be front and center in negotiations, it still reportedly wants distribution on broadcast stations to reach the biggest audience possible. Sarah? Carl?
The playoff ratings have been good, haven't they, Julia?
The playoffs ratings have been good. We're trying to aggregate them now, but by some measures, the highest they've been in 11 years, up about 9% from last year. So and I believe that's just for the ones on some of the channels. So we're trying to get all of those final numbers, but definitely an increase in the playoffs. And notable that the ratings were flat from last year in the regular season, even though there has been cord cutting since then.
Meantime, Julia, some discussion about Little Mermaid, whether or not it was soft internationally. I noticed Truist did trim their Disney target back to 105 today.
Yeah, Truist did trim their Disney target. They still do have a buy rating on the stock. The thing with these family films is it's not like a superhero movie that has that sort of teenage 20-something audience. These family films are designed to hold up over the long run, so we'll see how it does next weekend.
I was too busy with Succession. Julia, thank you. Julia Boorstin. It was amazing.
Yeah.
They stuck the landing, 10 out of 10.
I know.
How was Barry?
It's all anyone can talk about.
Well, yeah, except for you.
In the meantime, we'll get HP tonight. We'll maybe more on AI and the PC refresh. Let's get to the judge of the half.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The heavily hyped AI trade, whether there are signs of bubble trouble as NVIDIA tops $1 trillion in market cap. We'll discuss and debate with the investment committee. Joining me for the hour today, Carrie Firestone, Josh Brown, Joe Terranova, Steve Weiss. Let's check the markets here. Do have a mixed day for stocks. The Dow Industrials are down by 120. S&P is good for about 6.5. The action in the Nasdaq, though, no big shock there. 2/3 of 1%. We said NVIDIA hits $1 trillion in market cap. First chip stock ever to get there. There's the gain of nearly 81 points. So that's our top story. And related to that is really our top story 1A, and that is Josh Brown, who has been a holder and fan and supporter of NVIDIA for as long as, frankly, we can all remember. And now you've used this gain to take some profits of some degree. You've sold a quarter of your position, is what you told our producers. Is that correct?
Yeah, this morning it gapped higher, and I took the opportunity to just take something off the table because, man, this is one for the ages. And I didn't want to sit here in a reversal and not have done something.
Refresh, our memories, if you could, on how long you've owned this stock. And do you remember when you first bought it and what the first price you paid for it was?
I don't remember the exact price, but it's like I bought it in the summer of 2015, and I remember coming on the show, we were in New Jersey, and said something to the effect, Netflix was struggling at that time, and I said maybe we ought to replace the N with NVIDIA. And, I've believed in the stock ever since then, and it's thousands of percentage points, obviously. I read this weekend that NVIDIA, over the last 10 years, prior to my getting involved, was the #1 performing stock, up 10,000%. So this is like just you could live your whole life and never see a stock do what NVIDIA has just done ever again, and we may not. So it's been a historic run. But I want to talk about some of the shorter term dynamics here, because I'm still a believer in NVIDIA. I still think they are the best positioned technology company in the world for what's to come. But this stock hit an 86 RSI this morning. It was at 83 on Friday. And I remember, and I think we have this chart, or I'm not sure if we were able to make it, but I just remember saying to myself, when was the last time NVIDIA was this overbought? I mean, this is a stock that's rallied before. And it turns out you have to go back to November of 2021, which was the peak of the tech bubble, where it traded at 89 RSI. If you go back to 2011, it hit 91. That was the highest ever. And NVIDIA's max RSI during the dot-com bubble a generation ago was 81. So you're talking about just a historic level of being overbought. And if you look at the 3-month, 6-month, and 1-year return after that 2011 peak in relative strength, it was -2%, -40%, and -42%. If you look at the November 2021, when RSI peaked last time, 3.6 and 1-year return was 3.6 and 1-year return -37%, -37%. So now basically you have arguably the best stock in the world, but it's 46% above its 50-day moving average. That's the 6th highest reading ever. And you just have to say to yourself, how likely is it for there to be strong gains in the very short term from here? It's not impossible, but the likelihood of a reversal grows. And so I just want to do what I think is prudent, take some risk off the table, obviously taking off my initial investment entirely, and, just be in a situation where if there is that reversal, I'm not as exposed as I was last week.
Got you. What obviously is so interesting about the current state of the market, the current state of buying into AI-related stocks, and then watching NVIDIA, Weiss, which was $300 in the moments before it reported earnings, which, we forget was, 10 days ago? Not even, it feels like. Where there's a bit of a seller in Josh in terms of taking some profits. You're a new buyer.
Yep.
On the close last Thursday, is that right?
Yep.
Take us through that thought process, because that is as intriguing to me as Josh's taking some profits is.
Well, clearly, I don't think there's ever been a more momentum-driven market than what we're in right now. And that momentum is confined, and that by and large, to 7 companies, of which NVIDIA, as Josh points out, is the #1 in all of that. So I thought that, look, I was hoping stock would miss and collapse, and then I'd take a fresh look at it for a full position rather than a trading position, which is what I put on. So, Scott, I'd like to tell you I was waiting for it to hit a valuation of 200 times earnings, but that's not it. It was purely playing momentum. I added to it Friday morning before the market opened, and I'm not going to be here for a long time. I mean, frankly, if Josh were a better salesperson, I would have gotten into it earlier. So kudos to him. I mean, it's just so rare to be able to identify a company like this and to buy it and to stay with it. And the story has changed somewhat. The fundamentals, in a good way, fundamentals have gotten a lot better.
Yeah, you remember it was like like a video game play, right?
Yeah.
And then it was a crypto play.
And then it was a data room play,
Bitcoin.
right? And then, but I'll tell you, I have lots of meetings, as you know, every day. Just got off another one with an AI company. There is no competitor there. It's not AMD. It's not Intel for sure. NVIDIA owns the market.
AMD's another new 52-week high today.
Exactly.
I mean, as these
kudos
stocks,
to
as
Joe.
the group continue to run.
Right. Kudos for Joe. But I still think the best AI play, bar none, is Microsoft, because it's a recurring revenue model. You're going to have to buy a full new suite of products, full upgrade, and they'll survive, and it's a lot less expensive. So look, I'll be in NVIDIA till I'm not. I wasn't happy to hear, frankly, that Dr. Death bought it last week as well, because when you have people that start violating their value discipline to this degree,
Didn't you kind of Didn't you kind of do that in your own sort of
Yes
way?
and no. Yes and no. I'm not purely a value player.
I know, but this sounds like so not
But
you
I always
lately.
I always have a speculative part of the portfolio that I can play in, and I've said that from beginnings. 13 years I've been in the show. This is the speculative part of the portfolio. It's not a big enough position where it's really going to inform the rest of my performance, but I've also got to be able to identify psychology, and I've got to be able to identify markets and where I can be wrong. So I've been wrong here. Look, if it goes up a lot, I'm not going to make a ton of dough. If it goes down a lot, I'm not going to lose a lot of money. But I thought there was good momentum. The first hint of a reversal, I'm gone. So I don't have stops on it right now because of the volatility. I could be taken out and then miss it up another 10% the next day. But I'm glad to see that Josh is staying there for 3 quarters. The fundamentals are there. But, since time began, chip companies have not been able to keep their competitive edge for a long period of time. And you've got tremendous motivation from all the other companies that buy their chips to put another chip company in business to compete with them. So they don't have a stranglehold on technology and innovation. Right now they do, but that will not endure.
What do you want to say at this moment about your committee members, one of whom, made one move on the line and the other one made another move on the other side of the line?
Josh is making an excellent risk management move. That's exactly
without question.
That's exactly what you're supposed to do when you see such a dramatic appreciation in a stock. So I don't think we're calling into question right now the overall AI thesis. Look, we're not even at the point yet where we've seen an increase in the IPOs. And that's when it gets bubblicious.
You
right?
can't call into, so you don't, aren't we kind of calling into question, though, whether this valuation is justified, given the move again?
Let me respond to that, because in the near term, you might be correct, but longer term as an overall thesis, right? When you see the avalanche of AI IPOs, and we're not seeing that at all so far in 2023, then it's getting to the point where it is bubblicious. Now, in the interim, is the valuation exceeding a comfort level? Without question. And what's driving it? A lot of what's been going on in the last couple of days is mandated buying. So I mentioned last week the Momentum Fund, MTUM, which is the largest momentum fund, the ETF globally. Guess what? NVIDIA has finally been added into MTUM in the last 3 days. So you're seeing a lot of that mandated buying. Can you imagine being a growth manager and not owning NVIDIA in your portfolio as you move towards the end of the month? So NVIDIA has to be back within that portfolio. And I think that's a lot of what's going on right now.
Well, Cathie Wood is a growth manager, right? And she doesn't own it anymore. And she tweeted yesterday in terms of, why she doesn't anymore. She had a great win with it for a long period of time, but she's been out since January. She tweeted yesterday, among other things, investors seem to think NVIDIA is the only AI play. It is not. The second tweet she has at the end says, at 25 times expected revenue for this year, however, NVIDIA is priced ahead of the curve. Now, to that point, NVIDIA is 25 times forward sales versus 6 times for the SOX.
All right, let's just say we missed it. I wish we'd have the humility to just say we missed it.
No, she sells her winners and buys her losers.
Yeah, but
that's a strategy.
There are times you have to have the humility to say that, I missed it. And NVIDIA has the absolute lead over everyone else. You mentioned AMD. I still have a half position in AMD. I'm looking for the exit in AMD at some point, because the gains that I've been able since early May to acquire in this chip company, you can't be greedy with that. You have to take
just
profits.
one more point on Josh's.
I got to get to
on
Kerry,
Josh's
too.
point. Just one point.
Yeah.
Josh didn't sell NVIDIA. He still believes in the fundamentals. What Josh sold, he sold the stock that, and I remember very clearly when he bought it, because I thought I was a freaking hero. I bought the stock in the 30s. I sold it at 78. I was really long the options, and Josh was buying it then. So I thought, hey, man, I've got more than a double and a quintuple on my options. But he was agnostic to the name of the company that he sold. He sold the stock that's had a meteoric rise, and kudos to him for knowing when to shave some of it off.
So, Kerry, how do you view this? You obviously don't own NVIDIA, but you have exposure across the AI spectrum, whether it's the Microsofts, the Metas, the Alphabets, some now throw Apple and Amazon into that mix too.
Yeah, exactly. I think what Josh is doing, first of all, is correct. If you own a stock that's had that kind of move, I mean, it's phenomenal, and I think it's great for the people who own it. But you have to take some of that profit off the table. I mean, it's just an extreme case of enthusiasm across the board for AI and for NVIDIA in particular. As I said last week, it's the poster child for this whole new category that everybody is jumping on. You know, they can't come up with enough ways to use generative AI in describing their products. I would say that in the last 5 trading days, there's been $450 billion of incremental value added to the top tech names in the S&P 500. And, you know, they are now up 33%. If you look at the market, it's up 10% for the year, but the rest of the market, if you take out 8 names, is essentially flat. And that's telling you something about the market. Either it's too narrow and it must broaden out, or it's too narrow and it's going to remain narrow, and maybe that's precarious. So what I think is the best way to think about this market is that if we don't have a recession, and it appears more likely that we will not have a recession, that earnings will start to grow more than expected, because we're trading at, you know, big number, 19 plus times current year and 17 plus times next year's earnings. We need that number to just, you know, come down. I know the top names pull it up, but we'd like to see a broadening of this market, and you need that for more enthusiasm about earnings for the entire market.
Of course, at some point, I suppose. I mean, Joe mentions the MTUM ETF. The other one that has AI as a part of it is the LRNZ. That's the Technology, AI, and Deep Learning ETF, which, by the way, is up 20% month to date, on pace for its best month since the inception, which was March of 2020. Within that, Datadog, you know, Joe still has half of his position there. That's up 38% month to date. Okta's up 30% month to date. AMD is up 42%. Joe, as you know, at least at this point, I hope, has sold half his position, but he still maintains half. CrowdStrike's up 31% month to date. And then there's Schrodinger, which is up 19%. But wait, there's more, Josh, right? Because you sold out completely, I think, of this name, right?
Yes. I bought Schrodinger before the earnings. It immediately fell because that's what always happens to me. I added a little bit to it. And then during this whole AI mania, the stock ran up 25%. And I just said, if I'm trying to cool off my portfolio from all the AI mania, then I'm probably better off just walking away from that one, taking the profit, and reevaluating in general. Look, I think what Steve said is right. It's very unlikely for there to be any technology company, especially in semiconductors, that maintains 100% market share or 80 or 90% market share. It's not that it never happens. It's that it happens so rarely historically that it would be kind of crazy to make a huge bet on that continuing to be the case. So in the short term, it's probably true that nobody can touch NVIDIA's market position, their platform, their products, their lead in this space. That's probably true. The thing is, there's going to come a time where it's not true, and there are going to be all sorts of things that happen along the way that spook the stock price. I wrote a blog post last night, 5 things that could knock NVIDIA down. First on the list is any credible evidence that China is about to do something with respect to Taiwan. Think about how important Taiwan is for the whole semi space, for everything really, but for tech and semis in particular. They don't even have to do anything. It could just be a report, and you could see 10% come out of any chip stock overnight. Like, these are the types of things that happen, and the risk is not lower as stocks rally. It appears to be lower, but it's actually higher. NVIDIA's enterprise value to earnings metrics are in the triple digits. EV to EBITDA right now, 148. EV to free cash flow on NVIDIA is 187. The PE is 214. The price to sales is 40. Now, the bulls would say, and I am a bull, the bulls would say, oh, no, actually, the stock just got cheaper based on guidance for Q2. Okay, possibly, but it's also possible that Q2 represents this massive pull forward, and we don't see follow through necessarily in Q3 guidance, in Q4 guidance. So It's just being realistic. Now, think about tech in general. 16% of the XLK ETF holdings are hitting 52-week highs right now. That's the highest reading since January. 72% of the XLK names are above their 200-day moving average. That's the highest since right before SVB. The median relative strength, RSI, in the XLK is 61. The median relative strength for the rest of the S&P 500 is 42. So take Schrodinger, take AI, C3 AI, whatever that is. Take all of the names that are getting caught up into this and just say to yourself, how much longer can this really go on for without a scare in the market? I don't think there's going to be a lot of room left, unfortunately, just because of how stretched some of these relative strength indicators are.
So on that point, which is a good one, Carrie, of your Microsoft, your Meta, your Apple, for those who are watching today, wherever they may be watching, and they hear somebody who's been as bullish on a name like NVIDIA and Josh have been linked as long as we can remember, are now questioning to themselves, should I take some chips off the table in some of these names that seemingly keep hitting new 52-week highs by the day?
Yeah.
What's your own decision? What's your thought process, as a well-skilled fund manager who has to make these kinds of decisions?
Yeah, so the way we would look at it is the following. What's the weight that we've assigned to these names? And in the places that we're overweight, so if we're overweight Google, we're overweight Amazon, we're overweight Meta. Not overweight Apple and Microsoft because very few people are. But we say, are we at a point with those names where we're overweight, where we feel it's too much of the portfolio? We're really putting too many chips on their back. And we decided no, but we're watching. We're watching to see where they go. Because, for example, Google sells for market multiple. Alphabet's a market multiple, and next year it's 17 times earnings. We don't have a problem owning it. The same is true for Meta. I mean, Microsoft is a little more expensive. Apple is more expensive, and Amazon, is more expensive. So we have tried to be careful about the prices that we're going to own those stocks at, but they're not close to the NVIDIA valuation. And, and at times like this, maybe valuation doesn't matter or PE doesn't matter. It's just about growth and the perception of growth. But at a certain point, you have to really face reality, and it will matter.
So, by the way, we see a note, I think that just dropped. Bank of America bumps the price target of NVIDIA up to $500. That's 23%. From current levels. Now, you recall that the day after earnings, there were what felt like 40 price target bumps, some of which were, I think, as high as $600 and whatnot. Joe, what do you want to say?
I wonder how much of all of this is really there's nowhere else to go with your money right now in the market, and where positioning has been completely offsides throughout the year. So think about this. Josh mentions technology, the amount of companies that are near a 52-week high. Month to date, technology is up 10%. You have communication services up and consumer discretionary both up about 4%. Energy's down 8%. Materials, industrials, utilities down 6%. Healthcare down 5%. Real estate 4%. Financials 3%. That cyclical trade is completely blown up.
So to
it's
that
not
point,
working.
Good. I'm glad you went there because I wanted to segue there anyway and come back to you. Small caps are underperforming large caps by the most since '97. Okay, the spread between the S&P 500 and the S&P equal weight is the widest since '99.
Yep.
That sort of answers to your point. Like, there's nowhere else to go. Where are you going to go in a still highly uncertain macro environment? Where?
A money market fund? I mean, that's literally your only alternative at this point. There's nothing competitively
better than most sectors
within the equity market that can deliver the type of revenue growth that you're seeing these technology companies deliver. And positioning is so incredibly important. I remain overweight energy. It's the asset that I look at most during the course of the day because I know it's struggling with such significant underperformance. And there are so many others that are in the same position that I am right now as well.
I look at the world a different way. There's nothing wrong with the way Carrie looks at it, nothing wrong with the way Joe looks at it, but overweight, underweight just isn't my lexicon of investing, okay? I'm strictly an absolute investor. I'm not looking to figure out what's going to outperform the Infotech sub-index of the S&P.
No, but you could be representative.
Can I make money?
Yes, but you could be representative of the same thought process by virtue of, well, it's a trading position or it's a bigger position. Right? I mean, you're sort of talking
not really.
kind of about the same
I'm not looking to
thing.
see.
I mean,
no, because
you're not taking a huge position in
difference
NVIDIA.
Is they're looking at an opportunity set. Here are the 10 names in the index. I'm going to bet on the 1 or 2 that can outperform, and that's what I'm going to show to my investors. That's what they look for. Very legitimate, very real. I'm not criticizing it. I just look at it differently, and I don't want anybody to think that just because I bought a trading position in NVIDIA and that I bought some Microsoft that I've changed my view. I'm still negative on the market. It bears me out. So for every NVIDIA that you have a Deere, which, has gotten crushed. So I'm still negative. I don't believe that a recession is less likely, as Carrie says, and I believe the risk in the market has moved higher. Take a look at Adobe, what Adobe's done. They don't report on June 15th. I have no idea if the quarter's going to be good or bad, but the stock's up nearly 100 points from the low, up nearly 35%. So all you have to do is a CEO come out and say AI, okay, whether it means artificial intelligence or autonomous ink, and it's going to go higher. That's what's happening. That's what the froth that Josh is talking about and why he's pairing.
All right, so let's do this. Let's sneak in a quick break, because on the other side, we're going to document 2 more moves that Josh Brown has made. We'll wait until the other side to give you more details about that. We'll do it next. All right, we're back. We have these other moves we want to document from Josh Brown. So let's do this, Josh. Newmont Mining, you sold. I mean, metals in mining has just not worked. So take us through this one first before we get to number 2.
Yeah, I'm a little bit mad at my cast members and even you, Scott. You guys should have talked me out of this when I put the trade on. I've been on the show for 11 years.
My material.
Weiss wasn't on that day, obviously, or he probably would have.
Yeah, I would have come at you hard, Joe.
Why did you let me? Why did you let me do this? It's it's the opposite of me. I don't screw with gold. This is so stupid. Gold hit the lowest level since March 20th. It was a sucker's rally above 2,000 an ounce. I should have known it. This is not my area, so I got stopped out of Newmont. It's not terrible, but it's a failed thesis. The dollar got stronger, gold got weaker, the debt ceiling thing didn't turn into a firebomb, and the trade just didn't work. And by the way, I've been saying this for 11 years on the show, and I should have remembered that I always say this. These are just not good companies, like the gold miners in general. They're not particularly run well. I know some of the biggest gold bulls in the world, and they tell you never buy the equities. If you like gold, buy gold. And I just violated so much about myself that I sold it last week, and then I crouched down in the shower and I cried a little. And I'm not going to do it again. And if I do it again, please say something.
Okay. Well,
this is not what I do. It's not my core strength.
Maybe your fellow Long Islander and pal Josh Brown should have said something to you to just buy the GLD.
Yeah.
Right? You still own the GLD, right?
I do, and that's the obvious mistake.
That wouldn't have worked either.
Well, Newmont's down in the last 52 weeks, 38%. The GLD is actually up 5%. So far, year to date, the GLD is up 7.5%. Newmont's down 13%. So if you want to buy gold, whatever your thesis is on gold.
Do you still want to buy gold now?
And I agree. Gold is in the middle of a pullback, so no, I don't want to buy gold right here.
Will you sell your GLD?
I'll maintain my position. We'll see what happens at the quarterly rebalance. If I see anything within the precious metal space that will lead me to exit the position, I'm more inclined right now to exit the position than I am to enter into the position, in particular because interest rates are beginning to rise. The thesis around owning gold, the precious metal, is the disinflationary velocity, and we saw that at the end of March, and that's why everyone was clamoring to buy it. So I think it just falls back to owning the precious metal relative to owning the miners, which Josh has said they're awful.
So the other stock that you sold out of, Josh, is SWX, Southwest Gas.
Yeah, well, this is another one where the story changed. So when I originally got involved with it, Carl Icahn was fighting with the company for board seats. He ended up getting what he wanted. They sold off the piece of the business that Icahn felt was superfluous. I think they got a good price for it. And now they are preparing to do a spin-off of the other business, and they want to become a pure regulated utility with a higher yield, I guess. The thing is that's going to take place over the course of the whole year. And in the meanwhile, the largest shareholder, Carl Icahn, is kind of in a fight for his professional life right now. And I don't think particularly focused on whether or not he should maybe take this company private, which is something that he was talking about doing last year. So the story changed. A lot of the catalysts happened. The stock didn't perform. So it's another situation where, look, not everything you do works. Not every idea you have plays out the way you think it will. And this is one of them. So I'm out. And I'm more liquid now for whatever comes next.
Okay. Let's get the headlines now with Bertha Coombs. Hi, Bertha.
Hey, Scott, here's what's happening. Prosecutors are urging a federal judge to deny a request by FTX founder Sam Bankman-Fried to dismiss criminal charges accusing him of stealing billions of dollars from customers. In early May, the former cryptocurrency billionaire filed a motion asking the judge to dismiss most of the 13 counts against him, saying prosecutors charged him in a rush to judgment in 2022. But in a late filing Monday night, prosecutors described his efforts as meritless. The judge will hear oral arguments in the case on June 15th. North Korea plans to launch its first military spy satellite in June. The country says the satellite is crucial for monitoring the United States military exercises with South Korea. The statement came a day after North Korea notified Japan's Coast Guard that the launch may affect nearby waters between May 31st and June 11th. And new data from China shows urban unemployment for those 16 to 24 hit a record of more than 20% in April, 4 times the broader unemployment rate in that country. And economists estimate that at least a quarter of college graduates are underemployed in low-paying jobs below their skill levels. The contrast here, Scott, youth unemployment in April here was 6.5%. Back to you.
Okay, Bertha, thank you. That's Bertha Coombs. Up next, 3 bullish calls of the day, including a best-in-class mention for one EV stock. Those shares are popping. There's our mystery chart. We're back to reveal it next.
Minimums.
All right, calls of the day now. We told you we have a few. Number one, ChargePoint upgraded to a buy at Bank of America. The target, though, gets lowered to $14 from $15.50. You can see it's a bit shy of 10 now. They say it's a best-in-class way to play EV charging. Josh, you still own this?
I do. I'm in a pretty big drawdown with this stock. It's one of these names that I bought, during the mania in 2021, and I didn't really risk manage the position. So I'm there. I've added to it at lower prices than my original purchase. It's basically a company that didn't pivot early enough to what investors were looking for, which is positive free cash flow. I understand why they decided not to. Just to catch people up, this is EV charging. They're not putting up like retail charging stations. What they're doing is fleet charging, and they're putting chargers at hotel chains and Starbucks and McDonald's, et cetera, so that those parking lots are equipped. And they're also doing an app for people that have an electric vehicle and they just want to be able to charge anywhere they go. So I think the decision to just keep building, not worry about going profitable, they have the cash. I guess I understand it, but the market doesn't care about stocks like this right now. At some point, they will go profitable. Probably not this year, maybe the end of next year. But that's what the analyst is talking about at Bank of America. They think it's a best-in-class way to play EV in general. And I thought that was true 2 years ago, but it just hasn't played out that way. So we'll see what happens.
So, Kerry, PayPal reiterated buy at Mizuho. Price target's 92. The stock's been disappointing, to say the least, right? It's down 16% year to date. So what's your take on this call?
Well, I think that the call is confusing because he's suggesting the stock's going to be up 50%, but then he also says buy on weakness. I mean, how much weaker can it possibly be? I mean, the stock is down from 400. And, we think it's inexpensive, but I've said that many times on this show. It trades for what would be, if you believe the earnings, 12 times this year's earnings, 10.5 times next year's earnings. So the market doesn't believe the E. The market thinks that they're going to have to bring the numbers down. But it would still be an inexpensive stock. It's a value trade. And I would think activists are going to start to show up. So to us, PayPal is inexpensive. It's attractively priced, but it hasn't worked yet. So I hope it works on this call. Thank you, anyone on Wall Street.
Okay. Johnson & Johnson resumed buy at Citi. Joe, you own it in the T, right? In the Joe T?
I do.
What do you, they raised the price target, buy rating, and 185.
So basically the spinoff of Kenvue, which is the Tylenol parent, there's optimism that they could build some momentum surrounding that. That's the essence of this note. That's just not the case. There is no momentum right now in J&J. It's part of an overall extremely complicated story for the healthcare sector. I think you're going to see significant turnover within the healthcare sector. And right now, it's the medical devices and Eli Lilly where investors want to be in the healthcare space. Otherwise, some very critical decisions surrounding ownership of healthcare are ahead in the coming weeks and months.
All righty. Up next, Mike Santoli joins us with his midday word. We're back on the half right after this.
$85.55.
We're back. Our senior markets commentator, Mike Santoli, joining us with his midday word. I think we figured it was just a matter of time before NVIDIA joined the $1 trillion club.
Yes.
Here it is. And it is causing some people to sort of reassess where they are in that name, like our very own Josh Brown.
Yeah, and there's not a huge sample size here. I guess 7 stocks ever have hit that. And, you know, it's funny. There's an old trading rule of thumb that stocks that get to 90 get to 100. Maybe it's stocks that get to a $900 billion market cap at least test out $1 trillion. I don't think any has gotten to, even well above 800 without testing it. At this point now, Meta was above it and fell well below, so is Tesla. The others are still there in the zone. Now, it is obviously a time to reassess, and I think it's very interesting, the swirl of psychology around it, because there's a sense of looking at the chart and saying, I missed it, it's a mini mania, there's something wild going on, and yet also a forced compulsion to participate. So nobody seems happy about,
my man right here.
Or participate in the overall theme.
Forced to participate, even in a small degree, but nonetheless.
Right. So anything that looks like it can justify what NVIDIA just reported as that revenue guide for the entire sector, but it's a localized kind of mini buying panic is the way I would put it. That's why the bubble talk's funny to me. If this is a bubble and Microsoft's a huge player and the stock is not yet where it traded a year and a half ago, before we were talking about AI, it's not a bubble yet if it's going to become one. It could be something out of hand. You know, EOG Resources, okay, the energy company, it like quadrupled in a year and a half to the high. Nobody talked about it being a bubble. It can happen. Stocks can get ahead of themselves. They can get overpriced. The risk reward can be bad without it being a bubble.
Yeah. All right. I'll see you in a couple. It's Mike Santoli. We'll see him later, of course, on Closing Bell. Still ahead, the Salesforce setup. That stock hitting a fresh 52-week high today as it gears up for its own earnings. We'll find out how our traders are positioned on that. We'll do it next.
Grade my trade. Send us your latest stock move, and the investment committee will debate it and grade it. Email us at askhalftime@cnbc.com or tweet us, #GradeMyTrade. Happening.
All right, we're back. Let's talk some earnings that are coming over the next few days. Salesforce tomorrow, new 52-week high, highest level since March of 2022. Carrie, you own Salesforce. What's your expectation here?
Yeah. as long as they sound positive about the remainder of the year. I mean, $1.62 is the number. It's not going to be that exciting of a quarter. The last quarter showed a lot of potential. They also talked a ton about cost cutting and making sure that they rationalized the whole, base of the employees, and they talked about weakness that they've experienced in big new accounts, but that could be coming to an end. So we really think that the number is going to look good as we go over the next few quarters, as long as they sound positive. And say AI several times on the call. We think that investors are probably going to feel good about what they're hearing. The stock can continue to go higher. It's still far from its all-time high.
I know, but I can't help but think as you're saying all this, well, as long as they say AI a million times on the call, that's great. I mean, we've come to that. That's really what we've come to for these stocks.
No, of course not. Of course not. No. I'm kidding about that. And this is a stock that traded at a multiple in the high 50s. And that multiple came down into the 20s. I mean, it's had a run, but it's still not anywhere near many of their peers in software. And they continue to put up good numbers. We think that it's going to be a good quarter. I mean, we really do think that this is a quarter, and for the rest of the year, they're going to have good numbers. And we applaud what they've been doing, and we think Mark Benioff is, back in charge and doing the right things.
CrowdStrike is tomorrow after the bell, too. Josh Brown, give me the first take on that.
Street's looking for 51 cents, I think. This is a stock that went down 60% in 2022. This year, it's up over 40%, rallying again today. It's a high beta, high valuation name that worked against it last year. This year, people don't care as much. I get what Carrie's saying. She's probably only half kidding, because the reality is, if the CEO of a tech company doesn't say AI 5 times in the prepared remarks, you already know where the analyst Q&A is going immediately following. So look, this is a company that's been integrating AI since before it was cool. That's the basis behind how Falcon works. The idea with CrowdStrike is the more companies join the network to be protected by it, the more an incursion on one company can immediately be solved for everyone else. So it works almost like a neural network. And so it is AI. I don't know if they'll get the credit for that, but I think the earnings will be good.
So, Joe, when we talked about CrowdStrike, which is also yours the other day, and we were mentioning the divergence in the gain from Palo Alto relative to CrowdStrike, you were almost apologetic in owning this stock. You said you missed it. You wished you chose the wrong one. Those are kind of the words you used. This stock's done really well. What's your thought process going into the earnings report?
So the stock has had a technical breakout over the last 3 weeks. We show. My comments were more in regard to selling out of Palo Alto way too soon, which I did. I was in Palo Alto many years ago. I think very few people on CNBC had mentioned it like I did. As it relates to CrowdStrike, they are generative AI, and they rolled out today the assistant, Charlotte AI, which a lot of companies have this assistant. That assistant, you'll be able to ask the simplest question: how vulnerable are my applications? And Charlotte AI will provide the answers and the solutions. So it's real when you talk about CrowdStrike and you identify it as a company that will be a leader in cybersecurity generative AI.
Okay. Grade My Trade is up next. We'll see you in 2 minutes. All right, grade my trade. Carrie, you're up first, okay? From Jeff. Home Depot is almost 16% of my portfolio, says Jeff. Should I trim a few shares and put the proceeds into Pfizer or AbbVie? What do you think?
Well, Jeff, 16% is too heavy a weight, and I think, yes, you should definitely trim that position just for the weight. I mean, the stock is down 30% from December of 2021. I think that it's going to have a tough couple of quarters because the renovation home rental market is a little weak. The macro environment for that type of spending is weak. On the other hand, it's forming a base, and I think the stock is still attractive over the long term. In terms of AbbVie or Pfizer, I don't think those stocks look great right here either. So definitely trim some of the Home Depot and perhaps look for some other opportunities, or even 4.5% in the money market fund is good right now.
Okay, Joey from Daniel bought Lockheed Martin at 462. What to do?
Down a little bit. The stock has been down. The stock's down about 15% on the debt ceiling negotiations since early April. We know there's a strong fundamental thesis surrounding defense, both domestically and globally. We know that these companies are going to participate in the growth of defense spending. I think what you do with Lockheed Martin here, Daniel, is you ensure that you protect the downside. And a lot of the ways that you can protect the downside just don't come in the form of price, but also understanding now you have a resolution to the debt ceiling debate, right? So you should have favorable price action. If that is absent, that is a critical indicator that the trade itself is going to see further deterioration. So I think the risk management on the downside is what Daniel needs to prioritize.
Okay, Weiss, quickly with you. Dan on Bank of America bought it at $29.32. Do I keep buying? What do you think?
I think you've got time. Look, you still have an inverted yield curve. The IPO market, which is the fat part of fees, I don't think, and according to bankers I talked to, isn't going to open for a year. So, look, is the stock cheap? Absolutely. Are there any catalysts or fundamentals to really make it move substantially higher and buck what I see as the market trend lower? Absolutely not. So I'd hold it. Excellent management. Can't say enough about Moynihan. But, you know, he's got to deal with the cards he's dealt. They're just not great cards.
All right. We'll take a quick break. We'll come back. We'll do final trades next.
Skechers Slip-ins.
All right, we're talking NVIDIA and market strategy today on Closing Bell at 3 o'clock. We just booked Stacy Rasgon. He's one of the top chip analysts on the street. Bryn Talkington's going to join us as well. She owns those shares, so we'll find out what she's doing. If she tempted to take some profits like Josh Brown did, she'll let us know later on. Adam Parker used to be a chip analyst, by the way, and he'll join us too. Talk some market strategy there along with Lauren Goodwin. I'll see all of you at 3 o'clock Eastern time. Carrie Firestone, final trade, please.
S&P Global, this is a company that peaked in late 2021. This had a long time to recover, starting to form a base. We think issuance will begin to come up if the economy strengthens. It's very good for S&P.
All right, good stuff. Thank you. Josh Brown.
Oracle, this stock remains a breakout in progress. Very involved in AI. I like it still.
Weiss.
6-month T-bill is almost a 5.5 yield, tax advantaged. That's what I'm buying.
Joey T.
A few weeks ago, bought EQT, had about a 10% gain in it. Let's protect the downside. 32.50 is going to be a stop if it keeps moving lower.
All right, good stuff. Thanks, everybody. I'll see you a little bit later on Closing Bell. The exchanges now.
Thank you, Scott, and welcome to The Exchange. I'm Kelly Evans, and here's what's ahead. A tentative debt deal has been reached, but it's not a done deal yet. We look at the hurdles that remain and how it could impact banks, inflation, and the Fed. If it does pass, is a rate pause out of the question? Our market guest weighs in with the one trade he's eyeing right now, regardless of which way the Fed goes in June. Plus, there's an item in the debt deal that could be especially problematic for consumers and the economy. That's especially true given the timing. Mark Zandi is here to explain why he's worried. And shares of Coinbase are rallying on an upgrade this morning. Bitcoin hitting its highest level since the beginning of May. Seems like crypto has some momentum again, but one of our guests is not buying into the hype. He tells us what he's buying instead. Before all that, though, let's start with today's markets. And you see the Dow is still negative by about 128 points, or 1/3% decline. More importantly, the S&P 500 up 3.5 points, but staying above this 4,200 level, closing there at the end of last week, really gave people a lot of confidence in the idea that this rally could be sustained for some time. The Nasdaq leading the way again today with about 0.5% gain. That's helped by a nearly 4% pop in NVIDIA, which pushed the stock not only to all-time highs, but into that $1 trillion market cap zone, 405, about $1 above that $1 trillion level. Again, this is just more people piling into the trade, makes it the first U.S. chip maker to ever hit that $1 trillion milestone. Tesla is also one of the top gainers in the S&P, and it comes as Elon Musk heads to China for the first time in 3 years. 3.5% gain in Tesla to just shy of $200 a share today. And we have to point out what's happening with crude. WTI down more than 4% right now, dipping back below $70 a barrel at this moment. We're pretty much just sitting here at session lows, as you can see, into the close. This amid uncertainty over the debt deal and OPEC talks. WTI is down 9% this month, on pace for its worst month since September. So a little bit of a fly in the ointment of the risk-on trade, or perhaps just a sign that supply can come back online. But we begin with the latest on that debt deal. The bill could face a tough path in the House if GOP opposition grows. Eamon Javers live in Washington with the latest. Hi, Eamon.
Hey there, Kelly. It's beginning to look a lot like getting a deal done was the easy part. Now the challenge is getting the votes to pass the debt ceiling bill on Capitol Hill. We just heard from the conservative House Freedom Caucus a few moments ago, where some members are expressing dismay over the terms of the deal Speaker McCarthy negotiated with President Biden.
This deal fails completely. And that's why these members and others will be absolutely opposed to the deal, and we will do everything in our power to stop it and end it now.
Now, that tees up a possibly tense moment later on this afternoon, with the House Rules Committee expected to meet at 3 p.m. to begin to move this legislation. That panel is controlled by Republicans by a 9-4 margin. So if 3 Republicans on the panel vote against the rule allowing the bill to move forward, that could kill the deal unless the panel's Democrats also vote to pass it. So that could present a challenge here for the Speaker, who's working with an extremely thin majority overall. The entire Republican conference is expected to meet this evening to discuss the deal, and the bill moves to the House floor as early as tomorrow if all goes well there. Now, because President Biden backs the deal, most Democrats are expected to support it as well. But there have been complaints from some House liberals that the deal gives away too much to Republicans. So it's not exactly clear yet how many votes Biden is going to be able to muster to pass his deal either. So challenges for Democratic and Republican leadership here, Kelly.
Would you say at this time, Eamon, that they are mostly kind of expected or anticipated challenges, or at what point does this start to kind of cloud the prospect of really getting it done?
Yeah, well, I think we're going to have a good picture of that at 3 o'clock when we see the House Rules Committee meet. We'll see if they're able to iron that out. I think if they do that at 3, then you'll have a good sense that this thing is on a glide path to passing in the House of Representatives. If there's any squirrely moments there, then you look at this House Republican Conference meeting this evening and see if there's like sort of open rebellion in the ranks. That could give you a sense of if there's really a problem or not. So far, no indications that this is not going to pass, right? But just something to watch as we go through the afternoon.
Yeah, great point. Eamon, thank you. We appreciate it. Eamon Javers. Some have worried the debt deal could spark more bank outflows, higher interest rates, and a more hawkish Fed. But my next guests say the agreement will be good news for the markets. Joining me now are Evan Brown, portfolio manager and head of multi-asset strategy at UBS, and James Pethokoukis, economic policy analyst at AEI and a CNBC contributor. Welcome to you both. Jimmy, I'll just start with you. Not that I normally ask you for, your S&P price targets or anything, but do you broadly think that this will be taken in stride as a good thing for markets and that it should be?
I think absolutely. Certainly major banks are assuming there's going to be deal. The kind of people who advise major banks assume there's going to be deal. So if there was not going to be a deal, I think we would already be seeing it. As Eamon, I like Eamon's phrase, squirrely moments. We haven't seen those squirrely moments. The people who you would kind of expect to be bad-mouthing this deal are. So that's not shocking. And again, I think, if everything goes smoothly at this Rules Committee meeting later, again, a very positive sign that really supports the kind of confidence you're seeing on Wall Street right now.
Jimmy, why is it, and I've pointed this out before, but so a decade ago when we had the fight, we had half the debt to GDP that we currently have. Interest rates were way lower. I mean, why were we so obsessed with it back then? And suddenly this time around, it's like, no big deal.
Well, I think, right. I think broadly people are thinking about the debt a little bit differently. It doesn't that the fact that we've had much higher debt to GDP ratios, but yet we still had low interest rates. I think has helped support the idea that perhaps we have a greater sort of runway on our debt than we thought previously. Listen, the economy after the pandemic, we expected the debt to go up. That has happened, and I think just among voters, there just isn't the sort of concern that we saw previously, whether that's right or wrong.
Yeah. So, Evan, I thought you also made the point kind of pushing back against some of the narratives going around that, okay, a deal isn't necessarily going to be a bad thing. People have been concerned, okay, this is going to trigger more, because again, people who want to put their money in government money market funds have been waiting for this to happen. So the idea is, okay, we're going to start to drain reserves out of the banking system again, or deposits. Why do you think that concern is overblown?
Yeah, this idea that liquidity is going to be drained from the system is, we certainly think is overblown for a few reasons. So first, there's plenty of reserves in the banking system. So even though you're going to see some decline in reserves, the overall level is fine. Second, Janet Yellen is no rookie with this stuff. She understands that the way the financial system works, and she's not going to issue tons of T-bills into the market without having an idea of financial market functioning. And then finally, there's just not that strong a causal link between the reserves in the system and what happens to risk assets. Banks don't need as many reserves to drive buying stocks or lending out to consumers or businesses.
So do you think that the system is going to be, at all tested in the next coming months, or do you think that that whole experience is largely behind us?
I think we'll see some draining of liquidity, but it's not going to be this major thing that a lot of people are calling for. Another point is that so much of the liquidity is from money market funds who are invested in the Fed's overnight repo facility. So it's just money coming out of there and into bills. So the actual decline in reserves on the banking system just won't be that much. So I think a lot of this is overblown.
So let me then kind of close with a quick comment from each of you on the outlook for the months to come. Jimmy, it's kind of widely assumed that based on leading indicators and the rest of it, we're going to tip into a recession at some point, maybe in 3 to 6 months' time. I don't know exactly when. What would you say about that assumption based on the way markets are trading and the fact that we seem to keep climbing this wall of worry and, coming out the other side?
Yeah. Oh, yeah. It really is sort of a classic situation where you're climbing a wall of worry right into a downturn. Listen, I think the case for a downturn remains intact. You could even make the case the longer it takes to happen, the more severe it will be. But I think those financial indicators and stressors are there, and that would still be my expectation.
That the financial stress is meaning that we're going to still have this broader downturn.
Yes. And to be sure, I think things are fragile enough that if there was a last, because the expectations are we're going to get a deal, no deal. I mean, I think that's the kind of shock we absolutely don't need right now.
Right, Evan. Though, are there other shocks that you're worried about, and what do you think about the business cycle at this point?
Yeah, look, I mean, the Fed will keep tightening. That looks quite likely now that we're past this debt ceiling deal. But they're tightening in large part because growth is fine, right? Yes, we see some leading indicators weakening, but we also see the housing market looking like it's bottoming. We're also seeing some of the internals of ISM manufacturing also inflect higher. So as much as these leading indicators have been decelerating, that's been happening for a long time, and now we're actually seeing some tentative green shoots. So overall, we think it's a decent environment over the next few months for the market.
Do you think the labor market just stays, doing what it's doing? Or it was interesting, even in the Conference Board index this morning, the household assessment of labor markets had dropped substantially. So it seems like households are telling us something.
If we could look at only one print, it would probably be initial jobless claims and then also continuing jobless claims. And initial jobless claims, after rising for a little bit, have really stabilized over the last couple of months. Continuing jobless claims are coming down. So, we should expect some labor market softening, and that's what we're seeing when you look at payrolls. But it's so slow. It's such a slow slowdown in the economy that there's just no indication that we're going to fall off a cliff.
All right, we'll leave it there. Gentlemen, thank you both for your time today. Evan Brown of UBS and James Pethokoukis. Zeroing in now on the banks in particular, my next guest says even with one more rate hike, bank balance sheets are adjusting, and the regionals are so beaten down that they're a buy here, especially if you play it through the KRE Regional Bank ETF. Joining me now is Mark Avalone, president of Potomac Wealth Advisors. Mark, it's good to see you. Welcome.
Good to be here.
Maybe that should feel like a safe call, but it still feels like going out on a limb a little bit because the banking system can just be its own animal. And what gives you the confidence to say, especially buying, an ETF with exposure, that, this is safe treading here?
Well, it's not an easy trade, and it's not today run out and buy this. It's the reality that it's down significantly off its peak, and it was largely because of an asset liability mismanagement and pricing of bonds on SVB's bank balance sheet. Every day that goes forward where rates have stabilized and they're even a little lower off their highs, every day bonds in a bank portfolio mature closer to par. So the thought that there's continued deterioration if we have stable rates is unfounded. And if rates start to drip down a little, and we think the Fed is at or around the last of its rate hikes, we think the balance sheet of banks in the financial system is going to improve. And investors have overreacted. It's understandable. But you want to go where the value is. And I would rather be in a beaten down sector that was sold off on emotion than one that's being bid up on a lot of hype and promise and is overvalued by historical standards.
Meaning defense, aerospace, industrials, areas we've talked to you about before that you like. So what do you think is going on with tech stocks or NVIDIA or the AI boom? I mean, however you want to describe it.
Well, I've always said we never abandoned the tech trade, and I'm glad we didn't. But that was mostly because we thought in a slowing growth environment, investors would want tech. Frankly, I little underestimated the impact of this AI frenzy, as did a lot of people. So at this point, we're not getting out of tech, even though we feel it's fully run up and is vulnerable, but we're not allocating new money. I think it's a long-term investment to be in these big mega cap names. If you try to time them too much, look, you could have missed a great move from NVIDIA if you had gotten out when it was near $100 a share just a few months ago. So they moved too far, too fast, but I wouldn't back up the truck and build a balanced portfolio around an area just because it's the hottest sector.
And why, just kind of going back to circle in on your point about the regional banks, why not, pick name by name, maybe a name that has been a strong performer, you have, some personal knowledge of, as opposed to the ETF where, there's a lot in there for better or for worse?
I thought you were going to ask that, and I came up with the answer that unless I'm reading the bank's reports they're filing with the Fed, and I'm combing through every annual report and doing the asset liability analysis myself, and I know about the commercial loan portfolio and what's under the hood, I am going to diversify that single bank risk away. One other thing I didn't mention on a positive on regional banks is they do not own a significant amount on a relative basis of commercial real estate. So I don't think their loan books are perilous relative to some other banks, more concerned about some smaller banks with higher percentage of real estate commercial loans. So I think in general, the balance sheets of these banks are strong. They're going to improve. And I would rather have a diversified basket of them as opposed to one bank that might give me an unpleasant surprise.
He had the answer ready to go. It makes a lot of sense from that point of view. Mark, thanks for your time today. It's good to see you. Wait, by the way, before I let you go, just a parting comment. 4,200 on the S&P. We've cleared the debt ceiling and all the rest of it. What do you tell people about simply the next move for the equity market? And is it a move that is fundamentally justified to you or just a momentum kind of play?
I think if we're talking in early next year, people will be glad they stayed in the market. But if they think it's going to be without a bumpy ride, whether it's getting this trade deal, this debt deal approved, if it's an earnings disappointment, remember this market multiple is inflated, and it's inflated because it's expecting earnings to deliver. So I think if we work through a few quarters of that, I think investors, if they sit tight till next year, are going to be pleased they did and should consider expanding exposure to stocks on any pullback or weakness.
All right, Mark Avallone, a pleasure. Thanks for your time.
Good to be here.
From Potomac Wealth Advisors. Coming up, if the debt deal passes, some 20 million student loan borrowers will need to resume paying about $250 a month. Some say the typical is more like $400. Anyway, starting late August. One of my next guests says that timing could spell trouble. He will tell us why next. Plus, Coinbase rallying today on the back of an upgrade, but one of our guests not buying it. He tells us why ahead. And as we head to break, here's a look at the markets. As mentioned, we've got a totally different picture depending on where you look. You can see the Dow, now the S&P has turned negative by a point, 4204. The Russell 2000s are down 0.5% today. The Nasdaq up a similar amount. The 10-year yield just a hair below 370. The exchange is back after this.
This is The Exchange on CNBC.
8555.
Welcome back to The Exchange. Federal student loan payments have been paused for more than 3 years. But as part of the debt ceiling agreement reached over the weekend, borrowers will likely have to resume making payments again in late August. And with recession concerns looming, our next guest says the move couldn't come at a worse time. Let's bring in Mark Zandi. He's chief economist at Moody's Analytics. Mark, it's good to see you. And I feel that every time we say the word recession, people are just going to be screaming at the TV saying, it's not here. Where is it? Everything's fine. Articulate the concerns that you have and about the timing of these repayments.
Sure, and Kelly, just to be on board, above board, I don't think a recession is going to happen, and I don't think the student loan payments are going to be the thing that pushes us in. But they're a weight. It's about 20 million student loan borrowers. They haven't been paying. They'll have to begin paying more or less in September. By my calculations, $250 a month, might be a little bit more, about $5 billion in increased payments per month. So you do a little bit of arithmetic, that'll shave a couple tenths of a percent off of GDP. Now, over the coming year. Now, in a more typical time, that's not really that big a deal. The economy can digest that gracefully. But in the current environment, with the economy as weak as it is, recession risks as high as they are, a couple tenths of a percent, can matter. But I don't think that this is what's going to push us in. But it's certainly a weight at a pretty significantly inopportune time.
I think there's also some people who have to restart those payments going, what was the point? It's nice to have the freed up capital for that period of time. But, 3 years of, let's say, $250 or for whatever the payment is. I mean, a lot of people would have finished paying off those loans had the payments kept going. And now it's like, OK, now I face just having to draw this out for another 3 years' time, and maybe I'm trying to buy a house, and those costs per month are also sky high. So it's probably going to leave a very sour taste.
Well, yeah, I mean, no one wants to start. They weren't paying, now they're going to pay. But at the end of the day, that was their decision, right? They could have still kept on paying. I would suspect most people understood that this was a temporary moratorium on payments because of the pandemic. Go back to the middle of the pandemic, people couldn't get to work. The labor markets were disrupted. It was pretty dark time. This was an effort to help alleviate the pressure on a group of people that are generally younger. They generally are lower income if they have any income, and this makes life a little bit easier for them. But you're right. I mean, here we are, 3 years later, and they're going to have to resume making those payments. And I suspect for a fair share of them, they might not be able to make it, right? Because my guess is they've mostly adjusted their spending to the more cash they had. Now that cash is going away, so they're going to have to face some hard choices here. What do I do? Do I stop paying on my credit card? Am I late on my rent payment? It's just going to increase, the kind of juggling that people are going to have to do. But back in the day, I think they looked at it as a very positive thing, not a negative thing.
We've even heard analysts, downgrade or be cautious about, gym memberships and the like if people say, okay, I have to cut something and what is that something going to be? So it could have more of a micro impact or be felt more in some places than others. And I think there was this hope that maybe something would magically, because the Biden administration talked a lot about this, about trying to, waive those payments altogether. I mean, there's been enough rhetoric that I think there might have been a hope of maybe this will just go away, right? I mean, the Biden administration now is hoping that this $10,000 or $20,000 that they're hoping to put, that the Supreme Court allows them to push that through, and that'll kind of offset for lower income borrowers. So there has been a lot of happy talk about getting rid of student debt.
Yeah, and you're right. I mean, the student loan forgiveness plan that the president, put forward is still in play. But as you point out, the Supreme Court is going to rule on this shortly. And the thinking is that they're going to strike this down. So it's not going to work as a way to provide relief. But the administration has also juiced up a so-called income repayment plan. So these are plans where you're under a lot of stress and you're shelling out a high share of your income to student loan payments. You can get a break. And if you pay for a certain period of time and you're still not paying that debt off, you can have some of that debt forgiven, if not all of it. So there are other ways to, kind of navigate around this. But I don't think the odds are that we're not going to get the full forgiveness plan as the president has envisaged.
Right. No, and you wonder a little bit about those incentives where, okay, if your income is below $125K, you can qualify for, so there, to people, that's going to be pretty powerful to make sure that their income doesn't go above that level, even though it might be a high-class problem to have. With the labor market, I mean, do you see it weakening considerably in the months to come? Because that'll be a big determinant, obviously, of whether people can make payments of all kinds going forward.
I do. I expect the labor market to slow here meaningfully. I mean, we're average monthly job growth is 250,000 per month. We're going to get another read, obviously, on Friday, and I suspect it's going to be closer to 200,000 given the data that we have. But, I do think the Federal Reserve is going to ensure that we get something sub 100K per month, because that would be consistent with getting unemployment notching a little bit higher here. And I think that's what they'll need to get wage growth and inflation back down something close to their target. So I think I would count on the labor market weakening here. One thing I will say, though, Kelly, the labor market's incredibly resilient. Businesses do not want to lay off workers because they know their number one problem is going to be finding and retaining workers. And in that context, while I think the labor market will slow, I don't think it will fall apart. And if we don't see more layoffs, I just don't see a recession.
Right, of course. Sort of the labor hoarding theory. What's the GDP hit from the debt deal, do you think? Is it even there? Is it slight? Is it substantial?
It's a tenth or two by my calculation. And that's also assuming that the Federal Reserve doesn't react to that. I mean, that everything, all else being equal with regard to policy, it'll shave 1 to 0.2% of GDP growth between the fourth quarter of this year and the fourth quarter of next year, when the peak impact will occur. That's 150,000 jobs. That's a tenth of a percent on unemployment. So, again, not great, kind of sort of in the ballpark of what the student loan debt moratorium ending might mean, but it's not enough to do the economy, in my view.
All right, Mark, we'll leave it there. Thank you so much for your time today.
Sure. Thank you.
Mark Zandi of Moody's. Coming up, a funding frenzy. The boom in AI is widely expected to boost capital to startups working in that field, but it could also kickstart spending in another part of the valley. We have those details ahead. Plus, this streaming service, down about 33% this month, could be poised to unload assets, according to one firm. We have the name, the potential buyers, and what's at stake. And as we head to break, here's a look at the Dow heat map with Intel and Salesforce leading the way, while P&G is one of the biggest laggards, believe it or not, today. Disney down 1%, Home Depot as well, and 3M down 1.5%. We're back after this.
Your Verizon.
Welcome back to the exchange that I mentioned a moment ago. The S&P has turned negative. It's clinging on to 4,200 literally by a couple tenths at this point. So we'll watch that again psychologically just as we look to close out the month. Dow down 145, about 50 points off session lows. NASDAQ positive. Let's look at some of the losers and winners today to kind of give you a sense of what's driving all of this. In the retail space, Target and Dollar General are both hitting 52-week lows today. This is a 3.5% sell-off for Target. Dollar General down about 1.5%. So again, both of these at 52-week lows. Energy Energy also under some pressure with crude down more than 4% today. Dominion and Eversource, 52-week lows of their own. Dominion now unchanged. Eversource down about 0.5%. But again, this is building on a whole period now of declines where these are really just the capstone. And of course, it'll sound repetitive, but big tech is outperforming again today. Microsoft, Apple, Netflix, Meta, all at levels not seen since really the market peak in late 2021 and early 22. Here's your prices: $177 for Apple, Netflix, Meta. They've really more than doubled. Netflix up more than 3%. That's kind of your outperformer other than NVIDIA today. Over to Tyler Matheson now for a CNBC News update.
Always NVIDIA's. Kelly, thank you very much. 5 people unaccounted for after an apartment building partially collapsed in Davenport, Iowa over the weekend. Davenport's mayor gave the update today amid criticism the city is moving too quickly to demolish the building before making sure no one is still inside. Protests erupted after a woman was rescued Monday night, hours after the city ordered the demolition to begin as early as Tuesday. A federal court ruling is clearing the way for OxyContin maker Purdue Pharma to settle thousands of legal claims over the opioid crisis. Under the new plan, the wealthy Sackler family is protected from opioid lawsuits. The Sacklers would give up ownership of Purdue, which would become a new company whose profits would be used to address the opioid crisis. They would also contribute up to $6 billion in cash over time, of which $750 million would go to individual opioid victims. The second private mission to the International Space Station is headed back to Earth. The 4-person crew completed more than 20 science experiments during their 8 days aboard the ISS. The mission is set to splash down off the coast of Florida later this evening. Kelly, back to you. See you in a half hour.
All right, Tyler, sounds good. Thank you. Coming up, there's only one more trading day in May after today, and the SMH is clocking a nearly 22% gain this month. But while some are taking money off the table, others say tech history points to a sustained rally from here. We will tell you why next. Welcome back. NVIDIA, the first chip maker to hit a market cap of $1 trillion. It's trading at all-time highs today, along with these names you see: Broadcom, onsemi, which have paired some gains, Applied Materials, AMD, Lam Research at 52-week highs of their own. Those big moves are fueling concerns about a bubble in the sector, but history suggests there could yet be more room to run. Deirdre Bosa joins us to explain in today's edition of Tech Check. Deirdre?
So, Kelly, I've showed you this chart before because I think it's a good one, and some people are looking at it as an analogy, perhaps, for this platform shift we're currently seeing. It's the shift to mobile internet. Semis, that yellow part of the chart, they were first to be recognized by the markets. They enabled and monetized the new technology. Infrastructure devices came next. Then the platforms themselves, think Google, mobile search, and Amazon. Back then, though, the semis were at the forefront, and they were names like Qualcomm and ARM. This time, it is undoubtedly NVIDIA. But what else could be here? Investors, they're looking forward to Broadcom earnings this week. Can it monetize its part in the AI hype cycle and talk up AI-related growth this year? Expectations are extremely high. Paired some gains today, but it's up some 25% or so since B of A called it the most underappreciated AI play about a week ago. Bernstein this morning, though, wrote, and this just relates to this huge surge in these AI names that we've seen this year. They said that if there was ever a year to consider the sell in May maxim, it might be this one. There's good reason to take money off the table, of course, after the run-up in those 7 stocks we've talked about that have led the broader market gains this year. But if generative AI is even more revolutionary than the mobile internet shift, going back to that first chart, which many smart people here believe it is, there could be more trillion-dollar companies to come. And Kelly, it's interesting to look at the evolution of big tech. First, it was FANG with 4 letters. Then it was FANG with an extra A. Now it's what some are calling, what is it this morning? I think the Magnificent 7, right? So instead of big tech giving up its leadership, there's only more entering that trillion-dollar club, more big tech becoming bigger, more names entering sort of this leadership.
Oh, I like that. So it kind of starts as the narrow FANG and broadens out to Ma or Ba or whatever we want to call it.
I haven't thought of a good acronym yet, but yes,
because we're
there's
past
like
that
7
point.
letters.
No, I totally take your point that, you get to a certain, it's silly to try to, come up with just 4 letters and 4 stocks anymore. But what do you do when you're starting out with NVIDIA at a market cap of $1 trillion, right? Like, what's the next layers to rise feel like that's where the next money is to be made?
Right. And so, when we think about that chart, we think about the mobile internet shift. It was the chip makers first. And then you saw, Google and Apple and Microsoft and Amazon become trillion-dollar companies, right? They only got bigger and bigger. So if you think that, the shift, the generative AI shift is going to be as big or bigger, there could be more trillion-dollar companies to come. Or we could just see big tech continue to get bigger and bigger. But, there's more to come here, and the market recognizes it at different points. So, yes, it's the chip makers now, but what's going to be next? A lot of folks are talking about data analytics, Kelly, and it's really, this is the gold or the oil, whatever you want to call it, in this next shift. So you could look at companies like Databricks. CRM could be interesting tomorrow, Salesforce, right? Because they made that acquisition a while ago of Tableau, and that's just crunching data. But that's what a lot of people here in the Valley say, is that the models are going to be, and the data sets are going to be most important, because that's building these large language models.
That's a really interesting point. Deirdre, thank you. We appreciate it. Deirdre Bosa. We'll talk to my next guest about that. But also first, can the AI boom save commercial real estate? Wolfe Research recently said the investment rush into artificial intelligence could lead to a surge in spending on data centers and even a flurry of office leasing in Silicon Valley. That could help stave off growing pressures on the sector. But are we putting too much on the emergence of AI as a major market force? Let's ask Sam Lessin, partner at Slow Ventures. Sam, it's good to see you again. And what do you think? Is it hype or justified? Go ahead.
Hype. It's pretty simple. I mean, look, the answer is everyone's excited about some of the opportunities around AI. They are real. I think this idea that the winners of last generation are going to win in AI again and compound their lead, I think, is basically correct. But this idea that commercial real estate is going to be somehow saved by AI, I think is a bridge too far for me. It sounds a little silly.
Well, maybe you can enlighten us. How bad is the sort of office activity? We all know San Francisco, right? But in Silicon Valley, totally different story. What's the situation like there? And do you think that all of a sudden all these people going, well, I want to be the next NVIDIA or Databricks or whatever it is, are going to be, crowded into these offices working on executing that plan?
You know, look, I think the reality is that this is not a boom that is very conducive to startups. So sure, there's a bunch of VCs plowing a bunch of money in. There's a moment. There will be a lot of companies started. But the reality, especially when it comes to commercial real estate, what you really need to drive commercial real estate is companies that are growing unbelievably quickly, adding tons of people and are very successful as startups versus, and I think what you're going to see really is that this boom is really a boom that's going to be dominated almost completely by the incumbents. So I would not expect some sort of Silicon Valley, thousands of startups that are going to be super successful and grow to big headcounts and need tons of people to drive the commercial real estate story anytime soon.
It's a great point about kind of where we are in the cycle. But what about Deirdre's point? And maybe you can tell us, where do people think the next wave of successful, I'll use the word startups, or successful investment dollars will be going on top of AI? Is it kind of data analytics? And she mentioned Tableau and Databricks and companies like this. Talk to me about whether and where that path will lead.
Look, I think that the big thing people are missing about AI is that it really is just an accelerant, a propellant to a lot of what's already there. So you can take Adobe and add AI, and it's a great story, right? You can take Meta and add AI, and it's a great story. You can take almost anything where there are products that all of a sudden with generative AI, you can make better, more efficient, create better consumer experiences. So it's not that this stuff won't permeate everything. It will, and it will be very powerful from that perspective. But it is interesting because I don't think that there are big themes to play, right? I think it's just good business and good startups that you can push in a lot of different ways. Now, in Silicon Valley, there's the special case of people who are specifically investing in deep tech or AI around it. Most of that stuff is going to go to zero. Some of it might be successful, but that's not going to be a big story. I think the big story is just going to be everything gets slightly better, right? And that slightly better can create improved margins. It can create new consumer experiences, et cetera. But I don't think there's some big thematic specific play like analytics that's completely revolutionized by this.
The one thing that does make sense to me, though, is data centers, because when NVIDIA comes out and raises its revenue, not to $8 billion as for, not to 9, not to 10, but to 11, and all of a sudden is talking about data centers. I mean, and you go, we're going to be a nation of data centers and self-storage. I mean, that's what is working in commercial real estate right now, and it does feel like there's going to be a huge data center growth in order to get that compute in one place.
There will be data center growth, and the big conversation really in AI right now is how much of AI will be done centrally in these big data centers versus migrate out to your phones, right, and be done locally. There'll be a little bit on the edge. There'll be like different topologies of networks, so it will all evolve. And yeah, there will be investment in data centers. But again, I don't think it's going to be a massive revolution and step change versus, it will be growth, right? There will be new opportunities. And what I think you'll see is the big cloud providers, the Amazons, the Microsofts, they're going to dominate this, right? More than anyone else.
How bad would sentiment be in the Valley right now if it weren't for the AI boom, right? Wouldn't it? What would we have to talk about otherwise?
Well, no, there are things to talk about. I think that the thing that's interesting is, Silicon Valley and a lot of these things are thematically driven, right? And themes are great because everyone can talk about them and glom onto them and do their take on them. And if you want to move billions of dollars of LP capital, it's really easy to say, well, we're on the theme of blank right now. I think we probably are in a moment where this theme is overblown. People are putting too much money in too irresponsibly at too high valuations, at least in the startup world, into these things because it's easy, right? You're on theme. But the reality is, the beauty of technology and where we are is there's 1,000 interesting businesses to fund at every moment, right? They might not be the sexy theme, right, of the moment, but when we're looking at small business opportunities and things like that, there are all sorts of platform opportunities and new things. You just have to be careful whenever the world is too excited about a theme, whether it's AI or blockchain or whatever, right? Your skepticism should go up.
No, very well said. Sam, thanks for your time today. We appreciate it.
Thanks so much.
Sam Lessin with Slow Ventures. Goldman Sachs reportedly preparing for another round of layoffs. This according to the Wall Street Journal, breaking just a few moments ago. The move would mark Goldman's third round of cuts in less than a year, would affect fewer than 250 jobs, but it does come as the big financial firms feel the pain from a plunge in deal-making activity. Goldman shares still down about 1% on the session. Still ahead, we now know who's playing in this year's NBA Finals, but where will we be watching future games? The potential $5 billion a year battle brewing among media companies, and who's poised to win? That's next. Welcome back. Shares of Netflix and Paramount, that was the mystery chart we teased, climbing higher today. Both companies getting a boost from analysts, but for two very different reasons. Julia Boorstin here with the details. What do you see, Julia?
Well, Kelly, let's start off with Paramount. Shares of that media giant surging on a Wolf Research upgrade from underperform to peer perform. That came out late Friday. The firm saying that National Amusements plans to borrow $125 million raises the odds of Paramount selling off assets accretively, saying they expect Shari Redstone to be what they call, quote, increasingly negotiable about the prices at which she would sell assets, both large and small, which they say will limit downside for investors. Meanwhile, Netflix shares are up over 3% on Bernstein, pointing to data from a company called Yipit, which shows that the paid sharing crackdown is working very well in the U.S., though less so in the U.K. Now, with an increasing focus on profitability rather than just those subscriber numbers, getting people borrowing passwords to start paying for access to Netflix is seen as a key for the streamer. Kelly?
But so Paramount could be not under duress, but forced to make these sales?
Well, I think the question is whether they're more open to making these sales. There's been a lot of speculation in the past that some of those assets owned by Paramount, whether it's the studio itself or whether it's some of their TV assets, would be ripe for acquisition, and whether this would be a good time for them to sell off some of those assets or maybe combine with another company so they could have more scale in the streaming wars.
So there was tons of advertising for Max, by the way, on the NBA game. Like literally, Julia, there were long trailers and buried little clips everywhere, which is a good transition to talk to you about the NBA more broadly. Who's going to get the rights here? I heard a podcast with Jimmy Pitaro recently where he seemed to say, like, look, we have a really good working relationship with the NBA. They are really happy with the direction this is going. And he didn't sound like he wanted to lose that.
Yeah, that's right. And certainly ESPN is a key partner for the NBA. And as the finals start this week, those rights negotiations are heating up. Now, current rights holders, which is ESPN, which is, of course, owned by Disney, and TNT, which is owned by Warner Brothers Discovery, they are currently in an exclusive negotiating window ahead of their combined $2.7 billion a year contracts expiring in 2025. When that exclusive window expires, we can expect interest from streamers, including Amazon and Apple. Amazon is already partnered with the NBA to stream games in Brazil, and of course, it's shown its expertise with sports streaming with the NFL games that it has. Meanwhile, Apple is showing its growing interest in sports, having bought up streaming rights to both soccer and baseball. Now, the NBA is in the spotlight right now, as all other major sports rights are tied up for years, and it's worth noting that playoffs ratings were up meaningfully from last year, while regular season ratings were pretty much flat with last year. Now, sources tell me that the league would like to split up its rights between at least two companies, so we could see streaming rights split up and also some rights still going to that linear TV bundle.
Yeah, the last major sports deal really to be up for some time is hugely important. Julia, thank you. Julia Boorstin. Coming up, shares of Coinbase up nearly 13% so far this month. And while they got an upgrade today, one analyst says he's seeing a troubling trend emerge. We'll dive into that next. Richmond Fed President Thomas Barkin just speaking at an NBAE event. Let's get to Steve Leisman with those headlines. Hi, Steve.
Hey, Kelly. Tom Barkin from Richmond saying Fed policy is right now in restrictive territory, but there is uncertainty around where rates need to go. Sounds kind of neutral, but then the next thing he says, he says he has one of the higher rate forecasts on the committee, and he hasn't, quote, backed off of that yet, at least. So he could be in the 5.5 range, which kind of tells you maybe he thinks the Fed has more to do. Doesn't say when it has to do it, but he does say, he said inflation is going to be stubborn, more stubborn than many people would hope. And he's looking to be convinced that demand is coming down and that that's going to bring down inflation. One good thing you heard, he's hearing less about the risk from wage increases. Important to say here, he's also pointing out that he's not hearing much about the banking trouble out there. Points out that the banking numbers from last Friday from the Fed were pretty healthy when it came to lending. So it's another reason why the Fed could go ahead if it wanted to, because the banking issue and the debt default issues have both kind of look like they're going away, Kelly.
All right, Steve, we appreciate it. Steve Leisman reporting. Keep an eye on the market. Largely unch. Dow's still down 150. Meantime, crypto having a strong start to the week. Coinbase shares higher on an upgrade to overweight at Atlantic Equities. Bitcoin up more than 2%, holding on to its nearly 70% gain so far this year. Coinbase and Bitcoin largely trading in tandem, but my next guest says there's a growing divergence in price action and volume that could mean trouble. Joining me now is Mizuho analyst Dan Dolev. It's good to see you again, Dan. What bothers you? Now, we should add, you're no Coinbase fan here. No. Longtime bear, I don't know, a longtime bear, vociferous bear on the stock. But what do you think is going on lately with the price of Bitcoin and Coinbase and all the rest of it?
Yeah, thanks. And you know, we've been bearish, like to give us, credit, we've been bearish since day one when everyone was dreaming the dream. I think what's going on right now is that retail is dead. So if you think about it, 95% of Coinbase's revenue, trading revenue comes from retail investors, and retail is basically dead. We track volumes every day. They are at an all-time low. Even today, as the stock is ripping, they're at an all-time low. It just shows you there's a huge disconnect between volumes and the stock.
And some are saying, well, it's great. Look at Bitcoin. It's got institutional support and they haven't bailed. But that may or well be the case for Bitcoin long term. Who knows? But for Coinbase, it's a big problem.
It's a big problem because the way they make money is when people come into the casino and gamble. And people are just not doing it. And it's going to take years for people to come back. And that's why the stock today, I can't explain it, but it's going to end in tears.
Let me ask you about one you've been much more positive on, which is SoFi. As we now see that student loan payments are set to restart, a lot of people have pointed that they could benefit from those who are facing that and saying, I definitely need to go in for a refi. That was their bread and butter. Is that going to be a big boon for them, or is that, overplayed?
No, I think it's actually a huge boon because if you think about this stock, and we were talking about it just like 2 weeks ago, it priced in like every bad thing that happened, including like an endless moratorium, student loan moratorium. And now that we're starting to talk about the end of it, then people are going to refinance and SoFi is going to make a lot of money. So for SoFi, all the bad news is priced in, none of the good news is priced in, and that's one glimpse of good news.
And there's an 8% pop in the shares today, still well shy of your price target, which was $9.50, around there, if I'm not mistaken.
Huge upside.
Still plenty of upside if that pans out. Last thing to ask you about is what's been going on at PayPal, where big debate on the stock. You've done some work. What do you sort of find at the heart of the investment thesis and a reason why you're positive on the shares today?
Yeah, so just a real quick 10-second, like the big debate, or one of the big debates on the stock is that they're handing over discounts to get people to use the app. We did a 30-page deep dive today that actually shows you, if you look at their transaction costs, there's no evidence of pricing concessions on PayPal side. That should be a huge sigh of relief to investors that people are actually using the app without pricing concessions. And that's why I think the stock is trading up today. Again, 30-page report, very detailed.
That said, it still seems to me, just as a casual observer, that things like Apple Pay could just cannibalize the need for something like PayPal over time.
Correct. And I think that's that's why the stock is trading at, in the 60s and not at 120 or 180. But there's a lot of optionality now with the end of the tenure of Dan Schulman, the CEO. The new person can come in, do something with rewards, do something with Venmo. There's just so many call options on PayPal today that are not priced in. And if you believe in it, you believe in those call options.
What would be the one to get you most excited for the new CEO to do?
I think rewards is like probably the most interesting thing because people use credit cards because of rewards, and PayPal has done really. They bought Honey for that. If few years ago, but they really did nothing with that. So if they can actually get it right, it would be a huge thing.
We will, Dan, a tour de force of the whole fintech space today. Thank you, Dan Dolev. We appreciate it.
Thank you.
That does it for The Exchange, everybody. For more analysis on markets and the economy, sign up for my newsletter. You can go to cnbc.com/newsletters or scan the QR code on your screen. And we should mention the Dow's still down 150, but both the S&P and the NASDAQ have briefly turned negative, I should say, during the session. The NASDAQ giving up about a 0.5% increase. We'll see if those Barkin comments have anything to do with it. That's next on Power Lunch, along with the $1 trillion trades and 3-stock lunch. Tyler is getting ready, and I'll join you on the other side of that break.
Clearly different.
Welcome to Power Lunch, everybody. Alongside Kelly Evans, I'm Tyler Matheson. And coming up, east of Wall Street, Elon Musk visiting China, meeting with leaders there as he visits his Shanghai operations. But he isn't the only one in China. Jamie Dimon also in the country for the first time in years. Apple's Tim Cook made some waves after visiting back in March. This as tensions between the U.S. and China remain high. Plus, despite facing headwind after headwind this past year, the markets remain relatively calm. Every major risk seems to be quickly resolved or at least ignored. But what some might see as calm against all odds, others could interpret as problematic. Kelly, more on this ahead.
Tyler, thank you. Let's get a check on the markets first. A couple of things to point out here. The S&P has gone negative and below 4,200 now with a 10-point drop, a 0.25% decline. The Dow is still down 0.5%. The NASDAQ briefly went red, is up by 2 right now. And all of this comes on a day when NVIDIA briefly joined the $1 trillion club. 404 roughly is the price there to watch for NVIDIA to hit that milestone. And we're a couple bucks back below that now at $989 billion. It, of course, joins the ranks of Microsoft, Apple, and Alphabet and Amazon, all thanks to that AI boom. We'll have more on that later on. Also, let's get a quick power check on the positive side of the S&P today. Ford getting an upgrade to buy at Jefferies. With this 4% pop, it's also overtaking GM's market cap. On the negative side, Comerica down 6.5%, actually off session lows. While the bulk of the bank crisis seems to have subsided, a lot of the small banks are still struggling compared with the big ones. And we'll get to more on that in a second time.
All right, we begin with a major U.S. CEO visiting China today, Tesla's Elon Musk, meeting with top leaders and saying the country's development is natural. This after telling David Faber earlier this month that, quote, the Chinese economy and the golden doors of the global economy are conjoined. Eunice Yoon is live in Beijing with more. Good day, Eunice.
Hi, Tyler. Well, Elon Musk used a similar phrase here in China when he told the foreign minister that China and the U.S. are conjoined. He was speaking to the foreign minister after arriving here in Beijing. He's expected to meet with the premier and then also to visit his Shanghai factory, which he hasn't seen in over 3 years. Now, upon arriving, Musk, right from the get-go, was speaking very positively about China, in addition to saying that China's development achievements are, quote, natural, as Tyler had said. He also said that he opposes decoupling and breaking chains. This is a similar line that we hear from Beijing. That's where the phrase about the U.S. and China being conjoined came in, and also that he's willing to expand here and share China's opportunities. Now, his remarks were met with equal enthusiasm from the Chinese government. The foreign ministry said that the foreign minister was talking about how Tesla shows that Beijing has a strong commitment to an international business climate. And then he used Tesla as an analogy for U.S.-China relations, saying that the two countries needed to, quote, avoid dangerous driving and step on the gas to promote mutually beneficial cooperation. Now, Musk isn't the only American CEO here in China. Jamie Dimon is headlining a JP Morgan conference in Shanghai, where about 2,600 bankers and clients are expected to gather. Shanghai City has already said that Jamie Dimon has paid a visit and met with the Shanghai party secretary, or the Communist Party chief there, saying that he would be investing more in Shanghai. And then for Shanghai's part, they say that this really shows the confidence that foreign companies have in Shanghai. Guys?
Eunice, thank you very much. And it's, of course, not just Musk in China. Jamie Dimon, as Eunice mentioned, making his first appearance in the country in 4 years, hosting a financial summit in Shanghai. All this coming just a few weeks before President Biden is set to host a first-ever state dinner for India, a move seen as tightening allies in the region around China. So is this a thawing of business relations? Let's talk to Dennis Unkovic, our friend and partner at Meyer, Unkovic & Scott, someone with years of experience helping companies do business in China. Dennis, I guess I am a little bit confused. On the one hand, it seems American business people are trying to be conciliatory towards China, keeping doors open, talking nice, where on the other hand, it seems that the political stance of the United States, the foreign policy stance of the United States, is to be tough on China. You almost, if you're a policymaker, can't be tough enough on China. Are we being too tough on China, politically, governmentally?
That's a great question. My opinion is no, we are not being too tough on China. Several companies, let's take Elon Musk, for example. He wants to sell, as he's manufacturing in China, his electric cars. That's great. And he will be able to do that. But he has doubled down on China. But most of the companies in the U.S. that are dependent upon Chinese exports have had a lot of problems over the last several years getting things on a timely basis. That's why you see the offshoring or reshoring going on there. And the CEOs visiting now, Tyler, it's not a surprise. Xi Jinping had a zero policy, COVID policy in effect for 3 years. It didn't work. And as a result, this is the first open door when they're going back. If I were a CEO, I might want to go back. But would I want to make major promises to invest significantly more? The answer is no.
How worried are you about two things? One is the state of the Chinese economy and whether it is as healthy as some of us are led to believe it may be, or as healthy as the Chinese government may want us to believe it is. And number two, the possibility that their battle with COVID is far, far, far from over.
Two things. You talk about how good the Chinese economy is. The GDP in China is now about 4.1%. As of April 2 months ago. That is the worst in a generation of growth in China. So Xi Jinping, although he has significant power and can lead the CCP, he does not have a strong economy. So it's really imperative on him to try to make nice with American companies. That's why I see you going on. And your second question was?
My second question was about COVID and the possibility that there may be incipient strains there that may handicap the economy more than we even know today. What do we know?
two things. Last week, NBC, you know them, of course,
Yes, heard of them.
announced that there would be a new wave of COVID infections going on in China between now and June 30th. They were estimating 65 million Chinese would be getting this over the next 6 weeks. That is a very, very serious problem. When you go back to it, Xi Jinping doubled down. He said, I'm going to have a zero COVID policy. We're not going to allow anybody to get COVID. Obviously, it failed. The Chinese economy went down for about 3 years, which is why in December, Xi Jinping did a complete 180 reverse and said, okay, we're going to have a new policy. So I think COVID is still a problem. One other thing, Tyler, why don't you ask the Chinese why they're not publishing statistics on how many people are getting COVID and where it is? I think there haven't been any statistics, to the best of my knowledge, in the last 3 or 4 months.
Dennis, just to kind of sort of zero in on this, then, you know, as we introduced you, we said, you know, you help American companies do business in China, but I hear you saying now companies are not doing enough on getting out. So is your business at this point getting companies into China or getting them out?
I'm spending more time with companies wanting to look at an alternative to just doing business in China. You mentioned the CEO of Apple a little bit before. He had what's called a China Plus, the #1. In other words, as far ago as 3 years ago, Cook was saying, let's find other places. Tyler, at the beginning of this interview, said, what about India? India can be one of the big winners because already you see Apple, although Cook was there making nice, they're already looking at outsourcing.
So, Dennis, I guess I would also kind of raise a comment from former Fed official Eric Rosengren, who earlier today tweeted, as we know with Japan, they never got back to their growth path after the peak in 1990. You know, banks had misallocated capital. He said China may now be facing the same challenge from its overinvestment in housing and its attacks on tech, and they seem unrepentant.
I was in Japan last week in Tokyo in meetings, and it was the first time since 1991 when the Japanese economy was growing at 6+%.
Wow.
So it took the Japanese almost 3 decades to turn it around. I think China is facing similar challenges.
And that would be formidable and perhaps another reason for companies to think twice. Dennis, thanks for joining us today.
Thank you, Kelly.
Dennis
Thank you.
Unkovic. Over to the financials now, shall we? In just the past hour, the Wall Street Journal is reporting that Goldman Sachs is preparing another round of layoffs amid the deal drought. Banks, for the most part, have been shaking off the crisis from earlier this year with the collapse of SVB. The big banks in particular, J.P. Morgan, a clear winner, up 6% in the past 2 months, while the KBE is down 5%. Our next guest favors the larger banks. He says more business will still flow that way. Mike Mayo is here on set with us, senior banking analyst and managing director at Wells Fargo. Welcome.
Thanks for having me.
Never a dull moment. Can I just ask you about the goal? I know Goldman is a little bit off topic, or maybe it's not, but of the major banks that should be doing so well right now, this is an investment bank. There are no deals. What is your rating on Goldman, and what should they do at this point?
Well, I think Goldman's positioned well for the next several years. Remember, Goldman and the large banks fired nobody during the pandemic. So a lot of what's happening at Goldman now is simply a catch-up in pruning the lowest performers. So I wouldn't have too much of a read into that. I mean, you do have lower for longer investment banking. It's taking longer for all kinds of deals to come back. On the other hand, several bank CEOs said at our conference a couple weeks ago, they see green shoots. So pruning, and it also sends a message. If you're not coming back to the office now, you're probably going to go back to the office after these layoffs. So I think these firms are trying to send a message that bring that intensity level back up to where it was before the pandemic.
It's an interesting point, but I wonder, to kind of bring this back to the whole banking sector, the place you want to be right now is in that kind of, what would we call it, bread and butter consumer business, right? I mean, or maybe you don't want to be if you have to pay out 5%, but their troubles with Marcus seem to have happened at exactly the worst time, because wouldn't that be the place to lean on for offsetting strength right now?
For over 150 years, Goldman Sachs' greatest strength was their investment banking and capital markets businesses to large corporations and investors. They went out of their lane with Marcus. That was a mistake. I said it was a mistake from day one. They're retreating from that now. That's the right move. Better late than never.
Sure.
So let's talk a little bit about those big banks and how they have been able to, well, I guess, sidestep some of the things that happened to the mid-size and the regional banks. You've got rising interest rates, and they seem to have stepped around that. You've got reduced deal flow, and they seem to have been making do with whatever deals they've got. You've got the issues of the banking crisis in the mid-sized bank, but they seem to have sort of stepped around that. What are they doing right? What is it that is native to those big banks that makes them your choice right now?
Well, Tyler, I think you're summing up consensus right now, and I know you like me bringing props every now and then. So you're describing, I think, the typical bank stock investor, and the typical bank stock investor is in the dark.
Yeah.
So what we did with the new report today.
I like you better with it on.
You're not the only one. But we said, let's do a kitchen sink analysis of banks. And we said, let's assume deposits go down by another 8%. Let's assume Fed funds goes down to 2.75%. That really squeezes the net interest margin. Let's assume a recession with higher credit losses. And let's assume a lot higher regulatory costs. So you throw in that kitchen sink, and earnings get hurt at the regional banks by 25%. Earnings get hurt at the largest banks by 5%, maybe 10%. So Goliath is winning. And so for all the actions the regulators have taken for the last 10 to 15 years since the global financial crisis, and a lot of it was to prevent concentration of power, the reality is business is flowing to the JP Morgan.
The business has gone there. It's the market, the hand of the market moving capital there, right?
And I know you're talking about $1 trillion market cap firms today with a new one entering that. JP Morgan has the possibility of becoming a $1 trillion market cap firm in, over the next 5 to 6 years. And they're gaining deposits.
So the history of the last
business.
30 years in banking has been of the reduction in the number of banks there are, banks and S&Ls in the United States. I don't know how many there are right now, but how many fewer will there be 10 years from now, 20 years from now? In other words, how does the big get bigger phenomenon play out?
Well, Goliath is winning. You need scale to keep up. There's a little less than 5,000 banks in the U.S. today.
Used to be what, 15,000?
Yeah, it used to be 15,000 when I started. And, it's probably going to be half that in 10 years from now.
Okay, there you go.
One of the biggest mistakes has been to prevent bank mergers. When I started in this business in the late 1980s, I worked at the Federal Reserve in Washington, D.C., and we approved bank mergers in 60 days.
Wow. Can you imagine?
Yeah.
Turning it around. In fact, the regulators, like we at the Fed in Washington, D.C., we were happy when a strong bank took over a weak bank. It was almost like, thank you very much for doing that. And that's where the U.S. banking regulators need to go today. And it's not, don't cut any corners. Make sure you're serving the community. Make sure the competitive considerations are under control. Make sure your Community Reinvestment Act, is up to date and all that. Don't cut any corners, but there's no reason you can't approve these mergers much more quickly. And there are look, the banks aren't going to zero. They're not being forced to sell their securities. The big banks are not raising capital, but you should still have the strong taking over the weak.
If you had one bank to buy today, it would be?
JP Morgan's my #1 pick. Business is flowing to them. They have the best relationship between revenues and expenses. And all this talk about AI, they have all sorts of new innovative AI technologies. Maybe they'll separate that out at some point and you'll get a partial tech valuation for them,
No
too.
worries about the Epstein connections, if there were Epstein connections?
I've seen no evidence that would have a material impact on my financial or strategic outlook for JP Morgan.
All right. Mike, thanks very much. Thanks for the eye shade. We appreciate it.
Thanks for having me.
I might borrow that for tonight, by the way.
Yeah, I tell you, it's getting light early, man.
One. Yeah.
All right, thanks. Good to see you. Coming up, no matter what negative headline comes out, the market seems to always find its center somehow. But what is making investors so chill, so zen? It could be that actual investors are on the sidelines while algo trading takes over. That's next. Plus, further ahead, State Farm stopping home insurance sales in California, citing wildfire risks. We'll discuss that one more when Power Lunch returns. We'll be right back. Welcome back to Power Lunch. Despite a challenging road ahead in D.C. for this debt deal, all signs do point to a resolution, or most do at least. And just like that, another major market risk may have been shoved aside. That seems to be the trend this year. We started the year with fears that rising rates would lead to a growth slowdown, maybe a recession. Then we had the AI boom, fuel tech stocks, the bank crisis contagion, prevented, maybe not, who knows. Government default, not this year. And yet, through all of this, the markets have remained relatively calm. Some would say better than calm. S&P is up 9% for the year, the NASDAQ up more than that, semiconductor stocks even more. For more on this whole phenomenon, let's bring in Hugh Johnson, Chairman and Chief Economist with Hugh Johnson Economics. Also with us is Greg Zuckerman of the Wall Street Journal. Greg, I'm going to begin with you. Is what we're seeing in the market today a sign of investor conviction, confidence that things are going to be okay, or is it something different?
So our indications suggest that the average equity fund, the average individual investor has been bullish, but not necessarily overly bullish. It's quant type funds that are really helping the market. My colleague did a really good story today about those who target volatility. And these include sort of trend followers, CTAs, as we call them, risk parity funds. Bridgewater is a huge one. And they look back and they look at vol, they look at the VIX and they see how low it's been and their models tell them to buy. So usually we sort of are here blaming the quants. We have to give them some credit here.
What do you say, Hugh? Is it a question of conviction? Is it a question of quants reacting to internal signals and thereby deploying capital into the market? What?
Well, keep in mind, Tyler, that quants are unemotional. They really don't get caught up in the day-to-day, week-to-week events that are really scary. Some of these things are really scaring small investors. I disagree with Greg a little bit. I think that I've never seen quite this level of widespread, let's call it pessimism, among average investors. So they're a little bit scared and they're caught up in some of these events. I think what gets them over, why this has been a good market, it's had stops and starts, and why we sort of restart is primarily because in every case, within a period of, say, 2 to 4 weeks, we've had a sort of solution, if that's the word, to some of the problems that we've had. The banking crisis, that's caused us to watch very carefully deposit outflows and bank lending. We're watching deposit outflows. We're watching bank lending. They seem to stabilize. That's helped investors. Now we've got the debt crisis, of course, the problem of a possible default. We're watching very carefully. We hear the words like, worldwide recession, but at the same time, we look at the details of the agreement between the House of Representatives and the president. And then when you look at it, the level of fiscal stimulus that's being removed, the level of, shall we say, restraint, non-defense discretionary spending is not much, exactly. And so investors will now get over that so-called default crisis or concern. So every time we get a crisis, every time we get an event like this, you bet investors are scared. You bet investors back away from the market. But at the same time, to some extent, they come back to the markets, largely because we start to see what looks like, I don't want to call it solutions, but something close to solutions.
That said, Greg, the sort of quants are our friend until they're not. I mean, we always pile on them at the first sign that they're, causing a panic or, So, what would you be watching for in terms of, when they flip the switch and start kind of pushing the market the other way?
Yeah, so I look at the VIX. The VIX at about 20 or so, it gets above that level and their models, and you don't want to generalize about quants. It's like saying mutual funds kind of thing. There are a lot of quants who do different types of things, but the ones we're talking about, trend followers, risk parity kind of guys, they look back. And like Bridgewater, they'll look back longer than some others, but they look at the VIX, and when it gets high, then they start getting concerned, or their models do anyway. They do some selling, but the fact that it's been relatively low for more than 6 months, it's been dropping for a little while over the past year. So if you want to go back that far, that's telling them to buy. But yeah, I would look at the VIX.
Hugh, let me turn to sort of questions of portfolio structure and management and where we are according to your models. if I am an average equity investor and I like to keep 60% stocks, 40% fixed income or cash, something like that, would you be, or 65%, 35%, where would you be right now?
Well, I'm a little bit concerned about a hard landing. I'm not saying that the hard landing is going to derail this so-called good market or bull market, but I'm concerned that we might see a little bit of a decline in stock prices as a result of that. What I'm seeing from the market sectors is I'm seeing positive performance from some bull market sectors. That's the good news. I'm seeing some good performance from the so-called defensive sectors like utilities and staples. That tells me, Tyler, in direct answer to your question, if you're 35 to 65% equities is your comfort range, be it about 50%, have a little defense in your portfolio, have some offense in the terms of technology and maybe communication services in your portfolio. In other words, a very balanced portfolio without a big bet to the upside or a big bet to the downside.
Hugh, good to see you, my friend. And Greg Zuckerman, also to you. Thank you for being with us.
Great seeing you.
Coming up, crude down more than 4% today as traders await what could be an impactful June OPEC Plus meeting. We'll have more on that next. Crude below 70 a barrel. Stay with us on Powerline. Welcome back. Big down day for oil. Nearly 4% declines below 70 a barrel. Got to bring in Pippa Stevens. What is happening, Pippa?
Yeah, getting slammed today, falling below that $70 per barrel level for the first time in nearly a month. And Rebecca Babin over at CIBC Private Wealth basically said that a lot of this is due to anxiety before the OPEC meeting. And essentially, it is a no-win situation because if they cut production further, that means that demand is actually weaker than the market is anticipating. If they keep it where it is, that's also going to disappoint a bunch of traders. And then also there are the challenges of just simply enforcing the cuts they've already announced. And this, of course, is all within the backdrop of Russia now sending record amounts of oil to China and India. at the expense of other OPEC members. And so this weakness in oil is dragging down energy stocks, but there is one name that is bucking that trend and then some, and it is Equitrans Midstream. That is the company that operates and constructs the Mountain Valley Pipeline. Now, over the weekend,
that's the Manchin pipeline.
Exactly, the Manchin pipeline.
Man,
so
why
the
didn't
debt
someone
seal,
give us a heads up about this? And there's one thing to look at, one stock that might
yeah. So it was up 40% earlier today. Last I checked, up about 35%. And that's because the debt seal deal includes specific provisions that would fast track this pipeline that is so important to Senator Manchin, given that it goes from West Virginia to Virginia.
Builders of it, or the owners?
Yeah. So they're the builders, and then it's a joint venture. And Equitrans was spun out of EQT. So there's a bunch of parties involved, but they are the owner, and then, they're the constructor and then the majority owner of the pipeline. And, it was 2 years ago, it was 92% complete. And then, so that was back in March of 2021.
Really?
And then since then, it's just been undergoing all this litigation. And so the provisions in the debt seal deal means that all of the permits would be fast-tracked, and then any appeals would go straight to D.C. rather than being stuck in the circuit, in Fourth Circuit.
It's fascinating, and maybe such a template as the rest of the country will ultimately have to try to move forward on its infrastructure of other such deals to come. But maybe Manchin just, this is just so important.
It's 92% complete.
Yes, exactly. So it's just been sitting there for the past 2 years as it undergoes all these permit requirements for things like passing through a forest and then waterways.
Yes, it's a lot of streams that it either goes under or over or.
Exactly. And this is angering a lot of climate activists. But on the flip side, the case for renewables is that they're actually cheaper. And so if you believe in that, then even if there is a pipeline, presumably we'll still see more renewables come online because it just is more economical than a pipeline.
Yeah, just need the intermittency issue.
Yes.
What was that? You
Batteries.
need 4 times as much installed electricity of renewables to have the same, anyway. Pippa, thank you. We appreciate it. Pippa Stevens.
Senator Manchin may be the most powerful man in Washington after the president.
You've said it.
I believed it for a long time. Pippa, thanks. Well, let's get to Bertha Coombs for a CNBC News update. Bertha.
Hi, Tyler. Thanks very much. Disgraced Theranos CEO Elizabeth Holmes reported to a Texas prison this afternoon to start an 11-year sentence for defrauding investors. Holmes entered the minimum security federal women's prison this afternoon, more than a year after a jury convicted her on 4 felony counts of fraud and conspiracy. As she begins her sentence, she leaves behind her 2 young children, both under the age of 2. The Carter Center sharing today that former First Lady Rosalynn Carter has dementia. The center says Rosalynn, who is 95 years old, continues to live happily at her Georgia home with her husband, former President Jimmy Carter. The announcement of Mrs. Carter's diagnosis comes as the former president continues to receive hospice care. And Golden Warriors general manager Bob Myers is stepping down after 11 seasons with the team and 4 NBA championships. Myers told ESPN that he plans to leave when his contract expires at the end of June. He says he turned down a new deal that would have placed him among the NBA's top earning executives. I guess it's like the old song, know when to fold them, know when to go.
Yeah, must be just time to move on there. And, we're looking forward to the finals, Denver and Miami.
Yeah, I'm sad. No Celtics.
No Celtics. Bertha, all right. There's always next year. Ahead on Power Lunch, insurance premiums are skyrocketing across the country, partly due to an increase in natural disasters like wildfires, as well as inflation. It's putting pressure on real estate properties. We'll talk about that next. Welcome back to Power Lunch, everybody. State Farm getting out of the Golden State, saying it's going to stop accepting homeowners insurance applications in California because of wildfire and construction costs there. But the nation's largest car and home property casualty insurer isn't the only one under pressure. And as companies hike their premiums to keep up with costs, property managers and developers are facing difficult decisions. Contessa Brewer has a closer look now.
It's astronomical and not sustainable.
Francis Greenberger's really feeling the pressure. The CEO of Time Equities oversees a large portfolio of properties and got sticker shock when the insurance bill came.
We just renewed our policy a couple of months ago at a 30% increase, 3-0.
In Corpus Christi, Texas, insurance premiums tripled for this 800-unit apartment complex that serves as homes for nurses, airport crew, and those who work in the oil industry.
That was pushing the premiums north of $2,000 a unit, which is absolutely unsustainable and frankly out of line. And it has created a significant burden for property that serves a workforce housing community.
Unable to hike the rent that much, the landlord, private equity fund Fundamental Advisors, is left pinching pennies on operating expenses and facing the prospect of bailing on other bills, including their debt.
This pricing is killing deals, it's preventing new development, and it's putting some companies that I've been talking to lately out of business.
Property insurance prices are soaring because natural disasters are more frequent and more severe, and inflation has made repairs and replacement more expensive. Skyrocketing litigation, verdicts, and settlements have driven costs higher, and insurance fraud is pervasive. But Danielle Lombardo, who heads up global real estate for Lockton, says banks and their mortgage requirements are part of the problem.
Lender requirements often dictate more insurance than is necessary for extreme events. If lenders were to take a more data-driven approach, we would be in a situation where we could fix part of the supply-demand issue in the market by having our clients buy less insurance.
If a lender requires coverage that would pay to replace entirely a $40 million property in Texas, the policy would be $3.7 million, Lombardo tells me. If that lender used data that more accurately reflected its real risk, the cost would be $1 million. If those requirements changed, of course, insurers would be selling cheaper policies. Contessa Brewer, CNBC Business News.
Here to talk more about California's impact on the insurance providers and the industry in general, let's bring in David Montemaden. He's managing director and senior equity research analyst in the insurance sector at Evercore. This has been kind of an exciting year for insurance because we've had, the stocks doing so well for a while, and then now obviously this huge news for California. Was it totally unexpected, or did you have a sense it might be coming?
Yeah, it's a good question. We've seen some other carriers, pull back on new business. Most recently, Allstate in November actually did the exact same thing that State Farm did, and is pulled back on writing new policies in California. And Chubb has also done some actions as well over the years. So it's been one area that is particularly prone to natural disasters, specifically wildfires, where the carriers are reacting to just a higher frequency of loss. And then when you are getting a loss, more severity just from inflation.
So those are two huge, kind of everyday, everywhere types of providers. I would have to imagine that's as true in California as the rest of the country. Where do people turn to for insurance? How expensive is that insurance now? Because, what are the state regulators going to say? No, you can't raise prices. I mean, people are literally leaving the state.
Yeah, there is an insurer of last resort in California. I believe it's called the FAIR Plan. But there are also other avenues that people can access. And so the excess and surplus lines market is a market where you can write in a little bit less regulated policies, where you're not as beholden to some of the restrictions that an admitted policy is in a state such as California.
The source in Contessa's report said that if insurers only insured not for the total risk of loss or the risk of total loss, but for something that the data would say was a more likely level of loss, how much would that change premiums and pricing?
I think that is, obviously the lower coverage limit, the lower the costs will be. But there are also various different elements you got to think about. What is the deductible? So it's really hard to say for, just a generic policy. But what I would say is that these are adjustments that all carriers are making where, even if they're not pulling out and, not writing new business, they are trying to increase deductibles at the same time as raising prices just to deal with a lot of the inflationary, pressures that, you guys have spoken about.
So there are some options, like you said, that people can turn to. But do you see any of the other companies that you cover saying, I remember a story about Louisiana, maybe 20 or 30 years ago. It could have been flooding. There was an issue that drove a lot of the insurers out of the market. And that's what then caused some people to get together and say, well, we are then going, our agency is going to cover that state. And they now are, the top provider in the state. And people have ultimately come back. Is there a market opportunity in California, biggest populated state in the country, I think, unless it's Texas, anyway, to come in now opportunistically and say, OK, we're more comfortable, we're able to, to write business and take massive share in this market?
Yeah, I mean, there definitely are carriers that are coming in specifically into the excess and surplus lines market. And there have also been a number of higher profile carriers which have stopped writing on admitted paper and moved into the excess and surplus line market where there's more freedom in terms of rate as well as coverage. So we have sort of started to see that, but there, consumers will have options, but they are much more expensive options.
Yeah. Speaking of more expensive, we don't have time to get into it, but, social inflation, as it's called in the insurance industry, these court rulings and the extent to which it's up in price, that was a surprising one to me. So perhaps a topic for another time, but they are facing a lot of cost increases. David, thanks for your time today.
Thanks so much for having me.
David Motemaden with Evercore ISI. Coming up, airlines in the green coming off a busy Memorial Day weekend with United, American, and Delta all on pace for their best month since January. How did they handle the holiday surge? We'll tell you when Power Lunch comes back after this break.
Welcome back to Power Lunch, everybody. Yields retreating from their recent highs as investors await a vote on that debt ceiling deal. Rick Santelli at the CME with more. Hi, Rick.
Hi, Tyler. Indeed, everything from T-bills out to 30-year bonds. Yields are dropping. They're not all dropping in equal proportions, though. As you look at an intraday of 2-year, you can see that right now it's down about 8 basis points or so. And if you open the chart up, you can see we've turned it from some of the highest yield closes going back to mid-March. But there's so many moving pieces here. We have votes yet to be done on the debt deal, but assuming it all goes as planned, what happens to supply? That's the big question. Is there going to be $1 trillion in T-bills? Where along the curve is Janet Yellen going to restock those shelves of supply that is much needed to bring those Treasury coffers back up to size? I'm not sure, but if you look at 10s to 2s right now, it's approaching minus 80, the most inverted it's been since March 10th. And we all know that ultimately, supply is most likely going to be in the short end. So watching these yield curves is what traders are doing in front of some of the big moves Janet Yellen probably has in store when the final votes are tallied on the debt deal. Kelly, back to you.
Everyone is watching and waiting for that, Rick. Thank you. Coming up, a new tech titan hitting the $1 trillion milestone. We'll track its meteoric rise and trade one fintech firm that could be next to join the club. If you think you can guess what it is, tweet us at Power Lunch and we'll reveal it after the break.
Free consultation. Welcome back to Power Lunch. I'm Christina Partsinevelos. NVIDIA stock hitting an all-time high today and was briefly part of the exclusive $1 trillion market cap club. And this is because its CEO Jensen Huang's keynote over the weekend whipped up some more enthusiasm by outlining a slew of new products like a new AI supercomputer, a partnership with the largest advertising agency in the world to create content using generative AI, and a combo CPU or central processing unit with a graphics, which is in full production right now. The bottom line, NVIDIA wants investors to know it's working on increasing revenues from adjacencies tied to its data center. So think of it like offering the entire AI ecosystem as opposed to just a chip. The stock is handily outperforming the S&P IT index as well as the SOX ETF, but has many, including Cathie Wood, debating the stretch valuation. However, Bank of America points out today that only 15% of cloud servers can handle these super sped up processing powers or accelerated computing, which leaves a large total addressable market for NVIDIA. Kelly?
Christina, thank you. It brings us to today's three-stock lunch. Trading the $1 Trillion Club is David Wagner. He's portfolio manager at Aptus Capital. David, welcome back. It's good to see you again. Let's start with NVIDIA. Are you a buyer here?
Yeah, Kelly, I like NVIDIA long-term here, but I think that investors need to understand that price volatility may be the norm moving forward, especially given current valuations. I mean, in this AI space, there's going to be winners, there's going to be losers, but it's a huge market, but there's going to be wild swings in prices and crazy valuations. And what does NVIDIA have? Well, probably a crazy valuations in the eyes of most people. But I think that's why it's really important that investors need to understand the bull case around Hopper, because I do think that GPUs moving forward are going to continue to drive positive earnings revisions. Basically, what I'm trying to say is that there has never been a data center sales cycle that has lasted less than 1 year. So this past quarters, it shouldn't be a one event pull forward of earnings and then they fall off a cliff next year. I do think that this is sustainable, pardon me. But the biggest point that I can make known here is that there's probably going to be air pockets in this name moving forward. But that's the risk of buying at this valuation. If there is an air pocket, say on earnings guidance, which is probably inevitable, the stock could pull back, 20% here. But Kelly, I do like NVIDIA here, though I recently trimmed it because I don't want to subject my investors to all of that volatility.
All right, let's move on to another one. The world's most valuable company, that would be Apple, sitting at a market cap of $2.8 trillion, leading the exclusive $1 trillion club. Do you see more upside here for Apple, or are you a little more cautious?
Tyler, there's a lot of, convicted thesis for Apple here. I mean, it's very polarizing. Apple's a name that I'm definitely not going to be betting against from a technical perspective. The technical perspective, well, it's very strong here, and I'm following the tape here, even at current valuations. I do think that AR/VR front, the developer conference next year is going to be the focus. It may not be a large financial impact, in the near term, but from a sentiment perspective, it could definitely show that, hey, Apple, it can still innovate. So I'm not betting against this name.
So for our third stock, David, we asked you to pick a company that you think could join the $1 Trillion Club. What is it?
It's going to take a little while. It's only about, $500 billion in market cap right now, but it's going to be Visa. I believe that, the combination of double-digit revenue growth and mid-teen EPS growth, and the stock trading at a pretty sizable discount versus its historical multiples is definitely a reason, to remain invested in this name. I mean, it checks a lot of boxes for this type of market environment right now. I mean, all told, the company's ability to protect the bottom line in a variety of macro scenarios, alongside a reasonable valuation that's only at 30% versus the S&P 500 on a premium standpoint, when it tends to trade at a 50% premium, are all definitely reasons why you need to remain invested in this name.
Very good. David, thanks. Good to see you.
All right, folks,
Thanks,
save some more room because there's more Power Lunch coming up.
What's next?
Welcome back, everybody. About 3 minutes to go and a lot more stories you need to know about. So let's get right to it today, starting with a big day for disgraced Theranos founder Elizabeth Holmes reporting to prison to begin her more than 11-year sentence. She was ordered to surrender by no later than 2 p.m. local time at a minimum security prison in Bryan, Texas. Remember, a federal jury in California convicted her in January of 4 counts of criminal fraud for deceiving investors.
You know, having just watched the end of Succession, which was a Shakespearean kind of tragic comedy, I think of her case in the same sort of Shakespearean way, or epic, flying too high to the sun. And I feel terribly for her children. 2 children.
2 young kids, apparently.
2 children.
Yeah.
She did the crime, she does the time. But
We'll see what that time amounts to. An 11-year sentence I don't know, maybe the legal experts, is that a couple of years in reality? Is that not? It's a tough way to start your life, though, with visiting your mom.
bet
But again, a saga, I think she was hoping to sort of wait out the clock, and that was not the case.
Yeah.
And some of the stuff was just so, I hope Silicon Valley has learned its lesson.
all right, next up, Memorial Day weekend air travel back above 2019 levels for the first time since the start of the pandemic. The TSA screened nearly 9.8 million people from Friday through Monday, including a post-pandemic record of 2.7 million on Friday alone. Air travel is back, pent-up demand. The issues here are there just aren't enough air traffic controllers to handle it. So lots of airlines have had to slow traffic or reduce traffic into and out of many metros, including the New York area.
Denver surpassing O'Hare as United's busiest hub. I was
Is
thinking
that
about
right?
that with Denver going to the playoffs.
Wow.
City's having a moment, isn't it?
Wow. I didn't know that.
Tough airport to travel through. Disney's Little Mermaid had quite a weekend. Swam past the competition at the box office to bring in about $118 million if we use the 4-day total. That makes the 5th highest Memorial Day opening in history. Not a lot of sort of coverage of this because the numbers weren't that impressive, but still, it shows that the cinema can still draw people in.
I didn't see it this weekend.
I'm shocked.
Yeah.
I was obsessed with The Little Mermaid as a kid. Maybe when my kids are a little older, we can do
You'll
a
go.
movie
You all
theater
will go.
outing.
I did go see the Yogi Berra documentary called It Ain't Over. It's marvelous. All right, community college enrollment growing after decades of declines. It rose 0.5% from the year before after falling 8.2 and 10.1% in 22 and 21, respectively. All of this fueled by the high cost of college, as well as economic anxiety and a tight labor market.
This is a sign the labor market is weakening. You don't go to community college if you can go get a job. And Gen Z teens are being unruly in malls. I thought we were maybe past this as a society, but apparently TikTok is fueling this growing trend. Garden State Plaza right here in New Jersey requires anyone under 18 to have a chaperone Fridays and Saturdays after 5 p.m.
They had a couple of fights in the food court or something like that.
You know, I used to bring my kids there as a place to go, especially in the winter.
In the winter, yeah.
Maybe I'll think twice. Look like a Little Mermaid.
You know, don't go to Garden State on a Friday night. Thanks for watching Power Lunch, everybody.
Closing bell starts right now.
Kelly, thanks so much. Welcome to Closing Bell. I'm Scott Wapner, live from Post 9 at the New York Stock Exchange. This make or break hour begins with the mania around AI stocks. Many, including NVIDIA, hitting new highs yet again today. This as questions intensify over whether it is all too much too soon and a bubble bound to burst. We discuss that with our panel of experts in just a moment. We're also, of course, watching for any developments out of Washington, right there at the Capitol, where the House Rules Committee is now meeting on that debt ceiling deal reached over the weekend. In the meantime, here is your scorecard with 60 minutes to go in regulation. A relatively tight range for stocks today. The NASDAQ once again where the action has been throughout much of the day. Meta and Microsoft, Apple, and AMD among the standouts there. Tough to get much going elsewhere, though, as energy and staples lag. It leads us to our talk of the tape, the $1 Trillion Club getting a new member today. NVIDIA becoming the first ever chip stock to reach that milestone. An astounding run for a stock that has just simply soared. What now, though, is the question. Is it time to take and protect some profits? Let's ask Requisite Capital's Bryn Talkington, who owns the stock, also a CNBC contributor. Bryn, welcome. It's nice to see you. How are you thinking about this? Are you tempted to take some chips off the table, and have you?
I have not. I have it positioned appropriately, and I think that, as I said last week, NVIDIA was under-owned going into earnings, and boy, did we see how under-owned it was, because you've just seen such a massive pile-in of investors who haven't owned NVIDIA, which has been a publicly traded company for 23 years. So I do think, though, the move in general has gone so fast. And I think it's gotten too fast, too quick, because, you know, Jensen said, Scott, on the call that he thinks over the next 10 years, not over the next 2, he thinks that data centers essentially are going to be recycled and reclaimed using accelerated computing. But that's 10 years out. And I think ChatGPT captured all of our imaginations of what AI could do. It clearly captured NVIDIA's market cap. But I think how companies monetize, how much double ordering was done with NVIDIA, we just won't know. And so I do think the frenzy will happen. But once again, as we know, frenzies last way longer than all of us ever expect.
I just love to try and get into the mind of an investor. I think our viewers would really like to channel the same. I want you to listen to what Josh Brown, a longtime NVIDIA investor, told us today on Halftime Report as he said he trimmed a quarter of his position. Listen.
Basically, you have arguably the best stock in the world, but it's 46% above its 50-day moving average. That's the 6th highest reading ever. And you just have to say to yourself, how likely is it for there to be strong gains in the very short term from here? It's not impossible, but the likelihood of a reversal grows.
So explain to me, you know, give me the psyche of somebody who loves the stock while at the same time suggesting, yeah, there's a bubble. How can one exist at the same time?
It's about managing your position, right? As I said in the beginning. So he still has 75% of the position. He sold 25. And so I think that long-term investors think that way just because it's so amazing what's happened. But if you look back, since NVIDIA has been a publicly traded company, there have been 8 years where it's had a return of over 100%. And in fact, in 2001 and 2016, the stock was up 300 and like 216% respectively. So we're still not even at those levels yet. And so I think this is what's hard to be a long-term investor in a company, is you have to know how to size the position, because so few people get that long-term return of stocks because they just can't believe it's going to continue to go on.
Yeah, let's bring in Stacy Rasgon now of Bernstein. He's one of the top chip analysts on the street to join the conversation. And we've been with him. We've been with you, Stacy, every step of the way here, before earnings, after earnings, and now we'll take the pulse of this whole thing yet again. Is the pulse speeding too fast? Do we need to slow things down?
Look, yeah, so there's going to be a controversy right now. The significant upside we're seeing right now is that I think we're kind of getting at, is it a pull forward like from next year or is it not? I don't think we know yet. That being said, I think it's definitely not a pull forward over the next like few quarters. Like they're clearly having upside to demand. They're clearly having upside to demand in the second half. They just guided $11 billion for Q2. Knowing NVIDIA, they probably think they can beat that number. I would not be surprised to see numbers continue to go up in the near to medium term. And then look, even if we get a pull forward or digestion, it will undoubtedly it will happen at some point. This is a company, their business does have digestion cycles. We've seen them before. We will see it again. But I think it's hard to argue that the opportunity in front of them is not large and that we are not early. We are clearly early. This has just begun. I think the opportunity is enormous. I think we are at a paradigm shift in terms of how data centers and other things are architected. And if you're looking out 3 years, 5 years, 10 years, I remain convinced that the upside is still considerably much more in front of us than it is behind us. Over the next year, into next year, I guess we can worry about next year when we get into next year, but at least for the next several quarters, my guess is numbers go higher, right? Not lower.
I think what just astounds me and others is how the guide could be so far beyond what even the very best on Wall Street expected, and I put you in that category. You've been one of the top-rated chip analysts for as long as I can remember. So
Yeah,
how does everybody seemingly get blown away and blindsided?
It was a big number, and you have to remember, if you were, for example, if you're looking for wafer starts or something in Taiwan as an indicator, it's not that many wafers. The ASPs on these things are really high. It's not that many units, relative to say something in the smartphone space. We sell, what do we do, 1 billion or 1 billion smartphones every year. What does NVIDIA do in terms of unit volumes for data center? 100,000 a month, 200,000 a month, something like that? It's not that many. So the incremental, in the supply chain for that kind of stuff, and maybe that starts to pick up more in the second half, but initially that incremental is not that big. And that's probably part of it. We all knew that they were going to have upside. Like we knew that, but just the magnitude of it, like it doesn't take a lot of wafers, for example, to drive that much revenue, just because the ASPs, the prices on these things are so high.
Let's bring in another contributor of ours, if we could, Stacey. Adam Parker, I think somebody you know quite well, of Trivariate Research.
Hi, hey, Stacey. Hey, Bryn.
Who used to be, for all of those of you who don't know, at Bernstein as a chip analyst. So
Adam
we're
was my
fortunate
direct
to have,
predecessor, actually, so yes.
Well, we're fortunate to have both of you today, along with Bryn. So, you know, Adam, when you look at this as now sort of the innocent bystander of sorts, what is your view?
I mean, there's a couple of things on the macro side that weren't mentioned. You know, just that IT budgets aren't going up, the economy's slowing, and so I think what caught people off guard is just the magnitude of the shift toward AI. Stacey's point's spot on, and he probably has a better number than me, but I think it's something like 30 times the price for one of these GPUs than it is for x86 servers. So his point's spot on. You just don't have the same number of units, and the pricing is huge. I think there'll probably be supply constraints too, and that may be another issue. It is a little interesting to not have gotten some word out of Taiwan, because in my whole, I guess, 25 years of paying attention to semis, I've never seen a revenue guide with that much upside as NVIDIA. You know, going from whatever it was, 7.15 billion consensus or whatever to 11, it's just the magnitude's massive. So in my meetings I'm doing mostly with CIOs and generalist PMs, they're just trying to figure out AI from sort of the broader perspective, which stocks are going to benefit, which might get destroyed, which maybe are impregnable. How do I think about valuations in that context? But I'm kind of with Stacey there, and Bryn too, that I don't think you want to value it on 2023 or 2024 free cash flow. I think it probably, I mean, you know, we wrote this several weeks ago when it was only 700 billion cap, but who knows? It could be worth 2 trillion was the number we threw out there.
So, Stacey, are you now rethinking the way that you're thinking about everything in your coverage universe and the potential, if there's a legitimate AI use to it, and what it means to the way you need to think and model your numbers?
I mean, so clearly lots of names have been running on AI hope, right? People have been looking for not just the ones who might win in the same ways that NVIDIA could win, but also the peripheral and the derivative plays around that in things like networking and memory and semicap. And so if nothing else, I think every frankly, probably every company outside of semis too is going to try to construct an AI story, whether or not they have one. And I think like we're thinking through the relevance and validity of those narratives is going to be important. And look, maybe it's possible that some names that, you know, there is an AI story that people weren't thinking of, and maybe it's possible that some names that are getting an AI type valuation, maybe the story's not as strong as people think. So that'll be the controversies that I think we'll need to be thinking about as we go through the rest of the year. Like, the market's clearly identifying winners and losers right now, and are those stories like actually like valid, or are they not?
Yeah, I think when you're a portfolio manager, you're just trying to find things that have a chance to have upward earnings revisions in the next 6 to 12 months. And in a market and economy that's eroding, that's hard. We know the overall 2024 estimates for the S&P 500 are too high. So it's not surprising people want to be associated with an AI story where there's upward revisions. I think and Stacey probably talks to a lot more people like this than I do. If you're trading 20 longs, 20 shorts, market neutral, just in semis, then you've got to figure out, well, maybe AMD's revenue is more Q4 and into next year, and Marvell's is a little bit later in the future, and NVIDIA's now, so you have that pair trade. I mean, there's lots of different things, but if you're a generalist PM looking back, you need beneficiary exposure to AI.
But see, Bryn, you're the one now as the investor of our group here who really has to decipher what's legit, what's not. What's the next big thing? What's the next, still good thing, but not as fast grower? Are you feeling the pressure at this moment to do just that?
No, because it's always about what multiple do you think the market is going to pay for X or Y?
All right, I thought I lost my own audio, but apparently you guys can't hear Bryn either, so we'll try and get her back. If we say where we are, Adam, at this moment in the market,
right?
Each incremental day that we say, okay, new high Microsoft, new high Meta, new high NVIDIA, does it make you more nervous?
A little bit. I just, I'm not really sure. We started the year saying bullish first half, bearish second half, just because everyone was saying the opposite. And you saw my note from yesterday. I'm kind of just really uncertain about the next 10% move. I'm not sure if we get to 4,600 or 3,800. It's just it's hard to be as bullish on the macro outlook now as it was a few months ago, because you've got notable people saying they're more optimistic. I think the Fed's going to be more hawkish than what's in the price. And so, I'm just sort of more balanced in trying to find places where there's upward revisions. Now, yes, we're doing a lot of work on AI and trying to figure out the beneficiaries. But I think we're also trying to figure out, are there things where expectations could be too low that have been beaten up? Energy, metals, things that are probably impregnable to AI in the long term. So I'm sort of focused both on beneficiaries and those that really can't be disrupted.
As Bryn, who we have your audio back, I'm told. Again, this idea of the investor class trying to decipher at this moment, kind of cut through the noise, break through the hype, and decide what has the correct growth trajectory to justify whatever valuation some of these stocks are now at today and may ultimately trade to in what feels like really near future.
Right. I mean, just look at the Qs. The top holdings in the Qs are going to be the beneficiaries: Meta, Google, NVIDIA, Apple, Microsoft. I mean, so it's like, once again, these companies are going to continue to grow. I know how Microsoft is going to monetize it. These big companies are going to make AI embedded in their companies and make it stickier for us as the users, and then charge more for that. So right now, I think the direct way to go is NVIDIA and Microsoft. But to Stacey's point, we are in early innings where there'll be lots of new winners that we're not even talking about today.
Yeah. So Stacey, as you look at your coverage universe, I don't even know, frankly, if you cover Marvell or a name like that. I know you do AMD. So when you see some of these others who are along for the ride, so to speak, who are the ones that we really need to pay attention to that we're not talking about every single day?
Yeah, so the one in my coverage that I think deserves more, and maybe it's getting a little bit of attention finally, is Broadcom. So Broadcom is benefiting a couple of different ways. They're benefiting all the hyperscalers doing their own chip design. Broadcom actually does that they call the ASIC. It's a custom chip. They do the chip design for that. And they're also benefiting from the networking side, which is another hugely important part of this as you're putting all of this stuff together. Broadcom, just based on what they said last quarter, 3 months ago, they were effectively calling for these AI revenues across chip design work and networking to be close to 15% of their semiconductor revenues this year. And that was 3 months ago. Presumably whatever they saw 3 months ago is higher now, I would guess. Broadcom reports earnings on Thursday, so we'll see what they have to say about that. But I think that's one of those less appreciated AI stories. It's not directly in compute, but it's other, they're not selling like compute chips, but it's other things that are equally important. And frankly, they've got a bigger percentage of their revenue for AI than Marvell or AMD or any of these others are going to have this year.
Yeah, Stacey, I appreciate you being with us once again. I look forward to our continuing conversation on that as I continue with Bryn and Adam for the remainder of this moment. You say the picture is increasingly negative for equities more broadly.
Maybe, yeah.
Does the AI story, though, sort of mitigate some of the negativity? You realize that we're on the cusp of this incredible new technological advance. It's enabled investors in some degree to, for lack of a better thing, hide out in some of these mega cap techs and play some defense and where the real offense of the future is going to be?
I think there's two things. I mean, in late March, we wrote a note. We talked about in the year, why is the market up so much? Is it all the Fed? And we said, no, it's not all the Fed. There's a lot of stuff going on in AI, and obviously we got a pretty big quarter on that. Now everyone's talking about it. I think the main implication I'm focused on is valuation and how that might not be an effective predictor of return. Because if you're sitting there saying, I want to buy cheap stocks and short expensive ones, what you're really doing is you're shorting those that have a higher probability of being disrupted, and you're longing those that are either impregnable or beneficiaries. So I think we could be in this thing where everyone wants to talk about valuation, but that might not be a great way to pick stocks. Now, maybe within beneficiaries, you'd say, all right, well, AMD and Marvell look like they're the same valuations as NVIDIA. There's upward revisions now, so I'll long AMD and be a little bit more negative, long NVIDIA and be a little more negative on AMD and Marvell, just very short term, something like that within beneficiaries or within. But I don't think you want to be long Chegg and short NVIDIA because it's cheap, right? One's disrupted and one is a benefit. So I think the valuation thing is what generals PMs are really trying to figure out. And sort of the more macro, yeah, you're right. AI is a beneficiary, but I think growth's going to be lower because of the regional bank stuff. The Fed's going to be more hawkish, and so so I think you probably have to think through Bond yields have backed up. I mean, there's not, the risk premium isn't compelling. So I'm a little bit more, don't know if the next 10% moves up or down than I was at the beginning of the year.
Well, you raise a good point, though, and we can end on it, Bryn, with you. This idea of kind of rethinking how you think about valuation in general and what you thought might be a little too rich or, ridiculously absurd. Maybe it turns out is not.
I think that investors that anchor on PEs are always going to miss it, because when you look back decades of data, Scott, 1 year forward returns and current PE multiples have zero correlation. And so that's where people anchoring of just buying cheap stocks, you need a catalyst. And right now the catalyst is in growth, and within growth is in AI. So I think continue to look for good companies, good sectors, and the rest will work, but do not anchor on multiples to construct your portfolio.
Real quick.
Yeah, no, I agree with Bryn. Actually, for very fast-growing stocks, you'd want to do the opposite. You want to buy the expensive and short the cheap for that 10% that's fastest growing. So she's spot on there for the growth stocks.
All right, real good stuff, guys. I appreciate it. Adam, thank you.
Yep.
Bryn,
Good to see you guys.
Thank you as well. Let's get to our Twitter question of the day. We want to know, which AI stock are you most bullish on right now? Is it NVIDIA, Microsoft, Alphabet, or Meta? You can head to @CNBC Closing Bell on Twitter. Share the results a little bit later on in the hour. In the meantime, we get a check on some top stocks to watch as we head into the close. Christina Partsinevelos is here with that. Christina.
Well, Ford stock could be headed for some more upside. That's according to Jefferies, after the bank upgraded the automaker to buy from hold with a price target of $16 a share. The firm said Form's recent investor event proved Ford could close the gap with its rivals by, quote, going back to the basics of focusing on its strengths. Shares are 4.5 or about 4.2% higher right now. Sticking with autos, shares of Tesla are also higher after Elon Musk makes his first visit to China in 3 years. His visit highlights the importance of the world's biggest electric car market, which is Tesla's second largest market after the U.S., and how Beijing wants to open or show it's open to foreign business. Barclays analysts also say the stock is well positioned for more gains. Shares are almost 4% higher right now, Scott.
All right, Christina, we'll see you in just a bit. Thank you, Christina Partsinevelos. We're just getting started here. Up next, trading new market risks. Lauren Goodwin from New York Life Investment is raising the red flag on what she says is a new selling risk for stocks. She'll explain. And later, energy stocks under pressure yet again. We'll tell you what's sending them lower today. Live from the New York Stock Exchange, you're watching Closing Bell on CNBC. Welcome back. We're following a developing story out of Washington. The House meeting on the debt ceiling is now underway. Our Eamon Javers live in Washington with the very latest. Eamon.
Hey there, Scott. Take a look at live pictures now of the House Rules Committee meeting right now. This is the first step for any piece of legislation on the Hill before it can go to the floor for a vote. You see that they are meeting now. Republicans control this committee by a 9-4 margin, so Speaker Kevin McCarthy should have home court advantage here. But there's been a lot of discontent among the most conservative members of the House Freedom Caucus about this debt deal. So we're watching this meeting to see if any of that spills over into this committee. Some of the unhappy members have talked about the possibility of forcing McCarthy out of the speakership. It's not clear if that's going to really amount to anything serious or if it's just political venting for now. Just a few moments ago, Speaker McCarthy spoke to that criticism, and what he said was, in essence, we didn't get outsmarted by the Democrats. What is clear here is that McCarthy is going to need Democratic votes to pass the bill on the floor as early as tomorrow. So we're going to watch and see whether we get any indication here that the deal is in trouble on the Hill. Back over to you, Scott.
All right, Eamon, thank you. We'll watch that very carefully. Eamon Javers in Washington for us. Our next guest says resolution in the debt ceiling duel could create new risk for equities. Let's bring in Lauren Goodwin of New York Life Investment Management. Welcome. Good to see you again. What's the new risk?
Well, it's not even a new risk. It's just one that we have to grapple with now, which is that one of the major supports for the market over the last 5 months has been the draining of the Treasury's general account to pay the Treasury's bills, to keep the economy running. Now, as we raise the debt ceiling, and I do believe that's going to take place this week, the Treasury has to rebuild that general account. There's about $500 billion that have drained over the last 5 months, and by the Treasury's own estimates, about $1.25 trillion that need to be raised in T-bills till the end of the year. That's a lot of supply and a lot of incremental supply over what would normally be raised that now the market has to grapple with. It's a risk for rates and for equities.
You don't think that it will be, better absorbed, for lack of a better word, than some are suggesting, who have raised the same issue, by the way, that you have over the course of the last couple of weeks?
I think it depends on who is buying these T-bills and how much supply is necessary. We've seen, for example, money market funds see a huge amount of flows over the last 4 or 5 months at the same time as this Treasury general account has been losing or pushing liquidity into the economy. If that supply is gobbled up, then great. We have a market that handles it well. But the sheer volume, nearly double the pace in the second half of the year, is normal. It's noteworthy for the markets.
Did it make you broadly more negative than you were before?
I think it's no, it doesn't make me more negative. It's just an interesting trigger point in the areas of the market where we could see some weakness. When I look at what could specifically trigger a sell-off here in the second half of the year, this is one of the items. But probably the more important fundamental economic ones are if we start to see unemployment claims rising and a second quarter of negative earnings growth. Those are signals that we're headed closer into recession. I think those are very clear market signals.
You think the Fed's done?
It's looking a lot more difficult here in the last couple of days with the just consumer spending from April up 0.8%. That is an astonishing number. And while the economic dominoes, so to speak, tend to topple the same way once the Fed starts raising interest rates, there's just a lot of support for the economy up there. I think the Fed could be done here, but if we have a higher than expected jobs report out of Friday, it's increasingly likely that we will still see another rate hike in June.
See, at what point do we, though, suggest and say, you know what, this good data is good. It's actually good. And it changes my perspective on what I thought was going to happen, whether I thought there was going to be a mild recession or a deeper recession. But the longer that the data remains supportive of the economy, isn't that good rather than a negative? Everybody takes it as good news is bad news because it re-engages the Fed at a time when we're thinking they're done.
That's exactly it, though. The good news is only good news if we can see the resumption of spending and the persistence of economic activity with inflation at more normal levels. Even though the disinflationary process has been intact for the last couple of months, inflation is still way above target. And the Fed, whether you agree with them or not, I happen to agree with them on this point, that when inflation is strong in the economy, it hurts normal people more than even the short-term impacts of a recession in the medium term. And so we have to see those inflationary figures come down before good news is just good news.
I mean, Richmond Fed President Barkin today said interest rates are, quote, in restrictive territory. I mean, you can read into anything that they say and make your own conclusion, but the implication would be that we're there. We're there. Now, we may stay there for a longer time than you think, but we're there. and we don't necessarily have to raise more. And if inflation comes down and the economy remains strong, that's the perfect scenario, is it not?
I'm sympathetic with that perspective that the Fed could pause here. I think the Fed's been pretty consistent over the last 9, even 12 months, saying that 5.25 is where we could stop, hold, and let the long and variable lags of monetary policy do their work. Now, the fact that we're still seeing strong consumer spending, a strong labor market, that's typical of an economic cycle. That is the last set of dominoes to fall as the economic cycle sort of turns over. So I think they could wait. What's going to be challenging for them is the persistence of this data. If they do continue to hike, that's when I think that actually the risk of a sharper, more severe recession increases.
I think we have a jobs report Friday, so the data is going to come fast and furious. It's good to see you again.
Thanks for having me.
All right, Lauren Goodwin joining us here, Post 9 once again. Up next, 5-star stock advice. Capital Wealth Planning's Kevin Simpson is back. He's breaking down his latest trades for us as well. He's going to reveal the one tech name he is pulling back on. Plus, an interview you won't want to miss. BlackRock's Rick Rieder, he will join us tomorrow right here on Closing Bell at 3 o'clock Eastern Time. We have a lot to talk to Rick Rieder about. Looking forward to that tomorrow. We're right back.
Eastern.
Well, we've been watching the market today, and the Dow is off the worst levels of the day. It's still off about 53. It's really been, yet again, a NASDAQ story. The NASDAQ's up 0.5%. NVIDIA has been the story again. Another new high today before a, let's call it a midday pullback just a bit as we continue to watch this market trade and head towards the end here. Still above 4,200 on the S&P 500 with just less than 30 minutes or so to go. The NASDAQ 100, a number of mega caps hitting their highest levels in more than a year today. That's been part of the story. The tech sentiment driven by AI gaining more steam. But our next guest is using this rally as an opportunity to take some profits. Joining us now is Kevin Simpson of Capital Wealth Planning. How are you? It's good to see you.
Hey, Scott. How are you?
Good, thank you. So you trimmed some Microsoft. I said to Bryn at the top of our show, like trying to get inside the mind of an investor who's watching this all unfold, new highs for Meta, new highs for Microsoft, new highs for NVIDIA, et cetera, et cetera. At what point do you decide I need to take some profits like you did with Microsoft?
Well, I mean, I think anytime you're seeing a move like this, and these stocks, heck, Scott, they're going to the moon, you've got to right-size the position. So we come at everything with a rules-based approach. Looking at things from a risk management perspective, we like to keep a maximum of a 5% weighting in any one name. So you've got Microsoft up 36, 37% year to date. It gives us an opportunity to sell into that strength, put some dry powder on the sidelines. We still love the company. We still have a 5% allocation, but the multiples do get a little bit stretched. And heck, everything having to do with AI is pushing these things higher and higher. So we've also seen vol increase into the space, and we've been able to write calls on Microsoft last week, did pretty well with that trade. And even a few minutes ago, we wrote calls for June on Microsoft again, looking to capitalize on that volatility. So we still like the name, but we're taking profits into the strength.
You think it's a bubble? All this stuff that's going on in the market around AI and all these stocks? You've seen a lot of markets, right? Does this feel that way to you?
Well, I think it's starting to, and that's the problem, because you've got legitimate companies that are making money, and you can invest in them and you can own them, and we own Apple and we own Microsoft, and we're going to continue to hold on to them. NVIDIA is not in our space, it's not in our universe, but boy, what a run that's had. But if you think back to 1999, the dot-com bubble, if you think back more recently to 2020, sitting around in May, all of the stocks that were going to be COVID stocks, all of the work-at-home companies, no one wanted to miss them. Meme stocks, it gets to be the same thing. So what I'm concerned about is that a bubble could happen if we start to see companies that are non-profitable just taking advantage of investors looking to get caught up in the hype.
Well, let me ask you this. So what you just said of NVIDIA, quote, not in our universe. Why not? I mean, is it just too rich? And isn't that the whole point in some respects of writing the covered calls that you do? Again, I just bring it back to Bryn. She employs the same kind of strategy in many ways that you do. She can own NVIDIA. She writes covered calls against it. Why not you?
Yeah, Bryn has a great strategy as well. Ours has to be a dividend-focused company, and the dividend on NVIDIA is just so inconsequential, and the dividend growth isn't there. Every stock that we invest in has to pay a dividend and has to have a very strong dividend growth. So I'm hoping that at some point these stocks become part of our universe and they can be candidates, because specifically to your point, Scott, they're unbelievable companies to write covered calls on. And if I was a shareholder in NVIDIA, I would trim the position, I'd take some profits, I'd be writing covered calls, and I would be using the protective put strategy to lock in some of these profits that we've enjoyed. Again, I'm a Microsoft Apple guy, but NVIDIA can be done the same way. You can look at the trade the same exact way as professional portfolio managers. We don't get the luxury of hyping any one thing. I can't just run into AI because it sounds cool. We've done the same thing for 20 years, but I think it's easy to get caught up in it, and I would caution people just to be careful.
No, you know what? I'm glad you reminded me and our viewers of the specifics of your strategy in terms of it having to have a dividend. We showed, the next to no dividend, obviously, that NVIDIA pays when we put it on the screen. So thank you for doing that. Also, you sold calls on Dow Inc.
Yeah, well, aside from these handful of stocks that have been going to the moon, the rest of the market's just been trudging along in a purgatory, and we've been trying to tread water. The Dow position has an amazing dividend. So we sold calls on it. We're taking advantage of trying to make some money, get paid while we wait in the flat market. AI stocks excluded. The stock also went ex-dividend today, so we picked up another 75 cents on it. But this is a stock that really has been just languishing, and anything having to do with healthcare, industrials, energy, all the things that dividend managers like us are invested in, they have not enjoyed the rally so far. So we've been looking to generate cash flow. We talk a lot about dividends, but really dialing in to see what that translates into a portfolio is important. that 75-cent dividend we're going to get, it matters. On an annualized basis, it's over a 5% cash flow. The covered calls that we've been writing on Dow, even a boring stock like that, 8% annualized premiums. The one that we wrote today for Microsoft, I mean, that's incredibly rich. It's over a 10% annualized premium, and that'll expire on June 16th. So even in a market that's somewhat bifurcated between hot AI and the rest of the world, there's things that you can be doing to take advantage of it. And we're long-term investors. So to your point, we've seen a lot of hype things in our day, but we're enjoying exposure, and we're going to continue to do it with Microsoft and Apple.
I'm going to ask you to be real quick on this. I noticed you trimmed SLB. Also, are you turning cold on energy?
No, we've had a pretty good weighting in Chevron, SLB, and Marathon Petroleum. Again, it's just right-sizing the position. We want to have a little cash, a little dry powder. I'm sure that everything's going to go smoothly in Washington. There's no chance that there won't be any contention or chin wagging and posturing. So just in the off chance that they mess this thing up, we want to have a little dry powder in our pocket for the next couple of weeks.
Gotcha. We'll talk to you soon, Kev. Thanks as always.
Thank you.
All right. Talk to you again. Kevin Simpson. Up next, we're tracking the biggest movers as we head into the close. Christina Partsinevelos is back with that. Christina.
Well, Scott, energy names are getting slammed ahead of an important meeting this weekend, and an analyst suggests that if crypto climbs 10% in market cap, then this one stock could move about 8% higher. I'll have the names right after this short break.
We've
got just about 15 minutes to go before the closing bell. Let's get back to Christina Partsenevelos now for a look at the stocks that she is watching. Christina.
Well, if you believe in crypto's rise, then you should believe in Coinbase. That's the message from Atlantic equity analysts after they upgraded Coin to overweight with a price target of $70. So that's about 23% upside. The stock is trading right now at $60.87, already 7% higher today. They like management's pricing power in its trading business, resulting in higher retail trading volume. The stock is up 71, almost 72% year to date. Oil fell below that $70 a barrel threshold for the first time in a month on mixed messages from major producers ahead of the OPEC Plus meeting this weekend, all while Russia continues to send record amounts of oil to China. And there's also concerns of further rate hikes by the Fed, which is also weighing on the sector. That's why the S&P energy sector is about 1% lower today and about 9% lower in the month, so it's the worst performing sector on the S&P 500. Names like Coterra, Devon Energy, Marathon Oil are all among the weakest links right now. You can see on your screen, Marathon down about almost 2%, Devon almost 3%, Coterra about 3%, and Dominion Energy, we have the wrong one up there. Well, it was trading at lows not seen in over a decade. Scott?
Okay, Christina, thank you. Last chance to weigh in on our Twitter question. We asked, which AI stock are you most bullish on? NVIDIA, Microsoft, Alphabet, or Meta? Head to @CNBC Closing Bell on Twitter. The results are right after this break. To the results now of our Twitter question. We asked, which AI stock are you most bullish on? NVIDIA, Microsoft, Alphabet, or Meta? Well, go figure. NVIDIA is the winner, nearly 44% of the vote. Up next, we have your earnings rundown. HP, HPE, and Box all out with results in OT. Counting it down with the key metrics you need to look out for when we take you inside the market zone. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down the crucial moments of the trading day. Plus, Bank of America's Marcy McGregor is back with her market forecast for the summer. Frank Holland looking ahead to key tech earnings out in overtime today. Mike, I begin with you. I mean, if it's cyclically sensitive, it's not doing well. It's getting drowned out. And you heard from our poll. It's all about NVIDIA.
Yeah, I mean, it's the one, what you would call affirmative story out there, where something is actually progressing, it's positive, we can seize on a trend. The rest of it is just exactly how much have we priced in already and how are we going to sell. But I would say, I was looking at, the equal weighted consumer discretionary, industrials, transports, all have the same look to them. They're kind of sideways heavy, but they're above their March lows. They're kind of hanging in there. And that's what the overall market is doing right now. I'm definitely on alert for some of the most overheated names in the crosshairs of the AI traders. NVIDIA down 4 to 5% off the high intraday.
Yes, it
You
is.
see a reversal in Broadcom. So
Marvell,
who knows
maybe?
if the fever breaks in the short term and AI, C3 AI, the stock, up 30% into earnings tomorrow. Let's see if that's a decisive one way or the other. And then to me, it's all about what the rest of the market does. The rest of the market's been kind of doing no better than hanging in there. And you still have more new lows than new highs. But it has netted out into this slow grind to a marginal pop above what we thought was the ceiling of the market at 4,200.
Marcy McGregor with us with her summer forecast from Bank of America, of course. So the rest of the market that Mike is speaking to just now, where do you see it going this summer?
I see a market that's really struggling to break out of this trading range in a decisive way. And I think Mike has a great point. It's about conviction or lack of conviction. When I think about the summer, you have an economy that's continuing to slow. I think data is going to confirm that as we get into the heat of the summer. And I think you're going to have a market where you really want to be diversified, you really want to be balanced and tilt up in quality because there's so many unknowns out there. With an economy slowing, that we have very likely the debt ceiling deal behind us. But that might remove liquidity from this market. So I think you get choppiness this summer, but I see it as a buying opportunity. If you have, call it a 2 to 3 year time horizon, have excess cash, I would be buying on volatility.
See, I go back to this. It's like glass half empty versus glass half full. Half empty says economy continuing to slow. Half full says economy remaining pretty firm.
Absolutely, and that's exactly what's happening here. It's almost like we're seeing these rolling recessions, first in housing, then manufacturing, but you have the consumer and the labor market that have been really resilient. Our internal data says the consumer purse strings are tightening up, especially in higher income consumers, but it's not falling off the cliff. And I think that gives me a lot of conviction in our view that this is likely to be a mild recession. I keep calling it a reset because the Fed is trying to slow the economy down. They will get their way. But I just don't see this being more than a reset when we get to the back half of this year.
What do you make? Have we gotten too top heavy? Does it matter to you or not?
When I see this market, which is certainly more concentrated, typically bull markets are fairly concentrated when the index is up year to date, but this market is really concentrated relative to history. The top 10 names are responsible for 100% of the gains this year. Of course, I want to see a market that broadens out to tell me a little bit about market health. That'll get me a little bit more positive. In the meantime, I actually see this flight to mega tech as another kind of search for quality, for the standout names in an uncertain world. So long term, I without a doubt think this AI moment is like the iPhone. It's like the internet moment. It's going to be transformative. But this is a long-term theme, not a trade in my view.
All right, Marcy, good to talk to you. Thank you for that. Frank Hollins watching some pretty important earnings after the bell in what we call overtime, HP, HPE, and Box. Frank.
Yeah, a lot to look at here. We're going to look at three very different parts of the tech universe. HP Inc., ticker HPQ, that's hardware. HP Enterprises, ticker HPE, that's software. Then we have Box, a storage player, ticker's just Box. As you can see here on the chart, all three are lagging behind the broader tech rally that's been largely focused on AI. So let's start with HPQ. The key metric there will be full year guidance. It was reaffirmed last quarter at $320 to $360 a share. It was first issued back in October as we saw steep declines in PC shipments. However, today, JP Morgan upgraded HPQ, forecasting a 21% increase in the second half of the year over the first half of the year when it comes to PC shipments. The CFO of Lenovo, that's the world's largest PC maker, also told me on Worldwide Exchange he expects a big second half rebound when it comes to PC shipments. All right, turning our attention now to HP Enterprises, ticker HPE. Compute is the key segment there. Morgan Stanley upgraded HPE today as a beneficiary of the macro trend of return to work. Compute's where it gets about 45% of revenue, and the performance here was going to answer a lot of questions about IT spending outside of AI. Remember, though, HPE also has a segment focused on AI and high-performance computing. Investors looking for any news about deals demand there. All right, last but not least is Box, that's storage. Two questions. Will AI disrupt this business and demand? Billings for Box give investors just a sense of demand. It's not the whole story. Estimates have that number rising about 5% year over year. A lot of questions about the future of storage with AI and the willingness of companies to spend on storage in this environment. with so much disruption right now, Scott.
Mike, how are you thinking about this? I mean, PC's bottoming. If we get a clue, IT spend, as Frank said, get some good clues here.
Yes, although the starting point is very different from a lot of the stuff we're talking about, which is these are companies, HP and HPE, priced for very little growth, if any, 7 to 9 times earnings. It's all value. Any kind of accelerant to growth is probably going to be considered a bonus as opposed to assumed. So a different starting point, but definitely interesting. I think it would be particularly fascinating to see if, let's say, HPE can catch the AI tailwind, which again is going to feed that idea that traders are just grasping for any way to seize on this trend and maybe stretching a little too far in trying to impute an AI story into where there isn't one.
Well, that's going to be the big thing now for every single earnings report as it relates to tech or anything else. How many times you say AI or try and convince the analyst community and the investor community that you are a player in AI in any substance.
And the question is, to what degree any of that is just additive, or if we're talking about roughly the same size pie and it's the AI that's pulling budget away from other things, that's probably going to be an issue for some of the software companies here. But it is funny because every single thing you bring up comes with a yeah but, right? Even coming into this year, everyone was leaning toward it's a recession. We got hot January data. They say, oh, that's bad news. The Fed's not done, right? We get the credit crunch, and obviously it's bad news, but it doesn't seem like it's actually blowing up into anything. And we get or maybe more dovish Fed than we anticipated, and that seems like more of a bad news story because we're waiting for the credit impact. And then fascinatingly, debt ceiling, it's a big overhang. We get through it immediately. Everyone says, uh-oh, watch out, massive Treasury issuance, yields are going up. My only point here is this is a pretty battle-tested market. We've been dealing for a year and a half with people expecting bad things, and they haven't all come to pass, at least not in a way that has shocked the market below where we got to certainly last October.
Hey, Jobs Friday. Don't forget about that, too. We got more data right in front of us, too, in this holiday shortened week. All right, there's the bell. S&P looks like it's going to hold on to 4,200. Dow's going to be modestly negative into the close. I'll send it into overtime with Morgan and John. I'll see you tomorrow.
For the major averages, that is the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Fort. Coming up this hour, we are watching software and hardware as we await earnings results from HP, HPE, Box, and Ambarella. We're going to bring you all of those numbers as soon as they cross.
Plus, we're going to talk to former Fed Vice Chair Roger Ferguson about his read on the Fed's next move as the odds of a June hike go up, plus his take on the debt ceiling deal. Well, let's begin with the debt ceiling. The House Rules Committee meeting this afternoon ahead of an expected vote tomorrow on the deal struck by President Biden and House Speaker McCarthy. Eamon Javers has the latest for us. Eamon, this is going to get out of the Rules Committee?
Hey there, John. We think it will, but take a look at these live pictures, and you can see the House Rules Committee is meeting right now. Republican leaders opened up the hearing by talking up the idea of compromise.
In a true negotiation, you always get less than you want and give up more than you'd like. But with the passage of the Fiscal Responsibility Act, we'll responsibly lift the debt ceiling and avoid a default that would devastate the American economy.
But there's been a lot of discontent among the most conservative members of the House Freedom Caucus about this debt deal. So we're watching this hearing to see if any of that causes problems for the bill. Some of the unhappy members have talked about the possibility of forcing McCarthy out of the speakership altogether. That made Speaker McCarthy defend the deal on Capitol Hill just a short time ago. Here's what he said.
How are we outsmarted? The largest cut in the history of Congress, the biggest ability to pull money back. We got work requirements for welfare where the Democrats said was a red line. We've got NEPA reform for the first time in 40 years. We took a Trump executive order for pay-go against the administration.
Now, John, this evening, the entire House Republican Conference will meet on Capitol Hill, and that's going to give McCarthy a chance to tamp down some of this grumbling from his fellow Republican colleagues. We'll see if that works. The vote could be on the floor tomorrow afternoon. We'll watch and see for it. Back over to you.
Okay. Eamon Javers, thank you for that. Let's bring in two more voices on this in the broader market. Joining us now is Unlimited Funds CIO Bob Elliott and Macquarie Group's Terry Wiseman. Good afternoon to you both. Bob, I'll start with you. I mean, the S&P basically ended the day flat, 42.05, but it was a mixed picture. How much is the market baking in and absorbing this debt deal and all of this now, I guess, hashing out, you could say, in D.C. among lawmakers?
Well, I think a lot of the benefit to the markets that came from the acknowledgement that the debt deal was going to finally come to fruition happened last week, and so I think in many ways what we're seeing right now is the market's taking a breather and digesting the actual news following a relatively sizable lift before. I think the more interesting part is the market action in the bond market, which really saw a pretty good bid today, which was interesting in the context, even quite a ways out the curve where there wasn't that much concern about immediate default the way there was in T-bills. And I think that reflects the fact that there really was some underlying concern in the bond market, and part of the sell-off that we saw in the back half of last week and recently was driven by debt ceiling concerns from a variety of different investors.
Yeah, Terry, we did see this relief rally in treasuries. I just wonder if it's going to be short-lived, because now all the attention is focusing on the Treasury general account and the fact that you're going to have to see this big issuance to refill the coffers there, and that's going to suck liquidity out of the system, and maybe therefore we see a lot more volatility in the bond market moving forward.
Yeah, well, first of all, I do agree that the more interesting dynamic is in the bond market and fixed income. Look, what's been happening over the last few weeks, I think, is that the traders, fixed income traders, bond traders, have actually gotten ahead of the prospect that there's going to be quite a lot of net new issuance coming out of the Treasury. Estimates range from anywhere from $250 billion to as high as $1 trillion to be issued over the next few weeks. They got ahead of this, which means this is the reason why Treasury yields have been going up so much over the last 2 and 3 weeks. In fact, you can see this by looking at the positions of traders reports on the CFTC. They show a very massive short position in bonds right now. Now, when I see a massive short position in bonds, I'm inclined to think, well, no, we might get a short squeeze here. It's very possible, even though we do get this massive amount of issuance coming out of the Treasury, the market is so short the bond right now that if they just normalize their positions, cover their short positions, we could see yields lower, not higher, despite the flood of this issuance. How low? Maybe the 10-year goes from 3.7 to 3.6 or maybe 3.5 before we finally get all of the short positioning washed out of this market.
Interesting. Bob, are the equity markets and fixed income positioned really differently right now, considering we've got these debt ceiling hopes and the AI excitement that was affecting some stocks today, but we also have a Fed that's looking more likely, a lot of people think, than a week or so ago to hike again in June, right?
Yeah, the Fed tightening expectations have really shifted considerably over the course of the last couple of weeks. You know, it wasn't that long ago when basically no expectation of a hike was priced in, and now it's more than 50%. And so you see that picture. And I think whether you look at the stock market or you look at the bond market, what we're seeing is both are indicating a recognition that the U.S. economy is continuing to plug along at a reasonable pace, a pace that is strong enough to continue to keep labor markets tight, and probably more importantly, strong enough to keep inflation reasonably elevated relative to the Fed's target. And so both stocks and bonds are reflecting that we probably need a bit tighter policy on a forward-looking basis than where we were just a couple of weeks ago.
Okay, Terry, does this, the multiples in equities right now, I know you said bonds are more interesting, but do they look like they reflect that kind of expectation that I guess inflation is pretty stubborn and therefore the Fed will have to continue to battle it? And how does the jobs number factor in, you think, to that percentage likelihood that the Fed needs to hike again in June?
Well, look, if all that's going to happen is that the Fed hikes and yet we don't see a recession or a significant slowdown in the economy, then yeah, you can easily make the case that stocks are fairly priced here. I think the decision on whether one owns stocks now or chooses to stay away should really turn on not on whether the Fed hikes or not. It's on whether when the Fed does hike, is that going to put the economy in a tailspin? We think it will. We're already seeing signs that the economy is slowing. I know that there's plenty of indicators out there that suggest that the economy is not slowing, but those tend to be coincident indicators of the economy. If you look at the leading indicators, they do suggest the Fed has already tightened quite a bit because they're signaling a recession coming. They are at very low levels right now. So I'd be concerned about the Fed hiking to the extent that I think it's going to cause a recession.
Okay. Terry, Bob, thank you. I do want to mention that Hewlett-Packard Enterprise, Ambarella, and Box are out. We are going through those numbers now. I believe still waiting on HP Inc. But now CNBC senior markets commentator Mike Santoli joins us from the New York Stock Exchange. What are you watching, Mike?
Well, John, initially, just a snapshot of where the overall market finds itself here. The S&P 500 had nosed above as of Friday, that 4,200 level. And there's just interesting upward grind, very kind of grudging action right here that has developed over the last several weeks. It's sort of like a mini shallow uptrend within this bigger, but still not particularly exuberant uptrend coming off of October. Now, as everybody keeps talking about, a lot of the upside does owe to a handful of very large market cap stocks, but also the rest of the market is not exactly falling apart, making new lows. So far, it's kind of a halting effort at making a new 9-month high. Today was obviously very much a indecisive type moment there. And take a look at one measure of exactly how split this market has been. This is called the CBOE Implied Correlation Index. It's basically the market's expectation of how much big stocks will move together as one or move independently. And right now, when this is very low, it means the market is assuming that it's going to continue to be one where stocks go their own way as opposed to herding in the same direction. And this right here is around November of 2021, which was the peak in the NASDAQ. That also was a very narrow rally. So just, take that for what it's worth, that oftentimes you will see a narrowing out of a rally before you get some kind of pullback action. But also, guess what? This is the stock pickers market people claim they want to see a lot of times. It doesn't mean it's easy to pick the right stocks, but it does mean that they're moving on their own factors as opposed to one of those big kind of risk-on, risk-off pendulum swings, guys.
Mike, is that a response to certain big stocks rally? I'm thinking about NVIDIA, which we've been talking about for the past few days. Is that in part what causes, that index to go down? Because, it's already moved separate from the rest, and I guess people expect that at this point it's more likely, and I could think of a few others that perhaps are more likely to move in a different direction.
Absolutely. It's a response to exactly that type of action where you have a relatively small group of big, consistent winners over a period of time, and then the rest of the market is not following along with it. So you have that along with the fact that it really has not been one of those huge macro-driven markets, not massive swings in yields and currencies and Fed expectations. Even though those things are moving at the margin, it hasn't really been the driving factor of huge swings within the equity market. So all that boiled together is people pricing in sort of this continued independent action among big stocks.
All right. Mike Santoli, we'll see you later this hour. Thank you. Hewlett-Packard Enterprise earnings are out, and Frank Holland has the numbers for us. Hi, Frank.
Hey there, Morgan. Shares of Hewlett-Packard Enterprise is down almost 8% right now after a miss on revenue. Revenue about 5% below estimates, but there was a beat on EPS. Profit 4 cents above estimates. However, its current quarter guidance is light on revenues with profit in line with expectations. Compute is the core business of this company. It saw a big miss. Revenue of $2.761 billion compared to estimates of $3.22 billion. Important to note, it has a segment that's focused on high-powered computing and artificial intelligence. That segment beat estimates with revenue of $840 million compared to estimates of over $801 million. So I got a chance to speak with CEO Antonio Neri. He told me in part there is strong demand for the company's AI offerings, and he expects a spike in business in coming quarters, saying in part, HP has unique intellectual property that allows us to deliver AI at scale and AI inference, and because of that IP, and the software to be able to run these models. Again, he expects more demand in the second half of the year. So also want to focus on two other quick things. HPE with strong beats when it came to gross margin, operating margin, key metrics in this so-called year of efficiency. But again, shares of HPE down big, down now 6.5% after a miss on revenue and a beat on EPS. There was also a raise on guidance, but obviously investors focusing on some of the misses here. Back over to you.
Yeah, Frank, high performance computing not balancing the rest out. Thank you. Ambarella earnings also out. Christina Partsinevelos has those numbers. Christina?
Yeah, the company posted a smaller than expected loss of 15 cents adjusted, which was a little bit better than what the street anticipated on revenues of 62.1 million. So we can call it in line. We can say it's a slight beat for the top and bottom line. But what we're looking at for Q2 revenue guidance, that range is coming in a little lighter than expected, between 60 and 64 million. The street was anticipating 67.2 million. So there is a stark contrast there. The company itself also saying in their press release that the cyclical headwinds persist and continue to put pressures on their financial results, but they're taking their inference AI strategy to the next level. Keep in mind that Ambarella makes system on a chip specifically for cameras, so they're used for high advanced cameras as well as those that are in cars. That is a larger market for them, but as we're seeing with these results thus far, Q2 revenue guidance coming in a little lighter. They provided a gross margins range too, but I have no number to compare. That would be 62.5 to 64.5% gross margins for Q2. So overall, revenues fell 31% year over year. Adjusted loss coming in at 15 cents per share, which is a little bit better than what the street was anticipating.
Yeah, big move after hours. That stock down, more than 13.5%. But that just, Morgan, takes it down to the level where it was on Thursday, the 25th.
Yeah, we've seen such a huge move higher in semi stocks overall on the back of NVIDIA, and the SMH certainly been testing some key levels because of that.
Yeah.
All right, well, after the break, we're exactly 2 weeks away from the Fed's June meeting. The odds of a hike are on the rise. We're going to break down those odds with former Fed Vice Chair Roger Ferguson.
And later, does NVIDIA's rapid rise to $1 trillion in market cap have echoes of the dot-com bubble? We're going to discuss when Overtime comes right back.
Welcome back to Overtime. Box earnings are out. Frank Holland has the numbers. Hi, Frank.
Well, hey, Morgan, shares of Box moving just about 3% higher right now after a beat on revenue and a beat on EPS. Profit was 5 cents above estimates. The company also posted strong beats when it came to margin. Q1 gross margin of 77.9%, well above the estimate of 76%. Also got a chance to speak with CEO Aaron Levie. He said he expects AI, it's a theme here, obviously, he expects AI to be a tailwind for the company as other companies need more storage for their AI capabilities and offerings. Also looking at guidance. When you look at full year revenue guidance, the revenue guidance was just slightly below estimates. However, EPS guidance was above estimates. The bottom end of the EPS guidance was $1.44 for the full year. That was the same as the estimate, top range at $1.50. So again, shares of Box beating estimates when it came to revenue and EPS. Shares up now 3.5%. Back over to you.
And Frank, it looks like the guide with the range between 260 and 262 might be a little bit better than the expectation of 260. So maybe a little bit better there on the revenue guide as well. Thank you. Now, the fate of the debt ceiling deal still up in the air as it awaits passage in Congress before the June 5th deadline. And a week after that, the Fed will be on the clock for its June meeting, with the odds of a hike ticking higher in the last week or so. Joining us now to discuss is former Fed Vice Chair Roger Ferguson. Roger, good to have you. Tell me how all of this data is lining up in your mind, and what kind of a wage number we need to see on Friday for folks you think to feel like a pause would be reasonable at this point.
Well, look, I think the data are lining up to show that inflation is remaining relatively sticky and certainly above the Fed's 2% stated target. You know, I think the wage number on Friday, to some degree, is not going to be driving these outcomes. I know the market will pay a great deal of attention to it, but it's just one of many, many pieces of data that have come in. And more importantly, therefore, it's important to see the bigger picture, which is that inflation itself is remaining relatively sticky. What does that mean for the upcoming meeting? Well, as you've observed, the odds of a hike in the market's mind seem to have gone up. I think that's a safe reflection. It's going to be a very, very close call. But even if they decide to take a pause now at this upcoming meeting, the market should not interpret that as being the end of this cycle of hiking.
Do you think they can afford to take a pause if Friday's number is hot on any of the reads, given the PCE number that we got a few days ago?
No, if the Friday number is hot, I think it's obviously reduces the odds of a pause. Even if they decide to take a pause, I think they're going to signal it's just to see exactly what the state of the economy is, and a pause is not going to be the end. So I think the market should be set up for maybe a slightly more hawkish Fed than had been expected maybe a couple of weeks ago, with either a move or what I would describe as a hawkish pause, i.e. pause just to see how things are playing out, not a pause that's a prelude to an end necessarily.
Yeah, we know all the turmoil from the regional banking situation of the last couple months is still wending its way through the economy and adding to tighter credit conditions, although the full impact has yet to be known. I wonder what you think, assuming we get a debt ceiling deal this week, I wonder what you think the impact is going to be of Treasury having to replenish its cash balance. You got analysts putting numbers out there of as high as $1 trillion of bills that are going to need to be issued by the end of Q3. And Bank of America has estimated that the impact that's going to have on liquidity in the financial markets could be the equivalent of a 25 basis point hike by the Fed. So again, another area of tightening that perhaps hasn't been fully appreciated yet. How do you see it?
I agree with that. I think there is some uncertainty. As I listen to colleagues, as I listen to friends and former colleagues on the board, as I listen to bankers, I think the question of how much credit tightening is still left in the pipeline is one that's a big question mark. Most people would say thus far we haven't seen dramatic effects from credit tightening. We expect some, obviously. You add to that the possibility of market-driven rates going up as the Treasury goes out to borrow. And so all of that might suggest some wisdom in taking a pause just to see how this credit tightening and higher interest rates play out over the next couple of quarters. So that's one of the things I think will keep the what I'm describing as a hawkish pause on the table. A recognition that more is to come in the credit tightening process. Probably not draconian, but it might be wise just to take a moment to see how that plays out.
I don't know if you've looked at it yet, but the San Francisco Fed put out a report looking at the impact of tight labor markets on core PCE inflation, and actually found in this report today that labor cost growth is responsible for about only 0.1 percentage point of recent core PCE inflation. As we have this conversation about the jobs report on Friday, about how sticky core inflation and services inflation is right now, and that it's becoming entrenched in the economy, is a loosening of the labor market going to be enough to actually bring that back down to a 2% target?
Not necessarily. I mean, I think part of the challenge is the the inflation rate appears to be stuck so far above 2% that it's going to be a very gradual and slow process to bring it back down. That's one of the reasons that I have been saying that the markets, I think, have been so disconnected from the Fed in the expectation of, you know, a reversal towards the end of this year, towards a loosening mindset. I think this inflation is relatively sticky, certainly above the 2% target. It's going to take some work to get it back down. And the question now is one of tactics from meeting to meeting. But certainly, I think markets should not expect a Fed to take a dramatic swing from tightening to easing. I expect, as I've said several times, for rates to be higher and held longer than perhaps the market has been expecting.
Yeah. A lot of different inputs to factor in here. Talk about data dependency. Roger Ferguson, thank you for breaking it all down for us. HP earnings are out as well, and Frank Holland, who's now doing triple duty, he has the numbers for us.
I mean, Morgan, they do call this show overtime. All right. So looking at HP Inc. shares right now, down pretty big right now, down about more than 1.5% after a miss on revenue, a beat on EPS. Profit was 4 cents above estimates. The company also raised its full year EPS. Part of this down move for the stock, however, might be the miss on personal systems. That's commercial and consumer PCs. However, there was a pretty strong beat when it came to margin, again, in that so-called year of efficiency. I spoke with CEO Enrique Lores, who forecasted a second-half upswing when it came to PC shipments. He also said the company is working with silicon providers and software makers like a Microsoft and a Google to change the architecture of PCs, building AI into PCs and AI processing capabilities. So he said if you're a small business, you have an opportunity here where you don't have to use the cloud. He believes that's a chance to what he called refresh the PC market going forward. But again, as we mentioned, shares of HP Inc. down more than 1% right now after a miss on revenue and a beat on EPS, even with that full year guidance raise. Back over to you.
All right. Frank Holland, thank you. Don't miss Jim Cramer's exclusive interview with HP's CEO. That is coming up at 6 p.m. Eastern on Mad Money. Coming up on this show, though, energy is among the worst performing S&P sectors today as oil prices tumble. We're going to talk about what's behind the move with Citi's global head of commodities research. Overtime. We'll be right back. Welcome back. Oil sliding today, down 4% with WTI dipping below $70 a barrel. First time in almost a month. This amid uncertainty over the debt deal and OPEC Plus talks. WTI is on pace for its worst month since September. Joining us now is Ed Morse, Citigroup's global head of commodities research. Ed, great to have you on. What do you attribute this weakness to?
Well, the weakness is based on flows that are de minimis. We don't see very much in the way of open interest. Open interest is about at 10 to 13-year lows, in fact. So very limited amount of move of managed money can have a very big impact on prices. A lot of people think it has to do with what's happening with the debt ceiling. I don't see that as a causal connection. I think there are a bunch of other things happening. We've had very weak demand growth year to date globally, weaker in China than expected, weaker in the U.S. than expected. We had kind of a very disappointing Memorial Day weekend when people do whatever they can and looking at mobility on an instantaneous database. I think that on the mobility side, on the one hand, and the chatter about an OPEC meeting coming up this coming weekend is what really has done it. And doubts that are in the minds of a lot of people now that OPEC Plus countries will do anything. So I think those are the two major factors at work: a weaker than expected market and chatter about OPEC having said they might do something, but probably not.
Do you believe that OPEC's going to do something? I know there's all these concerns about Russia oversupply, and you've got that country essentially trying to produce and export as much as it can to offset the economic blow that's happened there. But then we know the Saudis have been wanting to tighten and keep prices elevated. So is this really a sit on your hands, do nothing, OPEC Plus type of meeting, or could we be surprised?
Well, remember that it's not all of OPEC Plus. It's only really 9 countries altogether who are part of this agreement. It's all a voluntary agreement. There will not be 9 members in favor of a further cut. That's almost a guarantee. The question is who might cut and for what reason? And I think the reason will be where prices are when it comes to this weekend, where prices are when it comes to the close on Friday. If we see WTI at the $60 range and Brent getting closer to 69 than to 75, I really think that there is the likelihood of an incremental cut taken by at least 4 of the 9 countries that were taking part in the cut that was scheduled for May. But Russia probably is not one of them.
Ed, was there an expectation that Memorial Day travel would be even stronger than it was, or is this in any way reflective of expected demand slowdown in the second half with all this recession talk looming?
No, I don't think the second half had to do with it. It really was, we had a significant build of inventory globally with high-frequency data, more than 20 million barrels worth in the first 2 weeks of May. And then for the last couple of weeks, we've seen really significant drawdowns of U.S. inventories, including gasoline. So people were thinking that this was an indication that that we were seeing the driving season that was really reappearing before Memorial Day. The one doubt about it is the degree to which refiners were, putting oil into retail outlets in anticipation of Memorial Day. But the high-frequency data were much more disappointing than the flurry that we had for a couple of weeks about how U.S. gasoline demand is really looking good for the first time in a long time.
Ed, very, very quickly, you got some permitting reforms, maybe not as ambitious as expected. You got a pipeline poised to be approved with this debt ceiling deal. I realize it might not happen overnight, but how positive is that for something like, say, Nat Gas?
Well, the nat gas issue is that would be positive in a longer term period of time. Nat gas is kind of trapped at the moment. Yes, we've seen drilling coming off, but not off enough to keep us from keeping on producing more. Industrial demand is down, and the likelihood of us reaching tank top, so to speak, by the end of the injection season is looking high. We have reports about weather conditions with lower than normal temperatures, with a lower probability of a big hurricane season, with El Nino effects happening in the market. So the signs are that it's going to be a weak natural gas season coming up this summer.
All right. Ed, thank you.
Thanks for having me. Good to see you again.
Equitrans finished the day up 35% on that pipeline possibility today.
Okay, now let's get a news update with Bertha Coombs. Bertha.
Thanks very much, Don. The trial for Robert Bowers, a truck driver accused of killing 11 people at a Pittsburgh synagogue, began today. Bowers faces 60 counts in the 2018 shooting at the Tree of Life Synagogue, the deadliest anti-Semitic attack in U.S. history, and could get the death sentence if convicted. The defense attorney acknowledged Bowers planned the attack, saying he shot every person he saw in her opening statement. LGBTQ plus activists calling for new strategies to promote equality, with California State Senator Scott Wieners saying, quote, "You need to be our ally, not just when it's easy, but also when it's hard." This comes after Target said it had removed products and relocated pride displays last week to ensure the safety of its employees. And Goldman Sachs is preparing for another round of layoffs amid a deal-making slowdown, according to a source with knowledge of the bank's plans. The company is expected to trim less than 250 jobs in coming weeks. In January, the bank cut about 3,200 positions following an initial round of layoffs last September. John, back over to you.
Bertha, thank you. Up next, NVIDIA officially joined the club of stocks that traded above $1 trillion market cap after it rose more than 170% so far this year. But is that rapid acceleration sustainable? Mike Santoli checks the charts. Next.
Help.com.
Welcome back. Supermicro shares soaring again today, up almost 7% on new product announcements out of Computex and Taipei and some debt ceiling hopes probably. Supermicro has more than doubled in a month. It makes high-end computing systems, counts NVIDIA as a major supplier. I spoke to founder and CEO Charles Liang about demand for power efficiency along with these powerful AI-capable systems.
Lots of new product. That's why I say we work with NVIDIA very closely since 20 years ago. And Jensen has been my old and good friend for so long. So we work together very closely in leverage design, share, platform design experience. So overall, Computex, we have lots of new product announcement with NVIDIA. At the same time, liquid cooling. As you know, now all the CPU, GPU consume much more power. So our state-of-the-art liquid cooling solution will benefit to our customer, save their energy cost up to 30% or even 40%. So we have lots of customers really very passionate to move to liquid cooling. And we have a very good product line already with inventory ready to support our demand.
Liang said he's got some product areas that aren't AI focused getting pressured by the macro environment. This is important because it's reflective of what we just saw from HPE earnings minutes ago. There's AI centric high performance, and then there's everything else.
Yeah, and Supermicro we know has been trading right alongside NVIDIA. It's up another 7%, another fresh 52-week high today.
Yeah.
Well, let's get back to Mike Santoli for more on AI and the chips, and specifically NVIDIA's rapid climb. Mike.
Yeah, Morgan, and putting it into some slightly longer-term perspective, here's a 10-year chart of NVIDIA, and you have to keep in mind that fundamental momentum, stock momentum, are real phenomena in the market. It's not wise to always just take the other side of it just because something's gone so far so fast. The other thing I'll mention is here in 2020, let's say mid-2020, NVIDIA had the exact same price-to-earnings multiple as it has today, around 50 times earnings. In other words, the earnings and the earnings estimates have continued to soar. At some point, this is going to be too much, too soon in terms of upside, but who knows when. We did have a 60+% reset right here into the low of last year. So just keep that in mind. And over the last 3 or 4 years, we're up about 8 times in NVIDIA's share price. It's reminding me in some degree of the build out of the internet in the late 90s. Here's a chart of EMC, which is, I mean, largely forgotten. It's inside of Dell right now. But at the time, you had this compulsory big company buying of data storage, which EMC was almost the exclusive vendor of this particular type of equipment. And I remember at the time the reports of company IT managers saying, we wish we could stop buying your stuff. We can't stop buying your stuff. And what happened here from 97 to the peak in 2000, it went up by 20 times, from about 5 to 100 split adjusted. Now, I'm not suggesting this is going to be the trajectory. I don't know there's going to be the same kind of bust. Very similar chart, by the way, would be Cisco of this same time period. The point is, you just never know when an individual kind of consensus beneficiary of a massive trend has gone too far. And I'll just go back to saying NVIDIA, for as much as it might be overheated in the short term, the fundamental metrics continue to move in the right direction, John.
Yeah, very smart. Thanks for the history lesson there for traders, Mike. Up next, the top analyst tells us what he wants to hear on the earnings calls from HP and Hewlett-Packard Enterprise, which are coming up in just a few minutes. We'll be right back. Welcome back to Overtime. Let's get another check on two after-hours movers. HP beating on earnings per share, missing on revenues. Similar story for Hewlett-Packard Enterprise, missing on the top but beating on the bottom line. Third quarter revenue guidance a little weak as well. Joining us now is Evercore ISI analyst Amit Daryanani. Amit, let's talk about HP Inc. first, because I wonder if you see what I see in here, which is possible stabilizing in commercial, both on the PC side, commercial printing up 5%. Does this reflect some return to office and perhaps some return to commercial buying again of both PCs and printing in office?
Yeah, on the print side, definitely seeing commercial business starting to improve, which is a nice sign for them. You're also seeing print operating margins at 19%, I think are fairly strong. Signs that perhaps the commercial side is starting to stabilize. On the PC side, I think the headline revenues were like down 24-25%. The focus will clearly be, have we hit a bottom on PC? There's a lot of data points that suggest we have. And if that's the case, then I do think the back half story starts to get a lot more attractive for them as commercial starts to improve and you potentially start to get a bit more of a back to school seasonality in the PC side as well.
Yeah, and I should have mentioned, consumer personal systems was down 39% compared to that 24 in commercial, so not as bad. When it comes to Hewlett-Packard Enterprise, everybody's trying to tell an AI story right now, but there are degrees, it seems, to which different companies are actually benefiting from this AI rush. Is HPE's high-performance computing division really geared toward that? How are we going to be able to tell?
Yeah, so John, if you look at their high-performance compute business, right, it's really focused heavily on these supercompute clusters that are deployed by universities and big institutions, right? It really has typically not been this high-intensity, data-driven AI algorithms that are or models that are running out there, right? So I would say it's not the case today. The part you want to hear from them in their server business, their compute business was actually down 3-4 points year over year, and that's what missed, I think, street numbers by the most amount as their server business underperformed. The part you want to hear from them is what angle, what vantage point can they have to ramp up servers and perhaps even infrastructure for these AI workloads? I'd say maybe not as much on the high performance compute side. That thing I think is not really going to be AI driven, but more on the compute side, on the server side, can they start to have a story over there to provide, really GPU based servers for these companies that are deploying AI large language models right now?
So whether it's HPE or HPQ, looks like you have inline ratings on both of these companies. Would you buy either of them right now, given the results we just got, or something else?
Well, I would buy something else would be the short answer right now, right? I think there are better parts on the enterprise side, for example, networking companies that are doing really well. In fact, if you get HP Enterprise, their networking business was up like 50% year over year. So I do think the parts of enterprise spend like networking that are doing very well, so names like Arista or a Cisco or Juniper would do well. I do think of these names, the part you want to hear with HP Inc. is what does the back half recovery look like? If that starts to materialize in a more positive manner, I think this starts to become a very interesting free cash flow generating asset to own for the back half of the year. So I think that's the one that's closer to an inflection point potentially, or not.
Okay. Amit Daryanani, thanks for joining us on the heels of those earnings results. Well, up next, we will discuss why defense tech startups like Red 6 are taking off right now. Stay with us. Welcome back to Overtime. The debt ceiling deal includes a 3% increase to 2024 defense spending, in line with President Biden's budget request. For 2025, it's just a 1% top-line increase, which is short of some analysts' expectations. Perhaps the reason defense stocks ended the day either lower or flat. But investors are putting more money to work in defense startups. Take Red 6, which is closing a $70 million Series B round led by Redbird Capital Partners with the venture arms of Lockheed Martin, Boeing's AEI, Horizon X Fund, Disney, and others.
This technology has major use for defense applications, but it also has a number of other use cases outside of defense. And I think you're seeing increasing appetite for that now. And obviously the geopolitics of what's happening in the world right now really helps that. And I think investors are starting to really get behind that trend.
So Red 6 has developed augmented reality for military pilot training, with the U.S. Air Force expected to flight test its first plane with the tech in coming weeks. AR in the cockpit means simulated scenarios while flying with no need for a second pilot in a second jet, which is how training currently occurs. Now, to put this in context, founder and CEO Daniel Robinson used to fly F-22s. Every flight cost $100,000. So he expects the debt deal to get done and defense spending to keep growing, but says it can be tough working with the government and the Pentagon specifically.
As much as they are, working hard to embrace small technologies, small companies and advanced technologies, it is still immensely difficult for small companies to make their way through the behemoth that is the Department of Defense, and that is the biggest threat to us. And I would wager that every tech CEO out there that is dealing with the Department of Defense would echo those sentiments.
Now, Red 6 is focused on military for now, but longer term is working on applications for individuals, outdoors, interacting with their surroundings as one example, though Robinson wagers that that's still at least 5 years away, maybe longer, for the industry writ large. That said, he's, quote, waiting with bated breath for potential announcements coming out of some high-profile companies, and I can think of one that maybe we get an AR-related announcement just next week, John. Apple.
Yes, looking forward to Apple. Also, Microsoft had this deal with the military related to AR, and it sort of got panned.
The HoloLens deal.
Yeah. It seemed like the feedback from the military caused some headaches, wasn't really great for the environment.
Yeah, it's a multi-billion-dollar deal. They continue to move forward with it, but there have been, it is not the deal it once was thought to be, and the military, the U.S. Army specifically, has started to look at other options as well. I'd also just note, John, when we're talking about some of these companies like a Red 6 or even Anduril, who we had on a couple of weeks ago, these are dual-use technology companies, and Palantir is sort of the poster child for this template. It's up 90% this month. You want to talk about names that have been getting investor attention as AI plays? Palantir is very much one of those names, but also more broadly, just investing in the space. I mean, Catherine Boyle of Andreessen Horowitz on with us a couple weeks ago. This idea of American dynamism. It is, in addition to AI, and perhaps because some of these technologies, like a Palantir or an Anduril, involve AI, you're seeing funding here, even if the rest of the market is pretty dry right now.
Interesting stuff. All right. Still ahead, what to expect from tomorrow's debt ceiling vote, and why our next guest still thinks there's a 1 in 5 chance of a default. We'll be right back.
Another busy day on tap tomorrow. We got Salesforce reporting first quarter numbers. We'll also get results from Chewy and C3 AI. But perhaps the biggest thing investors will be keyed in on is, of course, this House vote on the debt ceiling deal. The Rules Committee is still meeting this hour. Joining us now is Terry Haynes, Pangea Policy Advisory founder. Terry, great to have you on. I mean, we've already had some lawmakers come out and say they're not going to support. How much of this is bluster? How likely is it that we do actually get a deal done this week?
Thanks, Morgan. I have it at 80-20 today, but I was, up until the beginning of May, I was at 60-40, 40% that we were going to have a default, and 30 after both McCarthy passed a bill and Biden agreed to talk about limiting the rate of spending increase. So I'm at 80-20 today, and that's just because there's a difficult combination of politics, votes, and the roughly 1 week left to accomplish this. But, I do think this gets done, but that's a little more than a trailing risk.
Okay. So saying that this does get done, how do you see it in terms of winners and losers? I mean, we mentioned the pipeline, the company behind the pipeline that looks like it's poised to get approval, and that stock surged 35% today. Is this shaking out the way we anticipated? Can Republicans, for example, say, hey, listen, we got a deal done that works for us? Can Democrats do the same? I mean, how do you see it?
Yeah, I think both sides get some things to talk about here. Traditionally, in spending fights, Democrats always hang on Republicans, the idea that they're going to have draconian cuts to this or that domestic spending program. And then when that turns out not to happen, Democrats claim victory. So that's good. Similarly, Republicans can talk about starting to turn the battleship around and limiting the degree of increase in spending. So that's good for them, generally speaking. For markets, though, I think this is rather muted right now. What people need to remember outside of things like the pipeline or energy, where both fossil and clean energy can point to wins, these are budget top lines, and what markets tend to react to are more the specifics on spending, where the money's going to go, to whom, and for what purpose. That won't happen until the spending bills this fall. So really, markets can say, well, we've got some certainty here on fiscal for the next 2 fiscal years, and that's good, generally speaking. But when Congress also has to fill in the details on spending in the traditional spending fights in the fall, one net negative out of this, frankly, is that those fights are going to be rejoined just in about 4 months at the end of the fiscal year. So, the fights about the specifics will continue, and I think markets will wait for more specifics before they go up or down on a lot of this stuff.
All right, Terry Haynes, thanks for breaking it down for us.
Thank you, Morgan.
All right, well, just getting a check on the markets, John, here. I mean, it was a mixed picture. The NASDAQ eking out a gain, the Dow lower, though.
C3 AI, as you mentioned, is going to report earnings, and it was up 33%. Today. Now, we've had Tom Siebel on quite a bit. It's a heck of a rise ahead of getting some numbers reported. And it's interesting. People tend to say that this is a stock that's been overhyped. Look at where it was 3 years ago.
All right. We're going to be watching that one closely. So much more. That's going to do it for us here at Overtime.
Fast Money begins right now.
Right now on Fast, a monumental May for tech. The AI trade driving massive moves in NVIDIA and semis, but the good vibes also washing over names like Tesla, Netflix, Amazon, and more. So is this rotation into tech going to continue? What happens to the other once hot areas like energy and staples? Plus, split decision while U.S. and Chinese government officials are talking about decoupling. A host of U.S. businesses are trying to strengthen their bonds with Beijing. But will rising tensions between the two nations cause more pain than profit? And later, Carvana's back from the brink turnaround, Salesforce's big run ahead of earnings, and a bold call from Wells Fargo saying bank stocks are cheap. I'm Melissa Lee. This is Fast Money. We're live at the NASDAQ market site. On the desk tonight, Tim Seymour, Dan Nathan, Karen Feinerman, and Guy Adami. And we start off with the AI-led tech boom on Wall Street. What else? Chip stocks continuing the rip higher, with NVIDIA topping the $1 trillion value mark for the first time intraday. Broadcom also hitting a record high during today's session. It's now up 18% in just the last 3 sessions. Megacap tech also getting a boost. Apple, Microsoft, Alphabet, Amazon, and Meta have added a combined $775 billion in market cap just this month. But a rising tide hasn't lifted all boats, while the S&P Info Tech sector is up over 10% in May, on pace for its 5th straight month of gains. Crude oil and energy stocks are down nearly 9%. Defensive plays like utilities and consumer staples also dropping. So what does this say? That the great tech rally is coming at the expense of certain stocks. Where are we in this market, Tim?
Well, we've seen it before. We've seen it during periods where we've questioned growth and we've been worried about the macro, and we've seen mega cap tech outperform. You could take it back to 2018. We could take it back to 2016. I know Dan's pointed this out, way back when we were younger men and women here. And I think but I will continue to emphasize what I think I've been saying on, as long as Qs and semis continue to go higher, the market's going to go higher, and that may not be healthy for market breadth, but it is what it is. And so, and what happens is you first hit your relative outperformance to the S&P, or your relative resistance, which the semis went through. We talked about that last week, and then you hit all time. So semis right now, if you look at the SMH, I think the all-time high was 160, so that's about 8% away. If you look at Qs, we haven't hit our relative high against the S&P, which is about 3% away. I think they're going through it. And if you look at the all-time highs on the triple Qs or the NASDAQ 100, it's around 400. So Microsoft was the first of the mega cap tech stocks to do it. Apple then followed, and you go down the line. Amazon is the farthest away, and Google a little bit better than they are. So there are places, if you're following that playbook, I do think that that's what's going on. The rotation that you talked about has been extraordinary as well. Safety of staples, safety of at least resilient discretionary, safety of healthcare, which makes sense in the market where you have this kind of narrowing of breadth and you're worried about the macro. I think you're going to get that trade again, but I think those trades go lower. XLP, I think, has another 5 to 10% lower.
Listen, if you're buying this AI trade right here, right now, today, okay, you got here for the death rattle. And I'm just saying this because what sparked this rally
Can I ask you
here?
one quick question?
Sure, it's your show.
That's true.
Yeah.
Why am I asking the question? Okay.
But you're polite.
But
so.
would you have said that 2 sessions ago?
No, because this is a blow off top. Okay. Broadcom, Avago, whatever the hell it's called, it sold off 12% from its all-time highs today. Look at that. It's an epic blow off top there. If you look at NVIDIA today, this is the 3rd day since they guided up. This is the important part here. Okay. For this quarter right here, they guided a quarter that was consensus $7 billion in revenue. They guided to 11. So a $4 billion beat. Okay, and raise, essentially, if you think about this, caused a $500 billion rally in a handful of stocks that are all the only ways that you can play this. Now, there are other ways that you can play this. I think you could buy a stock like C3 AI that John Fort just mentioned. That's a $5 billion market cap company that was up 33% today. Okay, so there's goofy stuff going on here. If you are not paying attention, and alarm bells are not going off in your kind of wrist sensors here, this is for long people. Now, I'm obviously caught a little short some of these. I'm not naked short these, okay? I buy puts. I said this on Thursday. That's good money after bad, okay? So I'm making like defined risk bets against a bubble, and trying to do that is a really hard way to consistently make money, but I'm trapped here a little bit, so I'm doing this. But I'm just kind of like trying to highlight the fact that a $4 billion raise to guidance sparked this sort of rally. It seems fairly unnatural here. So I would also say it's also not a consistent way to make money buying things like this, especially when everything else we talked about. Look at what's going on in small caps. Look at what's going on in energy. Look what's going on in staples. Look what's going on in financials. And I could keep going here, people. I could go to resources. They are actually saying that things are slowing and the market is not reflective of what's going on in the economy here or possibly globally.
But maybe those things are not, they don't preclude.
They will be, Mel. No, I'm just telling you, I can take it to the bank. They will all.
Maybe the economy is slowing. Maybe there is a global slowdown underway, but maybe this is the area that will have this spend, Karen. Maybe this is maybe this spend, this CapEx spend on AI, because everybody is forced to do this, will spur this next round of cap spending for the tech sector. What do you think?
Yeah, I think so. Not shockingly, I don't fully agree with Dan. I think that analysis, it sounds really great that $4 billion has sparked a $500 billion rally. It's not really, I don't think, the right way to look at it. It's 1 quarter, a $4 billion beat on their way to, as Jensen Huang talked about, a $1 trillion infrastructure that needs to change right, over the next, I don't know how many years, that's a very different calculus. And I think that, yeah, is there a lot of hype in a lot of the stocks? For sure. I mean, it's reminiscent of, you know, a 3D printing bubble or some other bubbles. But in terms of the AI bubble, I think that it will become a bubble. I don't think it is yet. I think there's more to go. I feel like we're early-ish on. And I mean, you know, just if you look at what they announced, not even their earnings, their new supercomputing ability, that's the cloud on steroids at the beginning. And so, you know, could it trade down 30 or 40 points or up 30 or 40 points? Yes, it could. But I think there's a lot more runway than just what happened in the last 3 months unwinding. I don't believe that that's the end of the story.
Here's what our friend Savita Subramanian over at Bank of America Merrill Lynch put out this morning. Here, AI spend will likely occur within a broader CapEx cycle in automation, reshoring, green, et cetera. This is a new bull case for stocks. Guy, do you buy that thinking?
Well, I mean, that's been the thinking. And, you know, it looks like, I'm not saying she's coming to consensus, but there have been a lot of people in that camp. It is a fascinating argument. You know, what I would push back and say these stocks are being rewarded for it, but then I would answer the question you asked Dan. I would have said that 2 weeks ago, 25, 30% ago, so that's wrong. In terms of just the way the stock's traded, we talk about panics to the downside all the time, and clearly that happens. But what you saw specifically in Broadcom today, I mean, that stock traded $921 effectively on the open. To Dan's earlier point, it gave back more than $100, traded 5 times normal volume. That's not a natural move. I mean, something weird is going on. And again, NVIDIA, we said it for a long time, it's an extraordinarily important company, but one has to ask, are they already being rewarded for all the things we're talking about? I would submit yes, but again, I would have said that $150 ago, Mel.
Yeah, Bloomberg quoted Jensen Huang, the CEO of NVIDIA, who's giving a presentation in Taiwan and saying it's too much. I know it's too much regarding the accretion in the market cap, Karen. At what point do you, I mean, as a value investor, it almost surprises me that you still have NVIDIA, but at what point do you say, you know what, it is too much and I have to start pairing or you know, increase the rate at which I am pairing my position?
Well, okay, is that for sure what he was referring to? The too much was related to the stock, or too much now we're offering you this other product that's extraordinarily expensive to use and everyone's going to want to use it. So you know what, you're probably right about that, but I just feel like I can't trade around this, and I don't think it's over. So that leaves me with holding it, knowing that it could be extremely volatile. I can't make it a giant part of my portfolio, but I really do think we are in the dawn of another era. How much of this is reflected in the dawn? I don't think we're going to look back when this is all said and done and say, today, you know, May 31st, 2023, it was fully reflected in the stocks. I don't think that's the case.
I just take a more pragmatic view on the market. I look at semis that outperformed the S&P by 30% even before we knew NVIDIA, you know, was going to make these types of announcements. I mean, I'm talking about from that CPI low in October through the end of March. And some of that was also a function of what happened with SVB. We know SVB, there have been different catalysts for mega cap tech stocks along the way. And they always include a market that is concerned a little bit about growth. And I know we argue, we get concerned about these multiples on a Microsoft or on an Apple. But I mean, Microsoft's up 21% since earnings. Microsoft obviously on some level started some of this whole hysteria around AI with their ChatGPT. But I mean, you know, Apple right now is nearing an all-time high. Is this an AI trade? It's not. I mean, they may come out and say something, but I take it just a more simplistic view that semis are always leading the market, and semis were doing this job in a significant way before we even started pricing a lot of this in.
So we're having a show here today. It's the last day or second to last day of May of 2023, penultimate. And so penultimate day of 2023, and we're going to have a conversation that's very reminiscent of January, February of 2000. We're going to have a conversation we talk about banks and some of the regionals that's very reminiscent of kind of March of 2008. March, April 2008, and I've just heard some things that are really reminding me of that, okay? So the last stock to tick $1 trillion was Tesla in November of 2021. And really, we could have said a lot of the same things that we were saying about AI, about autonomous and all this sort of stuff then. And the stock lost 75% of its market value until January of this year, okay? So all of this stuff can happen. These conversations that we're having about this technology, next week, Apple is having their Worldwide Developers Forum. They have been using a thing called Siri that is based on artificial intelligence and machine learning for 10 freaking years, okay? So these are investments that they've been making. There's a product that a lot of people think sucks, okay? And if you're telling me that this H100 chip that Jensen Huang is telling everybody is going to need to have is going to make it finally good, well, then I'm taking the over on that because we've been using it for 10 years and it stinks, okay? They've been buying the most advanced chips for 10 years. They've been developing the most advanced chips for years using their own R&D budgets to do that. I think Microsoft's been doing this. Google's been doing this. Amazon's been doing this. I agree. Tesla's been doing this. Okay, so my point is,
Meta's been doing it.
Meta's been doing
this. In fact, Meta is probably as better positioned as any of these companies, and especially when you add in their reels and some of the things.
Yeah. Do you remember November of 2021 when what's his name, Zuckerberg, renamed the company the Metaverse, and this was going to be the next thing, and it almost was a $1 trillion market cap company, and then it lost 80% of its market value.
Because he doesn't have to talk about the Metaverse right
so all
now.
I'm saying is, how about it, people? Go buy your Nvidia right here at a $1 trillion market cap. If this ends up being a 1 or 2 quarter phenomenon, because every major company and every small crappy company has to do this, and then they realize that they overspend and the opportunity to commercialize it is not here, and then they pull back like the metaverse spending, or they pull back like Web3, or they pull back like crypto. Okay, we've seen all of this in the last 5 years.
I do see a scenario in which
it's different. Tell me why it's different.
No.
Okay.
I was going to actually acknowledge that there might be a scenario here where companies are going to front load some of their spend on this, and so the comps will get more difficult a year out. But that's a year out.
Sure.
And the momentum
so the market
here.
discounts the future.
I just think I'd like to bring it back to the market, which to me, we're looking at it in phases and in sequence of where we thought the market was going to go in the face of very difficult macro and whether it's recession, whether it's at least the Fed's 500 basis points, maybe another 25, the market's pricing in higher rates. None of this is good for equities. I think I'm looking at the market that I'm being given here, and it's telling me triple Qs are going higher. And if Qs are going higher, S&P is going to hit 4350. And it's not because I think that the world's become, a safe place. I think there's a lot of risks out there that are underappreciated. But I also think that you look at how short professional community is on S&Ps. You have record shorts on an S&P E-minis. You have some concern on sentiment. You certainly have people that are more in cash, I think, in the professional community than the retail community. That, to me, is the kind of stuff that when people are expecting this headwind, takes the markets higher. It's not going higher forever. I'm just saying I see the market that's in front of me, and I see the Qs and semis are outperforming, and until they stop, the entire market gets taken higher.
That S&P short number is a fugazi. Okay, what did we hear? We heard Tepper, we heard Druckenmiller, we heard Steve Cohen all in the last 2 weeks talk about they're all in on this AI trade, and they're probably short up the wazoo S&P future.
It could be a lot of things. Well, yes, of course you're hedging yourself.
We're seeing YOLO
I'm talking
calls.
about CTAs who are directional, and they are as underinvested in S&Ps.
But it's momentum.
Well, that's
so they're long all this crap, and they're short
the momentum
S&Ps.
is to the upside when they have to buy back.
The momentum in the S&P has not been to the upside. It's been trading in a range for 7 weeks in this really tight range with a really low VIX.
Listen to me. I'm telling you that the market will go higher if semis and Qs go higher.
I would like
and
to
the
ask Karen a
technicals
question.
are telling me that they're going higher.
Karen, I want to ask you a question. You're bullish Nvidia. You're bullish this spend cycle, and so this is making you bullish the S&P.
Yes,
it does.
Well, I mean, just mathematically, it kind of has to, right? If the whole tech sector trades up, then that pulls the S&P. But I do think it's at the expense of a lot of other industries. And so does that, I don't know how to answer that then. Mathematically, yes. But are there other things, probably things that I own that are not going to be particularly well received? Yes. So, a name like United Rental, which I own, which I think is cheap. I like the story. I love the team, all that. I could see that not really trading particularly well. So that's not a great black or white answer to your question, but I think there's sort of a gray. Technically, yes.
I accept gray.
But it's not a monolith.
Right. Guy, for the next 6 months, would you rather be on the momentum of the AI trade or search for value in the sectors that are suffering now because of this?
The The latter, I think. So I would say the latter. And listen, Tim's been spot on with this, so I'm not going to argue with him. But I got to believe we're getting a little long in the tooth here. So I would search for that. Listen, the things that have failed in the wake of this, healthcare has been under pressure. Obviously, energy, retailers. I mean, Target, I think, traded down to a 6 or 7 month low. Walmart hasn't traded particularly well. So I think those stocks are sort of being thrown out, and everybody's flocking into these names, which, again, I understand the reasons why. If there's opportunity, money will find opportunity. My concern is there's a euphoria going around that's unsustainable, and the stocks that are being sold are ones you actually want to try to get back into. I don't think the energy trade is over. I think popular belief sort of belies that if you look what's going on in the underlying commodity. But I'll say this. There is an OPEC meeting coming up, and I think they're going to turn the screws in a major way. So we'll see what happens on the back of that.
Yeah, and I just want to make one last point. All those names, all those situations we talked about, just as they overshot to the upside, they have the tendency, they all overshot to the downside. That is the risk, is that you're buying up here and you make a really catastrophic mistake.
Well, the market's next big hurdle may be the May jobs report due out on Friday. Let's bring in CNBC contributor Peter Boockvar, Chief Investment Officer at Bleakley Financial Group. Before we get to that, Peter, I want to bring you into this conversation that we're having, very heated one on the desk. When you take a look at this market, is this trying to tell you something, this huge boom in AI at the expense of industrial, staples, materials, et cetera?
Well, two things. If you look at, let's isolate the 8 companies from the 492 and then throw in the 2,000 and the small cap Russell. Well, those 2,500-ish companies are customers of those 8. So you can't have the 8 going up like this while their customer base are experiencing their own weakness. And with respect to extrapolating the AI craze and to think that this is going to be great for the broader economy immediately, and this is the beginning of a takeoff in the stock market. Well, the Apple iPhone was initiated in 2007. That wasn't the best buy signal for the broader market, and it certainly was no tell on the broader economy.
Okay. Let's talk about the jobs report now. What are you expecting, and is this going to give the Fed any reason to pause here?
So the estimates right now are under 200,000, and if the case, it would be the second month in a row below 200,000. The last time we saw that pre-COVID was 2019. I thought noteworthy was in today's consumer confidence number, where we saw weakness in the employment figures. In fact, those expecting more jobs over the coming 6 months fell to the lowest level in 7 years. So I do think that there's risk to the downside. But again, the Fed wants to see a weaker labor market. I think the Fed is pausing, regardless of what Friday's number is. And Friday's number is backward-looking anyway, so any central banker that's going to base their decision on Friday's number is really bad rear-view mirror type analysis.
Peter, it's Tim. So speaking of rear view, I mean, let's look back at the banking crisis. I was looking at your notes. I agree with you, and that we're probably the impact of SVB and the retail bank, the regional bank run is 100 basis points. Where do you think the Fed is in terms of their ability to really forecast this? And I think I know the answer, because there are many different forces that I do think are negative for the economy, and I think ultimately are negative for stocks. But right now, the Fed, if anything, has been talking rates higher. They've been talking up Fed fund futures. There's no sense, we had 120 basis points of cuts before the year end. If you asked us 3 months ago, now you're down about 15 basis points. So where do you think we are in the Fed's thinking?
I think humility is very important here. Since SVB collapsed, we've had 50 basis points of rate hikes, and based on some estimates, the credit crunch and / contraction is the equivalent of an additional 50. So you've had essentially 100 basis points of rate hikes since SVB collapsed. Just humility should tell you that the Fed should take a pause. And I'm not saying that they stop raising interest rates. I'm not saying they need to back off from this inflation fight. But wouldn't it be prudent from a risk management standpoint to take a step back? Because to your point, Tim, we don't really know how this is going to play out over the next 3 to 6 months. And if you don't really know, why would you then go raise interest rates? Shouldn't you raise or make a policy decision like that based on more confidence than looking at, okay, what's happened in the data today, which is reflecting what's already happened in the economy?
Peter, always great to get your thoughts. Thank you.
Thanks, Melissa.
Peter Bookvar, Bleakley. Peter had a really interesting note out this morning about the other sort of side effects of this debt deal, liquidity coming out of the system, which could mean tighter conditions. Also, people who have student debt, which seems like almost everybody out there, will start having to pay that debt a month sooner. And JP Morgan's economist came out saying that that is going to reduce consumer spending because the average monthly bill is somewhere along the lines of $393 a month. I mean, that's sort of meaningful, Karen. I'm just wondering how you sort of put this all together here for the economy.
Yeah, I mean, we've already seen pressure on sort of the lower end discretionary dollars. And so you got to think the overlap between lower end discretionary and student debt is pretty high. So I think it will probably be, how can it not be exacerbated, which I think is your point.
Yeah, I mean, Guy, maybe that goes to your, what did you call it?
He needs a
ugly. What?
I was going to ask Guy if he needed a tissue, possibly.
I know, Guy's playing
I
hurt
have,
today.
I actually have a tissue right here.
A single tissue. Let's hope there's a box there too.
No, well, somewhere.
But maybe that goes to your target chart, Guy.
Yeah, and the retailers, exactly. Target is 6-7 month low. I think the consumer, again, will spend money until the market gives them a reason not to. But, these things are happening very fast, and I think we're blinded by the euphoria around a very specific area. It's obviously driving the broader market up, but below the surface are things to be concerned about. And, oh, by the way, 2s, 10s, that yield spread that went down to below 50 basis points is back up to close to 80 basis points. And, again, people say it's not a big deal. It's a big deal. So the warning signs are there. Again, the market flow of funds is choosing not to acknowledge it.
Coming up, streaming surge. Netflix hitting up 52-week highs. Investors keep binging. Is this name the crown for your portfolio?
Oh, boy.
Or could stranger things happen? And Carvana shares driving higher after a rough year, but is there enough gas in the tank to keep going? We'll debate that when Fast Money returns.
looking at.
Welcome back to Fast Money. Investors binging on shares of Netflix today. The stock hitting its highest level since February 2022 after analysts at Bernstein touted the advantages of paid sharing. The streaming giant is now up 33% this year. So this gets to, I guess, paying instead of giving out that password for free in your household, Tim?
The call by the street, and I think it's the right one, is that the percentage of the people that were sharing or borrowing or stealing or whatever you want to attach to this are going to pay for some plan. And what that means for Netflix. This is all coming at a time when their competition isn't even going through anything like this. It's easy to say this now. It wasn't at the time when we thought that Netflix was saturated and they were growing their sub growth. These are catalysts to the stock. They're not things being done out of weakness. There's a lot of people using Netflix that never paid for it. The competitors are, if anything now, pulling content, reeling in their budgets, figuring out how to tidy up the bottom line because the top line's not enough. So that's why Netflix continues to go higher. It's up 28% from early May. So again, a part of the mega cap tech complex that has its own fundamentals that I think makes some sense here.
Yeah, it's sort of funny to think that the knock on Netflix in the early days was its content spend and overspending and levering up the balance sheet to do that, although its interest rates were basically at 0% during that whole time. And here we have competitors, and they realize that they too need to spend on content, but they can't afford to do that right now, so they aren't. So there's really wounded competitors out there, Dan, in terms of the Netflix story.
Yeah, I mean, listen, the street consensus for the out year for 2024, has, I don't know, like 29% earnings growth. So it's trading at about 27 times next year's 29 expected % earnings growth. I mean, that's about as cheap as it gets. For Netflix, I'll just mention this, though, where the stock's trading right now, it's really right back at that level where it was trading when it broke out in 2020 during the pandemic, when it became very clear that they were going to be the earliest pandemic winner. And I think it's important to remember that they're expected to earn maybe close to $2 more this year. So that was the kind of multiple compression that we've seen. It overshot to the downside. It's going to be a continual theme here for the next few months, people. This is a stock that was down 75% after it blew out to the upside, that sort of thing. So to me, I don't find it really compelling here unless you want to try to really drill down and glean what this password sharing, what the ad-supported stuff, what the competitive issues mean for the stock. It's right about at the midpoint of the range over the last 5 years, and it trades at a reasonable multiple if you believe in that 2024 consensus estimate.
Where are you, Karen, on Netflix?
I'm with my dog. Sorry about that. Where am I? I'm long. I can't argue that it's cheap. But I think Tim sort of touched on it. When you look at the competitive landscape now, and you look at Netflix balance sheet, at what kind of shape it's in, versus who are the big competitors? Disney, they have a balance sheet problem, right? We know that. Paramount, balance sheet problem. Discovery, balance sheet problem. And so they're really in, a pretty good position right now. So is it a little expensive? Yes, it is. But I think I think in the shakeout of the streaming story isn't over yet, and I think Netflix will emerge stronger for where they are right now. So I'm hanging on to it.
All right, there's a lot more Fast Money to come. Here's what's coming up next.
Carvana on cruise control. Shares reaching their highest level in months. But can the stock's U-turn continue? Plus, Beijing business. Elon Musk, Jamie Dimon, and other CEOs landing in China, even as tensions with the U.S. ramp up. The impact on your money ahead. You're watching Fast Money, live from the NASDAQ market site in Times Square. We're back right after this.
Welcome back to Fast Money. Shares of Carvana getting a huge boost today, climbing nearly 17% for its highest close since February. The stock has nearly doubled this month and is up more than 280% from all-time lows hit in December. It's a real head scratcher here. Karen, are the bonds trading any better?
The bonds are trading better. I think they have a bond deal that expires tonight for the closest in bonds. But if you look at some of them, like they're I don't know, 5 or 6 years out, that's trading at an 18% yield, that paper, which is telling you the bond market is pretty concerned about this as an ongoing concern. And you might think, well, okay, if the stock goes up, they can issue more shares, but the equity, the market cap is still pretty low at $2.5 billion. It is worth noting that the short interest is absolutely enormous. And so it could spike for sure. But and they've been trying to lever everything up that isn't nailed down. So they've been doing a good job of staying alive. And if you stay alive long enough, things could turn. But I wouldn't be a buyer.
Just live to another day, right? The short interest, according to FactSet, is showing up at 57% of shares outstanding, Tim.
Yeah, and it's come in a lot, but if you look at where the short interest was at its peak on the 52-week, was around 29%. I'm seeing it around 24%, or well north of 50% as a percentage of the outstanding float. That has a lot to do with what's going on. Karen, who is our resident bond girl, by the way, because she's the one that usually talks about it, so there's more than like double entendre there. You have a case of where I think you've seen a lot of great move here, but ultimately she pointed out that the equity, there's a limit. But you're following the credit markets on this story, and that's been the right thing to do.
Yep. Coming up, the China trade, the latest on rising tensions as top business leaders visit the country and how it's impacting your money next. Plus, Salesforce earnings on deck, and option traders are betting big ahead of the report how they are playing this name when Fast Money returns.
Get your trades to go with the Fast Money Podcast. Catch us anytime, anywhere. Follow today on your favorite podcasting app. We're back right after this.
Welcome back to Fast Money. Stocks closing virtually flat as investors await the passage of a tentative debt deal. The Dow falling 50 points, down for the sixth time in the last 76 sessions. The S&P up less than a tenth of a point. The Nasdaq managing to eke out a gain up 0.3%. And a couple of after-hours movers that we're watching. Box jumping after beating on the top and the bottom line. HP falling after posting a beat on earnings, but revenues falling short. And HP Enterprise also lower after a revenue miss. Meantime, Elon Musk is expected to make his first trip to China in 3 years this week. The Tesla CEO reportedly meeting with the country's foreign minister to discuss expansion plans. And he's not the only U.S. exec making the trip. J.P. Morgan CEO Jamie Dimon speaking at the bank's China conference on Wednesday in Shanghai, while Morgan Stanley is holding a China-focused event in Hong Kong this week. This even as calls for decoupling between the two countries grow. Our next guest says it's too early to quit on China. Let's bring in China Beige Book CEO Leland Miller. Leland, great to have you with us. Too early in what sense?
Well, I think the too early is about giving up on the Chinese recovery. You know, traders had it wrong from the beginning on this. There was a lot of excitement back when the COVID zero Band-Aid was pulled off in November and December. And there was this idea, oh, well, the economy's reopening. Yes, the economy's reopening, but it was not about to reactivate. And so December and January and February, these were months that were never going to show recovery. People were getting sick. Hundreds of millions of people are getting sick. You know, the COVID zero structures are being broken down. So the idea was always, look, Q1 is going to be rough. As we start getting to March, probably April, then we're going to start seeing the potential for a real economic recovery. I'll say that we just got our May data in. Our May data are much better than anything that we had been seeing with the government's reporting for April. So we're seeing some of the green shoots of this recovery, and it's something worth watching, not yet giving up on.
There's also the misconception that it would be the consumer driving the recovery, and China's never been a consumer-led economy. It's been a manufacturing-led economy, Leland. So I think that's part of, you know, sort of the idea that it should have been a faster bounce back. But I do want to talk about the CEOs in China and whether or not that relationship can be repaired. Is it possible to have the two capitals, you know, have tensions, but at the same time have the U.S. CEOs wanting to do business in China?
Well, it's possible, and it's certainly been what we've seen in the past, but it's getting tougher and tougher. I mean, the reason that Jamie's over there, the reason that Elon's over there is that they see an opening right now during what China has announced is, you know, the year of welcoming foreign investment in China, 2023. It's supposed to be a big year for that. At the same time, China has launched its large crackdowns of foreign businesses. They're regulating data flows outside the country. They are not being very hospitable to foreign investment or to foreign businesses. So there's this natural tension that as the U.S.-China relationship deteriorates, you know, what do we do? How much do we push back? You know, what signals do we send? And right now, it's a very confusing situation for CEOs. They're trying to do all they can to try to patch up the sinking ship, but you know, it's tough right now.
Leland, so you pointed out that in your note that you think the party's crackdown on foreign firms in China is quote unquote risk level rising. And you've pointed out that you think the economic risks are really the opposite, or that if anything, I hear what you're saying. I agree with that. In fact, I think if we think about a world where China growth in the mid 5% and 5.6, 5.7 is the upside compared to where we were 10 years ago, this would have been a disaster. This is actually very bullish right now, and I think that's bullish. But how about China's crackdown on their own firms? Like that to me is the biggest part of this. And I look at, whether it's the K-Web, I look at the FXI, which has underperformed the S&P by 72% in the last decade. It's China's treatment of their own companies and corporate governance and those macro risks that I think are a lot more important than the economy.
I agree. These are, this is what people are looking at. They're looking for signals from the government. Does the government want to do business? Is the government looking for growth? Is the government looking to incentivize innovation in its economy? And you look at what's happened for years now with the big tech firms. You look across the economy and you see a lot of worrying signs that what Xi Jinping's economy is doing is sort of battening down the hatches. Maybe not for kinetic conflict, but for economic conflict for sure. So, look, there's a lot of mixed signals being sent. The rule in 2023 should be we are going to see a better bounce back. It's too early right now. Q2 numbers can still beat estimates for the Q2 GDP print. But also, it is the longer backdrop here is a structural slowdown. So when you're investing in China right now, you have to think, do I catch the cyclical bounce back in 2023? Do I acknowledge the long-term structural slowdown that's going to be the norm going forward? How do I evaluate political risk? How do I evaluate this real geopolitical risk that's ramping up? It's a lot harder to do business in China right now than it's ever been.
Wow. Leland, thank you for your time. Appreciate it.
Thanks for having me.
Leland Miller. I'll just go straight to you since you are known as the ambassador, you know, amongst
That's the name they gave me.
And family. Yeah.
Yeah.
Well, how do you assess all of those things that Leland was talking about? Geopolitical risk, the bounce back that people aren't really factoring in right now.
I think American CEOs have been able to do business in China for a long time without the environment that we have today. But I think American CEOs in non-strategic sectors are going to continue to be a place that China wants those companies, because I think on some level China is more concerned about their own consumer, and obviously they're more concerned about social control. But I think we're all acknowledging that environment has changed. I still think that what they're doing to their own companies is a bigger issue. And I think the minute we get more all clear, like at least some of the signs we're seeing around Alibaba, let's see some of those spinoffs go okay. Let's see some of the listing standards not tighten, but actually loosen up a little bit. That to me is more important. But I think the macro and the economy in China is something that you want to invest in at this point relative to where it's been over the last 3 years, which has been a disaster.
Dan?
Yeah, I mean, like, look at the way the Shanghai Composite acts over the last few weeks. Look at the way the FXI. I mean, it acts like something else is going on. It feels like a growth scare. You started off the show by talking about some of those periods we had in 15 and 16, where when China really looked like it was slowing. And let's not forget, 4.5% GDP in Q1. If we have fits and starts in Q2 and really never get going, it might not be the engine of growth that a lot of, I think, let's say, markets in the West are kind of pricing right now. And I think that has kind of been built into the 2023 story, at least in the stock market here, and it doesn't seem to be materializing.
Coming up, Salesforce on deck to report earnings tomorrow. Do options traders have their head in the clouds on this name? We'll head to the pits for the action next. And later, financials in focus. One top analyst saying everything but the kitchen sink was priced in. We'll debate that call ahead. More Fast Money in 2. Welcome back to Fast Money. Salesforce hitting a new all-time high ahead of tomorrow's afternoon earnings report. Option traders are betting the cloud giant could see a big move when the results cross. Mike Coe's got the action. Mike?
Yeah, Salesforce traded more than 3 times the average daily options volume today. Right now, the options market implying a move of about 9%. Calls were outpacing puts, and the busiest of those were the 240 strike calls that expire at the end of this week. We saw nearly 4,200 of those trading for about $3.30 a contract. Buyers of those are betting that that same implied move will be to the upside.
Guy, what are you thinking about CRM?
Valuation's probably cheap historically, but still trades like 1 turn from a market multiple. It's had an unabated run since December. You know, my sense is I think you take profits into this number, not add to a long position.
All right. Mike, thanks. Mike Coe. For more options action, tune into the full show. That's Friday, 5:30 p.m. Eastern Time. Coming up, why one top analyst is doing this when it comes to the banking sector. You won't believe your eyes. The details and much more when Fast Money returns. We're following some headlines right now. So we have just these headlines that Japan has issued an evacuation order for residents for what could be a ballistic missile fired by North Korea. The warning is specifically for the Okinawa region. South Korea is also warning Seoul residents to prepare for possible evacuation. This is what we know right now. As soon as we get more on this, we will continue to update you. Meantime, moving on, top banking analyst Mike Mayo is out with a note saying financials are headed higher as too many rate, recession, and regulatory risks are currently priced in. His top picks, J.P. Morgan, Citi, U.S. Bancorp, Bank of America, State Street. He put on the blindfold, saying that people are, they don't know what they're doing. Bank investors are basically blind because they don't see that some of these banks are really pricing this in. Karen, I'll go to you on this.
Well, ironically, I'm blind too. I can't see you at all, but I do like Mike Mayo, and I do like banks, right? JP Morgan is my biggest bank position. I think, the price to book, the price to earnings, he talks a lot about price to earnings, under 10 times. The price to book here is well below its 5-year average at 1.8. And so I think there is an opportunity. I've thought that for a while. The SVB fallout at the moment seems to have died down, but they're really the beneficiaries of that. The deposit fee is outstanding for them, and I think they're going to also get a lot of additional business. So I like them. I'm long, staying long.
Yeah, as you see there on the screen, he likes the biggest banks, so JP Morgan and Citi are his picks, Tim.
Well, I'm long JP Morgan and Citi as well, and I've been long them both for a long time. And you can pick your spots on the banks, and you can pick whatever charts you want. I mean, you can look at banks year over year or JP Morgan, and it's effectively flat to the S&P on a 1 year. So there have been periods where banks have had this extreme duress for obvious reasons. We haven't gone into a credit world, and I'll just tell you, that's a pretty ugly place for banks. But I think you have an environment here where clearly there's been trades within here. And the regional banks have clearly priced in recession, have clearly priced in the dynamics that are a credit dynamic. The problem here is, and some of the most sophisticated investors in banks, and these guys tell me this, you cannot analyze a bank run that can be triggered with the world of pressing buttons and digital kind of post-market activity. So that's the problem here, because that's still hanging out.
Yeah, well, as long as the Fed speak remains as hawkish as it has, we've seen the 2-year come back up, and we heard about relief of these mark-to-market losses, these held-to-maturities that a lot of these regional banks have. And granted, yes, there was tremendous efforts to kind of suggest that those losses will be backstopped and that sort of thing. But the cost of further FDIC insurance comes at the feet of the large banks. And Bank of America, Citi, Wells Fargo, they don't act well. They are much further off of their recent highs than, let's say, JP Morgan. So Karen's point about JP Morgan, everything comes up roses for JP Morgan. Everything else looks like it sucks for the rest of the banks out there. And the regionals, they are like waiting for another shoe to drop, in my opinion, especially if rates go higher.
Is there another shoe guy, you think?
Feels that way. I mean, BKX has been cut in half since January of 22. It's bounced probably 10% since the May lows, but it's not a really meaningful bounce. And the KRE at one point today was pretty significantly lower, bounced late in the day. The banks are telling a much different story than the broader market, and I do think there's another shoot, especially with the way the bond markets continue to trade. The MOVE index continues to go higher. 2s, 10s, as we mentioned, is widening out again. I think something else is going to happen in the banking sector relatively soon.
If there's another shoe to drop, what we saw before, Karen, was we saw a flight to the biggest banks, and so they benefited as the biggest and the strongest and the beneficiary of deposit flow. But is that over? So the next shoe to drop is just bad for the sector overall?
Well, if there is another shoe to drop, then you're going to see the same thing. I think you're going to see a flight of more deposits to the big banks again, right? One of the things that has helped the KRE is that some of these banks have come out and said, we actually gained deposits in the last few months, and that's been good. But also one thing that the KRE stocks have that the big banks don't is a bigger percentage of commercial real estate. And we have to see that clear up a little bit. That's sort of a big obstacle in the short term.
You look at some of the exposure these banks have. Karen's right to bring that up. I look at JP Morgan on the charts and I say, that's a bank that's been struggling to get through 145 for a long time. I think if it gets through there, that's kind of your key technical place. It's been dancing around there. But right now, the environment we're in, the markets have had a great run. And I think you're going to have to test that again.
All right. Up next, final trades. Final trade time, Guy.
Palantir might be the real winner of this AI battle, Melms.
Get some chicken soup in you, Guy. I mean, geez. Karen.
Yeah, you know, I'm gonna follow Mike. Blind leading the blind, I suppose, but I do like JP Morgan even right here. I'm a buyer.
Tim Seymour.
Netflix, we talked about it. I think the thesis is that these changes that they brought about, I think they can do out of strength, not out of weakness. Where it is on the charts, 400 is a key level to get through, and I think we have to watch that, but I think it gets through there.
Dan.
Really want to give me this much time here?
It's kind of risky.
Yeah.
20 seconds.
What's interesting, Nell, that we, I actually like the TLT here. I think that like longer term yields can come in. I think the 2-year can stay bid here, and I think that's probably the way this plays out.
You're not an angry guy in real life.
No.
You're perfectly fine.
Markets are emotional people.
Today. That's
oh, really?
Yeah. Thanks for watching Fast Money. Mad Money with Jim Cramer starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CBC or tweet me at Jim Cramer. You stray, you lose. That's the defining feature of this market, because if you stray from a small portion of the tech complex, you are going to be destroyed. Today, very difficult. Dow shed 51 points. S&P ended up 0.07%. The NASDAQ advanced 0.32%. There it is again. We spent a huge amount of time talking about a very narrow group of winners, some of which you might be lucky enough to own. Information technology sector up 34.8% for the year, led by, yes, NVIDIA, the king, up 174%. AMD up 93%. Salesforce up 65%. The communications services sector up 32%, this time driven by a handful of winners like Meta Platforms up 118%, Alphabet up 40%, Netflix up 33%. Third, there's the consumer discretionary group. That's rallied 19%. It's led by Tesla, up 63% for the year. It's a who's who of artificial intelligence and friends of cornucopia of companies that benefit from extremely fast semiconductors, just a small smattering of winners amid a host of losers. In short, this is indeed the subterranean homesick market, because you don't need a weatherman to know which way the wind blows. Yes, it is that narrow. And that's why I want to break out. I want to do something very different from what you heard all day. Today I want to focus on not just the winners, but the losers. The losers, the raggedy rest, to show you what happens when you do stray from tech and what you end up in. More important, explain why so many sectors have become minefields. Let's go through the S&P 500 sector by sector. Energy is the worst performing group. It's down 11%. Easy to understand why. Both oil and natural gas prices have been obliterated this year, including one more horrific day today. So, of course, the fossil fuel stocks have been killed. It would be weird if they weren't. Apache down 31%, Halliburton down 24%, Devon down 24%. Next, the utilities, which do poorly when interest rates go higher, because they tend to be dividend stocks, and these dividends now look less attractive versus bonds. Utilities are off 9% for the year on average, led by AES, distribution company, down 31%. Dominion, a traditional utility, down 18%, worried about the dividend. Eversource, another utility in the Northeast, down 19%. Normally, the utilities are terrific recession-proof stocks, but if you invested like the Fed's going to throw us into a recession, as so many say, you've been crushed in these stocks. Healthcare, right in the crosshairs of the government, down 7% for the year. Organon led the way. That's the women's health spin-off from Merck. It's off an astounding 31% for the year. Then there's the great Moderna, down 28%. Hey, post-COVID hangover. CVS, same problem, off 28%. So much for its diversification and other forms of healthcare beyond the pilferage cursed drugstore chain. I'm actually shocked that the financials are only down 6.5% for the year, given that the regional banks have been disasters. Comerica down 44%, KeyCorp down 43%, Zions off 41%. These are all casualties of the collapse of Silicon Valley Bank and First Republic. This group is so bad, you got to wonder if they can even bottom when the Fed finishes tightening. So far, the only financials reflect the bad, not any good. And so the yields are unsafe. The earnings are clouded by supposedly inevitable recession, though that recession never seems to arrive, despite the Fed's endless rate hikes. Waiting for Godot situation. Real estate, off 3.5%, heavily influenced by the persistence of remote work. big office building owner, Boston Properties down 28%. Alexandria Real Estate off 23%, and then a host of others jockeying for third, too close to call. It's another cursed group made even more painful because the real estate investment trusts used to have trampolines of high yields underneath them. But with interest rates so high, especially on the short end, those dividends offer very little protection. What can I say? Businesses just don't need as much office space as they did before COVID. Not with so many people working from home a day or two every week. Next, we have the consumer staples. They're down 3%. Archer Daniels Midland, agricultural processing company, falling 23%. You think Archer Daniels would benefit in an environment with so much inflation, but when you drill down, the worst inflation is in housing and wages. Everything else has cooled, in some cases dramatically. Then there's Estee Lauder, which we own for the Charitable Trust. Has them good lately because their fortunes are linked with China. China's been a disastrous theme as the reopening's gone much slower than expected. Finally, there's Walgreens, down 20%, which is frantically trying to imitate CVS's decision to go all healthcare, not just pharmacy. Horrendous results so far. To be fair, it's not liking their plans. Look, they can't do any better than CVS. Then there's the materials sector, down 2.7%. That's led by CF Industries, a fertilizer stock, off 27%. Followed by the once pristine International Flavors and Fragrances, which has been decimated by bad management, causing its stock to fall 25%. And then there's another fertilizer play, Mosaic, which has lost 24% of its value. The FERTs, as they're known in the business, have been stalwarts of the great agricultural boom that occurred when Russia invaded Ukraine. Breadbasket of Europe, 13% of the world's calories went offline. Once the ag supply chain got sorted out, though, the group collapsed. Finally, we've got the accursed industrials. They're off 3.5%. The worst is a company called Leidos. That's a government consultant that many consider to be a very smart defense company, down 25%, thanks to fears that there might be defense cuts in the debt ceiling deal. Next is 3M, which has 2 giant lawsuits against it, causing it to fall 20%. 3M's fabled dividend aristocrat status hasn't deterred sellers. And then there's Northrop Grumman, also off almost 20%. That, too, is about the budget deal, I call it the non-deal, with investors fleeing from defense contractors for fear of spending restraints. Now, when we look back at the first 5 months of the year, we can only conclude that if you wandered away from the very small part of tech that's a funnel, you underperformed. All of this is to say that 2023 is the turbocharged opposite of last year. The market's so narrow that if it weren't for ChatGPT and the recognition of what artificial intelligence could be worth, the averages might be having a terrible year. As it is, tech's so strong that it's allowed the S&P 500 to rally 9.5%, even as not much else is working. In fact, if you looked at an equal weighting of the S&P, where the return on every stock has the same contribution to the index's performance, you'd have a down year, down 0.35%. It's arguably the best year if you're a tech investor, or the worst year if you're concentrated in anything else. It's so bad that you have to wonder if this disparity can really continue. We trimmed some tech this morning for the Charitable Trust. You can look at our reasoning by joining the CNBC Investing Club, and I urge you to do so. The bottom line, we just feel too darn greedy not to take any profits in tech. That said, though, straying from tech might continue to be the kiss of death in this market, at least until we get a cooling in the trillion-dollar colossus that is NVIDIA, the undisputed leader of 2023. Tyler in California. Tyler.
Hey, Big Booyah from California. How you doing, Jim?
Booyah, back at you, Tyler. What's going on?
Real quickly, I'd like to give a shout-out to my son, Landon. Daddy loves you. My question is regarding Salesforce, CRM, going into earnings. How's it looking?
Okay, I think that Salesforce has a really bright future because of what's known as Einstein, which is their predictor that uses a lot of artificial intelligence. So I actually think that even if it isn't good, I'd like to add to the position that we sold if it gets really hit. We have a nice position in the Charitable Trust. I still expect good things out for the year. Let's go to Mike in Illinois. Mike.
Hey, Jim. Thanks for taking my call. I'm calling in regards to Portillo's. I'd like to know your opinion on whether or not the stock is worth buying.
All right. Sure. I mean, look, I'm going to give you 2 answers. One, the company is worth investing in. But 2, the shareholders who were part of a private equity, private going public, have decimated the stock. They've got to stop selling. They have to. That stock could be at 30 if they would just stop selling. Look, straying from tech might continue to be the kiss of death in this market. We still get a cooling in the trillion-dollar colossus that is NVIDIA, the undisputed leader of 2023. On Mad Tonight, last week, while all eyes were on Cramer fave NVIDIA, there was another semiconductor player that wowed Wall Street with its AI plans. Don't miss my exclusive with Marvell Technology. Learn more about what's in their pipeline as the stock continues to be on pace to have its best month since 2001. Then, I've been telling you that I think there's a good chance that Wall Street's being too negative here. So where should we go to get a read on the prospect for economic growth? I'm going off the charts on a precious metal that's not as precious, that's more of a industrial metal. And HP reported after the close. And with a host of headwinds facing the PC market, how did the company fare this quarter? I'm getting the latest from the CEO, and it's not what you expect. Stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
everybody's still talking about last week's amazing blowout quarter from NVIDIA. But you should know there's another semiconductor company that reported a great quarter last week and saw its stock soar. I'm talking about Marvell Technology, which makes chips for AI, cloud computing, storage, the data center, 5G networks, and even the auto industry. When Marvell reported last Thursday, management gave very bullish guidance on AI, saying it's a $400 million opportunity this year and then an $800 million opportunity next year. And that's based on real orders and real prospects. You can understand why Marvell's stock shot up 32% on Friday. Can it keep running? Let's check in with Matt Murphy. He's the president and CEO of Marvell Technology. Get a better read on the quarter and what's next. Mr. Murphy, welcome back to Mad Money.
Yeah, Jim, hey, thanks for having me back. Appreciate it.
So, Matt, this was a rather astonishing quarter and an amazing conference call. And I'm going to give you the floor to explain it because there are a lot of people who seem confused in the call. You made a couple acquisitions. You may not have thought that what could happen did happen. You even gave it a forecast that was much below what ultimately happened. But things change rapidly. And your acquisitions turned out to be brilliant in retrospect. Tell us about that because it really has changed the company dramatically.
Sure. Thanks, Jim. Yeah, it's great to be on. And if you think about it, the story that really got a lot of attention and people excited was our story about AI. And if you go back, actually, in 2019, we did an acquisition of a spin-out of Global Foundries, which was prior IBM, called Avera, which got us custom chip design technology and a team that knew how to do large-scale custom compute ASICs. In 2020, we acquired Inphi, which had excellent technology for optical interconnect for data centers, both in AI clusters as well as in traditional cloud infrastructure. So these have been years in the making. We always knew that AI was an important application within the cloud. Our view historically was that was one of many exciting things that we were working on. But I would say since December, with the release of ChatGPT from OpenAI, everything changed. And so really the big reveal and the big discussion in our call last week was that we quantified the amount of revenue that Marvell was getting from AI. And the numbers are pretty big. They're much bigger than people thought. It was about $200 million last year. We said it was going to at least double this year, and then at least double again next year. And I think that insight that we provided to investors was quite helpful and encouraging and probably better than people thought.
Well, what kind of compound annual growth rate is that?
Well, if you take 2023 to 2025, our fiscal years, which would be calendar 22 to 24, that would be 100% compounded growth rate. If you went back to calendar 21, the revenue was like sub 50 million, so it would even be a higher growth rate actually off of 21. So it's growing quite nicely, and quite frankly, there's a lot of upside potential to this because things are moving so fast, especially since January, February, as the AI momentum has taken off, and we see cloud CapEx spending, moving more and more towards AI from traditional cloud infrastructure. They've got to make room in the budget, and our content opportunity is significantly larger in these AI systems versus traditional cloud infrastructure. Both are great opportunities, but AI can be bigger.
Well, how much of that is because the current is really 95% CPU, 5% graphical GPU, and it's going to flip entirely, which uses a huge amount more of space, basically, of what you need?
Yeah, that dynamic is finally getting understood. In traditional cloud infrastructure, CPUs and traditional processors were the main form of compute, with accelerated computing being a smaller portion. And I said in my prepared remarks last week on Thursday that was basically inverting, okay, a 180-degree shift. And so the bulk of the opportunity now in AI systems is accelerated computing with the standard processors being more for control. That creates a big opportunity for Marvell on our custom side, but it also just drives tremendous amount of computing power, which then requires high-speed networking technology and connectivity technology done in the optical domain, and that's really where we shine, both on the networking side, but also emerging in the custom compute side.
I don't mean to slight the others, because I know there's much that is troughing and going higher, but your outgoing chairman, Rick Hill, who is a friend of mine and my family's, did either he or you ever think that in the last 4 months, this true bonanza could be upon you?
Well, I think, thanks for mentioning Rick. He's our chairman of the board. He helped recruit me into the company 7 years ago. He's going to be retiring, by the way, Jim. I think you and I have talked about that at the June meeting. What a career for Rick, a true industry legend, and tying it back to the opportunity in front of us. Quite frankly, Rick has always been an optimist, and he's a technologist by nature. And he's been lockstep with me and the management team on everything we've been doing. So while maybe the magnitude of the change has happened, I mean, Rick's a visionary, right? So he's none of this is surprising, but maybe just the speed at which it's happening. But he's been there shoulder to shoulder with the management team, really having our back since day one. And so we helped build this company, to address what we call the data infrastructure opportunity. 7 years ago we started, and look where it ended up, Jim.
Well,
I mean,
Matt,
basically you have AI infrastructure as the biggest opportunity.
But are they going to spend?
That's
are these
existed.
companies going to spend? The big companies that we need to see spend, are they going to turn it on? Because Marvell's going to get a lot of it.
Oh, it's already turned on. I mean, you can see that from our friends over at NVIDIA, which had an absolute blowout guide for next quarter. We see the CapEx plans shifting meaningfully inside these companies as they prepare their own plans. I'm talking about the large cloud companies that we do business with. And so we're adjusting our plans as well, because as AI scales, right, we have significant content in those systems. And so now it's really a great opportunity sitting in front of us. And quite frankly, the demand shift, I said in the call last week, the backlog forecast and revenue outlook, even for this year, has gone up meaningfully just in the last 3 months. Wow. And I think even on a daily basis, we're seeing just a tremendous amount of activity here, both on the current business, Jim, but also I would say on the design win pipeline and funnel of opportunities that we're addressing. So it's not just a one cycle thing. This is, I think, a multi-year opportunity for us and a scarce few companies in the chip industry to participate.
Okay, well, Matt, I want to congratulate you and, of course, Rick Hill, your outgoing chairman. Rick's done an amazing job. Matt Murphy, president and CEO of Marvell. MRVL, the move is for real. Thank you so much, Matt, for coming on Mad Money.
Yeah, thanks, Jim.
You heard what he just said. These are, look, it's just breakthrough, okay? It's breakthrough. Let's leave it at that. Mad Money's back after the break.
Coming up, is copper a showstopper? Kramer goes off the charts on a metal that's heating the kettle. Next. Pro.
Even though we've got a hoped-for deal on the debt ceiling, at least in theory, the fact remains that economic pessimism is rampant. Hardly anyone believes in the U.S. economy because any sign of strength is just seen as another reason for the Fed to keep tightening, ultimately perhaps throwing us into a recession. We're worried about China, too, especially now that they've got this terrifying new wave of COVID, though the Communist Party seems reluctant to lock everything down again. Still, China growing at low single digits? Hard to believe, but true. Still, I think there's a good chance that Wall Street's too negative from here. Let me tell you why. Well, first, actually, I don't even want you to take it from me. Let's go to the charts. Let's go to the charts with the help of Carly Garner. She's a brilliant technician who's the co-founder of DeCarly Trading. She's the author of Higher Probability Commodity Trading. She's our resident commodity expert, and she's someone I completely believe in. 3 weeks ago, Garner told us to ignore all the negative headlines, simply focus on the fact that we got a weaker dollar, which is very good for the stock market. Sure enough, wow, we are up nicely since then, even though the last few weeks have been, let's say, full of some big picture misery. So now let's talk about the most important bellwether for global economic growth, and I like the story she's telling. I want to talk about copper. This is the metal you need for new construction, which is what makes it such a good barometer for the economy. After catching fire earlier this year, copper futures have now pulled back from $4.35 to $3.66. That's a vertical collapse for the red metal. Yet Garner's not discouraged by the recent sell-off. If anything, she thinks the same themes that allowed copper to work earlier this year, before the collapse, should only let it keep running. We've still got a weaker dollar. We still got a decline in interest rates volatility, both of which are good for commodity prices. This is really important, guys, because I think a lot of people don't even pay attention to copper. That's a mistake. Take a look at the weekly chart of the copper futures. Although it's certainly complicated, all right? Garner points out that copper's been in an overall uptrend since early 2020, once we started getting over the COVID crash. Copper tested the lower end of this trading range back in the summer and the fall of last year, and now Garner says it's happening again. Based on both the trend line and the 200-week moving average, she thinks copper's got a floor of support around $3.60. Right there, we're at it. Down a few cents from where it is, actually. For her, the floor represents the difference between a bull market in copper and a bear market in copper. That said, if we get a temporary breakdown to below that key level, but ultimately copper bounces back and puts in a weekly close above $3.60, she would still say bullish. We are at what I like to call the fulcrum level for this commodity. If the price of copper can't consistently hold above its 200-day moving average, then that's what we're looking at right here, okay? If it can't hold above this, well, then she says her bull thesis is wrong. We could get a quick probe down to $3.30, even maybe $3. That would be terrible. That said, she sees that kind of pullback as a buying opportunity. Why? In large part because of the relative strength index. See, that's the RSI. That's an important momentum indicator down right here. It stands at 40, which is not quite an oversold reading, but it's definitely on the cooler side, which tells Garner that the bulk of the selling in copper might already be behind us. See, if it weren't, it'd be all the way up here. Okay. How about the shorter-term daily chart for the July copper futures? Even here, Garner sees signs that copper's due for a rebound. Based on the July contract, the trendline floor of support comes near 355, all right here. Down 5 cents from the floor in the weekly chart. While copper's currently trading below its 200-day moving average, Garner thinks that this could be a temporary breach. If copper can pivot and rebound above its ceiling resistance near 370, then vault over the 200-day moving average around 380, she says the resulting upward momentum could be enough to overwhelm the bears. At the same time, the relative strength index, well, that's tumbled all the way down to 30, and before rebounding is now trending higher. Okay, so bottom there and then going up a little bit. According to Garner, we saw similar action in the RSI in the middle of last year, right before we got a big rally. More important, check out this weekly chart of the copper futures with the CFTC's Commitment of Traders report data at the bottom. This shows the net future position of various groups of investors. Garner likes to watch the large speculators, the green line. Okay, that's all the way down here, because that category represents institutional money managers. Historically, when large speculators all crowd in on one side of a trade, they tend to be dead wrong, because any given move needs to convert new adherents, or else it runs out of fuel. And it's important to find new adherents when virtually everybody already agrees with you. Right now, Garner points out that large speculators are net short, and that's what this shows you right here. They are net short copper by a pretty substantial amount. That isn't necessarily a buy signal, but she thinks it both limits the potential downside and multiplies the potential upside if things go in the right direction. And again, we're betting against these people right here because they're leaning too far one way. Next, take a look at the seasonal chart of copper. You'll love this. Now it does at any given point in the year historically. Gartner points out that copper tends to find a low in late June. Okay, we know that's not that far from here, right? But the bigger up moves generally tend to come in the fall. Still, right now, the seasonal pattern is definitely on the side of the bulls. Now, why do we even care about copper prices? Again, this has always been an important bellwether commodity. Over time, copper can help you predict where the global economy is heading, and that matters to the stock market. If you take a look at the closing prices of copper futures and the S&P futures over the last 180 days, they tend to close in the same direction about 60% of the time. In the past, the correlation was much stronger, though. But we're in a weird moment right now with the war in Ukraine and all central banks all over the world desperately raising interest rates to quash inflation. Still, take a look at this monthly chart of the S&P 500 futures in green and the copper futures in red. I thought this was really indicative of what could happen here. Except for the period from 2014 to 2016, copper and the stock market generally move in the same direction. Gartner also points out that while peaks in copper tend to be slowed away on the stock market, bottoms in copper either immediately precede or almost directly coincide with bottoms in the stock market. When copper's bottomed in the past, the S&P 500 is followed within 3 months or less. For example, when copper found its floor last year, that was 3 months before the market bottomed last October. 3 months before the market bottomed in 2009, we got a bottom in copper. If we're looking at a similar timetable this time, as long as copper holds above $3, Gartner says stocks should either trade sideways or work their way higher, because it's very rare for the S&P to go down while copper prices are hanging in there. Of course, lately copper hasn't been doing that hot because China's a huge consumer. They buy roughly half the world's copper, and the Chinese reopening post-COVID hasn't been going as well as many people thought, including me. But as Gartner sees it, commodity traders got way too bullish into the China reopening. At this point, those exuberant speculators have mostly thrown in the towel. By the time they're done selling, Gartner thinks copper can start running again, and that's virtually, as we saw, within about 30 days. Here's the bottom line. The charts as interpreted by Carly Garner suggest that copper could be in much better shape than you think. And if copper's ready to run, that's a very good sign for the seemingly beleaguered global economy and those who are betting on a worldwide recession. Dory in New York. Dory.
Hi, booyah.
Booyah, Dory. What's
How are
up?
you, Jim?
I'm good. How about you?
I'm very good. I'm watching your show almost every day.
Oh,
and I
thank
just
you.
have a question about the stock with the NUE, Nucor.
Nucor. Okay. You know, let me take it from here. Here's the problem with Nucor. This is the best of the best steel company. But if we're going into recession, no one will want to own the stock, even as you and I both know it's a terrific stock. So what happens, and we own some of these for our charitable trust, is that you can't jump in ahead. You have to wait. It doesn't look like it has, it looks like it's come down big from its top, right? Because it has been much higher. But the fact is, even though it's at 182 and it's now at 133, it could go lower. I would wait until it goes lower to do some buying. How about Randy in Pennsylvania? Randy.
Jim, booyah!
Booyah! What's up?
Jim, my late father and I watch your show all the time. It means a lot for me to be on the show. I want to talk to you about gold and gold futures, and also Fly, Eagles, Fly. We have Sports Talk here every Tuesday. This is the greatest day of my life. Sports Talk, and now speaking to you.
Oh, you're way too kind. It takes my breath away. I mean, you know, we got a lot of soul searching. What am I still doing? And the answer is I'm doing it for you. That's what's happening. Now, gold is problematic. You would think it'd be going up, given the fact that we're supposed to be in such an inflationary role. But that's what you buy as a hedge. But the fact is, no one really knows what to do with gold these days. And we're not sure whether there's inflation, deflation, which is really rather remarkable. So people are just abandoning it. I don't. 10% of a portfolio, I believe, should still be in gold. I've not changed since we started the show. And thank you for the kind words. They are really sensational, especially after the 3-day weekend where we had a lot of soul searching. All right. The charts observed by Carly Garner suggest that copper prices could be getting ready for a big run. That is surprising. And it's a very good sign for the seemingly beleaguered global economy. Maybe it's not so beleaguered after all. Much more Mad Money ahead, including my post-earnings exclusive with HP. As I said at the top of the show, if you stray from tech in this market, you lose. So is there room in the tech space for a stock like HP? Oh, boy, we're going to talk to the CEO. Then today, NVIDIA became the first trillion-dollar semiconductor company. So what's the secret sauce that led one of my favorite stocks at this moment? No one's talking about it. I'm going to detail what's really happening. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. All right, what do we make of these numbers from HP Inc., the iconic PC and printer maker? Here's a stock that's been on a roll this year. It's up 15%. Wall Street figures that we're close to working through that post-COVID PC glut, right? Now, tonight, HP reported a mixed quarter that was mostly better than feared. While their sales came in a tad light, they posted a 4-cent earnings beat off a 76-cent basis. Good operating margin, excellent cash flow, which we care about tremendously with this company. Same time, management gave solid guidance for the current quarter, actually raised their full-year forecast. So let's take a closer look at Enrique Lores. He's the president and CEO of HP Inc. to learn more about the quarter and the outlook for the future. Mr. Lores, welcome back to Mad Money.
Thank you, Jim. It's great to be here with you.
Oh, it's great to see you, sir. Enrique, I don't know, maybe I'm taking a liberty here, but I think it's time to call a bottom in the PC cycle.
Well, I think we are delivering on what we said we were going to do. During the first half, we reduced significantly channel inventory, and because of that, and because we expect to see normal seasonality from a demand perspective, we think that the second half is going to be significantly stronger than the first half, and that we are going to see growth second half versus first half. So we are more positive about the PC business now.
I want people to understand that's a very big call, Enrique. You are saying the second half will be very strong. Most people do not think that. Most people think it's just going to be okay. So is it new products? Is it share take? What is driving HP, your view that HP's second half is going to be so good?
Well, it's an overall market adjustment that we think is going to happen. If you look at the first half results, they were impacted by the reduction of channel inventory we and the industry have been driving. That channel inventory reduction is almost completed, so the impact on the second half will not be there. And at the same time, in the second half, because of back to school, because of the holiday season, especially consumer demand will be stronger. And when we combine both things, let us believe that the second half will be stronger than the first half.
Okay, so let's go a step further. Is it possible, I'm an HP user, so I'm thinking, do I get a new one? Do I get not a new one? AI, artificial intelligence, maybe a new chip, maybe a relationship with Microsoft, maybe my PC can do different things. Anything like that could be driving a whole new cycle.
I would say all of the things that you described. We think AI is going to bring a great helper to the PC business. It's going to help us to redefine what a PC is. The experiences that customers will be able to get are going to be much different. And we are working with all the key software vendors, with the key silicon providers to redesign the architecture of a PC. So we will be able to process locally all the AI applications that today are done in the cloud. Well, probably will help, Jim, if I give you an example.
Sure, please
Imagine you need to design a new spreadsheet. When you were an analyst, you had to spend a lot of hours doing that work.
Right.
What you will be able to do in the future is you will be able to ask your PC, give me the analysis that I need to get. And the PC will create the spreadsheet for you. And once the work is done, you will be able to dialogue with your PC and ask for further interpretation, further analysis. What is going to be critical is that this work will be done both in the cloud, but if you have your private information, your confidential information, you want to do that locally. You don't want to upload that information to the cloud. For that, you will need an AI-enabled PC, which is what we're building with all our key partners.
Well, I would think that you both need a new CPU, perhaps from AMD, and a change in the way Microsoft configures its programs, because current CPU and current Microsoft will not let us do that.
You are exactly right. Both of these things is what we need to change. And this is the work we are doing with Microsoft, with AMD, with Qualcomm, and many other silicon providers, because we think there is really an opportunity to create a new category of PCs that will drive significant refresh in the category.
There are people who spend hours going over spreadsheets, Excel spreadsheets, that you make it sound like could be done in minutes.
Or even shorter than in minutes. And this is just one of the applications that we are working on. There are many, many other applications where a similar impact will happen that is really going to help to bring new energy to the category.
Well, I mean, let's say I want to get a reservation in a restaurant. Can I talk to my PC and it can book it?
Eventually, it will also happen. I have been in this industry for many, many years, Jim, and I have never seen an opportunity like this to really drive innovation and drive new type of customer needs that we really think are going to be fundamental.
All right, so let me ask the obvious, which is, do I have to wait around a couple years for this to happen, or is this going to happen pretty soon?
This is going to start happening in 2024, so a few quarters from now. And this will just be the beginning of a very big change that is going to continue for many, many years.
In the meantime, I expect that you guys are ahead of the game. Perhaps you're even taking some share from others?
Well, we have been gaining share during the last 2 quarters, especially in categories where we think there is margin opportunity, because our goal is not to grow share by the sake of growing share. It's all about profitable growth. And for example, this quarter, we regained the #1 position in the commercial PC market, which, as you know, is more profitable than consumer. And we really are pleased with the progress we have made.
Well, I got to tell you, when I hear all this stuff about AI, I practically wonder, when can the consumer benefit? It always seems so business to business. It's obvious that it is completely Wrong. My view is wrong. The consumer is going to benefit very, very soon. Thank you for explaining that to us because it's a very big thing, Enrique. That's why I'm always so happy to see you on the show.
Very good to see you, Jim. Thank you. And I hope you saw how excited we are about the opportunities that we see that are really going to continue to drive the company forward.
Well, you make me excited too, and it's substance that makes me excited. That's Enrique Lores, President and CEO of HP Inc. Think about the future, people. Think about the future. It's huge. Mad Money's back at Bloomberg.
Coming up, Cramer takes your calls, and the sky is the limit. It's a fast fire lightning round. Next.
It is time. It's time for the lightning round. Play the sound. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's start with Alex in California. Alex.
Dr. Cramer. Booyah to you from West Los Angeles.
What's up?
Jim, I'm thinking of spending a couple of $100 in a bowling alley is considered discretionary spending. So with negative price to earnings ratio and a potential recession coming up later this year or next year, are you still recommending the stock of Bolero?
Well, the stock, I mean, candidly, I did not see the issues coming. There were some management issues, but I did not think that business on a weather basis got bad in California, that it would hurt their sales so much. It's rather dramatic. I'd like them to come on the show, and we can answer the questions that way. That's the best way to do these things. Let's go to Andrew in California. Andrew.
Hey, Jim. What are your thoughts on Corteva?
I happen to be bullish on that one, but it's going to be long-term. Why long-term? Because the ag market is very soggy right now, but I think it can make a comeback, and that's the best way to play it. I need to go to Jim, North Carolina. Jim.
Hey, Jim. How you doing, man?
I'm doing well. How about you, sir?
Good, thanks. Hey, I have a core holding that's been a complete disaster. It's probably hitting new lows as we speak. What can you tell me about Bristol Myers?
Boy, people have given up on the drug stocks. They really have. And Bristol's part of that complex. I am not going to give up on Bristol Myers because things are never so rosy that you can't have a drug stock in your portfolio. And that's a darn good one. I need to go to Troy in North Carolina. Troy.
Booyah, Jim.
Booyah.
Thanks for taking my call.
Of course.
I'm wanting to get your insight into the company TELUS.
You know, look, good yield. It's kind of like a lot of the other telco companies. The only one I really like is not the yielding company. I like T-Mobile. I think that T-Mobile has by far the best growth, and that's what I like when it comes to investing in technology. T-Mobile is my fave. And wow, it's nice off the high, too. Let's go to John in New Jersey. John.
Good evening, Mr. Kramer, the Money Tamer. Booyah, how are you?
Money Tamer. I like that. I'm going to tell my wife about that tonight. She needs, well, yeah, absolutely. Well, we'll talk generically. What's going on?
Jim, I purchased Verizon back in August 2022. I spent $250,000 for 5,200 shares. What's going on?
Okay, it's the growth. The growth isn't there. People are worried about the dividend. I'm not as worried about the dividend. I don't see the great growth. The growth is coming from T-Mobile. Let's go to Aaron, Illinois. Aaron.
Hi, Jim. I love the show. I just want to know about ticker AOS.
Okay, when you're starting to talk about just plain vanilla heating, ventilation, thermostats, boilers, that is a terrific kind of play, but I'm telling you, I see that and I'll race it with Carrier, where I really like the acquisition that they're doing over in Europe. Now I'm going to Steve in Pennsylvania. Steve.
Hey, Jim. Greetings from Cheltenham, Pennsylvania, right next to the old stomping grounds.
Yes, that's that old rival of Springfield High School, Montgomery County. How can I help?
We used to beat you guys like a drum. Yeah, Jim, you made a lot of money.
That's totally untrue. No, we repeatedly crushed you. That's never happened. I'm sorry. Go ahead.
You made me a lot of money in the healthcare insurers. What's going on with Centene?
Okay, I think Centene, first of all, the healthcare business as well. I mean, it's being killed by the government. But also, Mr. Neidorff passed away, who ran that company so well. So it's very hard for me to judge it without Mr. Neidorff. That's just the way I look at it. Let's go to Gene in Ohio. Gene.
Hey, Professor Kramer.
Yes.
This is Gene in Dublin, Ohio, home of the Memorial Golf Tournament, the golf capital of the world this week. And my
also,
stock
Wendy's
is
too.
SMCI.
Oh,
Super
my God. Okay,
Microcomputer Inc.
Look, no, they, this is the hot server company that everybody likes. I am not going to recommend that stock up here. Now, I am sure there are people who say, how can you not get on board? No, I like so many tech companies. I can't get on board that one. It's just too hot. John in New York. John.
Hello.
Hey, John, what's up?
What's going on?
You tell me.
Long Island, New York. I just have a question. With banks and rising interest rates, what do you think about Upstart?
Okay, Upstart is a short squeeze, plain and simple. It's not doing that well. It's like Carvana not doing that well. Doesn't matter. It's being shorted, Wayfair, and they're rallying. And that, ladies and gentlemen, good of the lightning round.
The lightning round is sponsored by TD Ameritrade. Coming up, there's plenty of wisdom to be had from a modern-day Da Vinci. The CEO of the first trillion-dollar semiconductor company speaks, and Kramer's listening. Next. Tomorrow, kick off the trading day with Squawk on the Street. Live from Post 9 at the NYSE.
I have to tell you, you're not worried about Social Security.
No, I'm not. Are you on Social Security yet?
now.
It all starts at 9 a.m. Eastern.
Remember, either you're running for food or you're running from becoming food. And oftentimes you can't tell which. Either way, run! That's what the most important person in technology, Jensen Huang, had to say at his commencement address at National Taiwan University this weekend. As is usual for the man who turned NVIDIA into the first trillion-dollar semiconductor company, the speech was all about humility. He talked about NVIDIA's 3 brushes with Doom, a bad bet on gaming console contract, a 3D graphics mistake, a bold move into mobile phones that was quickly abandoned because wireless chips are too commoditized. His takeaway? You cannot be afraid to fail. He told NTU grads to run, not walk, but also be prepared to stumble. He's optimistic about what's ahead, a 10-year cycle, maybe equivalent to the beginning of the internet. That optimism is backed by real orders and real revenue with a forecast 50% more than Wall Street was looking for in the next quarter alone. That is just staggering, the biggest forecast lift I've ever heard, and I've heard a lot of them in my time. While the skeptics might say NVIDIA's trillion-dollar valuation is ridiculous, we know that companies from a host of industries, advertising, autos, internet, gaming, among others, all want his super expensive H100 graphics cards, and they want them now. These cards are like gold if you need incredibly fast computing power to handle generative AI, something with the capacity to make many businesses more efficient and, by the way, only invent trillions of dollars in new industries that we can't even comprehend or dream of now. Jensen's adamant that AI will end up creating more jobs than it destroys, but this is a show about investing, and as investors, it doesn't really matter either way. Now, I voiced a little skepticism this weekend in a piece for the Investment Club, skepticism about the business, given that so few of the executives I met at the CNBC CEO Summit in Santa Barbara are actually using NVIDIA's highest-end products. They seem more fearful of it than excited about it. Fearful their competitors will have, and they won't. I think they're right to be worried. NVIDIA's graphic cards are what allows AI to run efficiently. The same goes for network engineering and cloud infrastructure. Nobody else comes close. That may not sound super exciting to you, but these products, which when bundled for strength can cost hundreds of thousands thousands of dollars are for the enterprise, not for you, not for the consumer. They're not meant to be exciting like using Amazon to buy things or using Google search or grabbing the next iPhone from Apple. Very few consumers could afford even one of NVIDIA's highest-end graphics cards. And what would you do with it? This is hardware that enables things behind the scenes. That's why it's so hard for people to accept that NVIDIA could possibly be this big. If you're a consumer, this company's invisible to the naked eye. To the extent regular people interact with NVIDIA, it's gamers buying consumer-level graphics cards to soup up their computers. But the growth potential here is much smaller than the enterprise business I'm talking about. I feel fortunate because I've liked NVIDIA for ages, and we've owned it for the Charitable Trust for years. I even renamed my dog after NVIDIA when I came back from a visit to the company's headquarters. I've seen the greatness of generative AI in person before anyone else even cared about it. I'm constantly blown away by what NVIDIA can do with gaming hardware, the lifelike nature of the characters. I've seen them create my doppelganger. I've even talked to him, courtesy of Jensen himself. I call him Da Vinci because he's both a visionary and a Renaissance man. Frankly, we may never see anything like this NVIDIA rally again in our lifetime. But in the end, Jensen's not about winning or about wealth creation. He's about being a good person. He's about staying humble. Maybe that's why so many investors don't seem to know about NVIDIA. They're just not promotional enough. Jensen's running, but being prepared to stumble, just like the rest of us. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
Hi, I'm Brian Sullivan, and tonight, risk of extinction. Hundreds of top tech minds sound a new alarm on AI. Is an investing frenzy overlooking the risks? Not on target.